0.11. Dollar index was up 0.48. We're back about 97, 97.34 around is where we trade. Today, all eyes on the Bank of Japan meeting. There's no US data per se. Bank of Japan meeting decision should come out in the morning in the first 1.5 hours. No big data point out of the US except the fact that its futures and options expiry there and the large volumes, etc., get transacted. Fed is out of the blackout period, the Federal Reserve. And the only reason I'm mentioning that is because perhaps you will hear from Trump appointee Fed Governor Stephen Miran, who is the only one on that FOMC who said, well, we should cut 50 basis points. And will he come out strongly in a way? I think it'll be interesting to see. I mean, others, of course, also, but I think this one is the one where there'll be maximum amount of focus because he kind of sort of represents Trump's demand that the Fed lower faster and more. Now, Trump, of course, also had something to say about the Russian war and what's happening there. So he said, well, Vladimir Putin, the Russian president, let me down. That's a quote. He said allies must stop buying oil and, you know, a little bit about the tariffs he's imposed on India as well. Now, just actually, I don't usually mention single stocks out of in the US in terms of what has happened, but really big moves and all in areas which are relevant for us as well. So NVIDIA announced a $5 billion deal with Intel. And the stock jumped. NVIDIA was up 3.5%. Do we have the price? Yeah. Do we have the price? NVIDIA 3.5% higher. Intel was up 23%. Okay, I don't think we have the price. We had Novo Nordisk, which was up 6%. Big jump there. That announced positive trial results from their anti-obesity pills. Remember, so far, you know, stuff like Mounjaro, Ozempic, etc., you got to take shots. But now we're talking about pills. Again, implications here. Novo was up 6%. And there was a company called ETNB, again, a small pharma company. Roche is acquiring it. Stock went up 85%. After the bell, you also had the old sort of FedEx, which was up 7%. And they basically reinstated their earlier guidance, essentially meaning that they're now expecting better earnings compared to what they put out earlier. Okay, now let's just quickly tie in the levels here. We've had a good run, very good run. 1,000 points off the lows of 24,400 to where we sort of left off yesterday. The next stop in that sense for the market is the high of 25,669. So that's the immediate stop. It's the second level we put out yesterday, which, of course, after the market crossed the first one yesterday, this becomes the immediate resistance point. Support is 25,210, which is the 40-hourly average, which continues to be dragged higher, pulled higher, as the market has inched up. Bank Nifty, 12 straight sessions, positive closes, no signs of a reversal yet. Here, resistance is at the high of 56,156. Again, not very far away, 1.5%, 2% away. And for the Nifty Bank, the support is, again, the 40-hourly exponential average, which is 55,177. So, you know, pretty good going. And we're inching closer and closer. And yesterday was a case in point, right? The Nifty really ramped up. It was not doing all that great. But starting about 2:30, from 2:30 to 3:30, the Nifty moved up 100 points. Nifty Bank rallied from 2:30. Midcap index, of course, the bottom was around, 1 o'clock earlier. So, you know, that the tendency to try and look for dips to buy, I think at the margin that is starting to come back. I don't want to jinx it, but the chorus seems to be growing a little bit, that maybe new highs by Diwali. So we'll see. It's not very far away. I think about 3.5% from where we stand. GIFT Nifty will give you a quick sense of how we like it to start. We'll pick it up from there. 40-odd points lower is the setup. Nigel is standing by with the F&O stats right now. Nigel, over to you.
Well, Prashant, over the last few days, if you buy the dip, you did make money. And, let's see whether or not that plays out, because after a while, the GIFT Nifty is suggesting that we pull back 40, 50 points or thereabouts. And there are two big points that are playing out for the Indian markets. One is the institutional buy numbers. Yesterday, both of them were on the right side. You had more than 3,500 crores of net buy number coming in from institutions. Point number one. Point number two, the short covering does continue. And the FIs, they've aggressively net short in the system. And those shorts are gradually getting covered. Even yesterday's trading session, 6,200 contracts were covered on the short side. But keep in mind, even after this sort of a short covering, they're still at around 86% on the short side. And just take a look at this. We're bounced 1,000 points from the recent low on the Nifty. And we make this point, right? When the FIs get aggressively net short, don't get nervous. In fact, that could be a blessing in disguise. And that could provide that much-awaited short covering bounce. That's precisely what's happened. from around 1.9 lakh contracts on the short side. Just take a look at it. In the last few trading sessions, it's down to around 1.5 lakh contracts, telling you the power of short covering and the way the FIs have got stuck on the wrong side. And in yesterday's trade, it was pretty clear, right? In the live market indicator, you do have the open interest. And on the Nifty bank, that's where bulk of the shorts were getting built in. And now they are scampering for cover. Even in yesterday's trade, the bigger short covering bounce had come in on the Nifty bank. And that's what's caused the Nifty bank to move to a 12-session winning streak, which we haven't seen in a while. So that one's, got its rhythm back. And that's good news for the markets on the whole. The PCR a few sessions ago had gone to around 1.35 odd. That's cooled off to around 1.16. Remember, when it goes to around it's cooled off to around 1.16. When it goes to around 1.6, that's where you see the markets get a little bit overbought. So we're a distance away from those levels. PCR has cooled down. And just take a look at it. The calls as well as the puts, there is equal amount of addition on both the sides. So on the call side, we had a good amount of open interest build up, both at the 25,500 call, 25,450 call, while on the downside, going by the put writing as well, we get straight to the levels. So going by the options here, the 25,250 mark, that's the important mark. You don't want to breach this on the downside. But I think the bears will really want to defend this. The 25,500, 25,500 and 50 mark. That's going to be extremely important level. And that range is something that the bears will be looking to defend. Getting to the other stocks that I'm looking at, you have the Nifty bank that's found its way. Reliance Industries, that's at a very, very crucial juncture. You need to get it past that, 1,440 odd level. That's the one that could lead the way actually from here on. So I'll be keeping an eye out on the big boy Reliance Industries. Besides that, a few stocks that we'll be looking at, the ones that are moving in and out of the F&O ban. HFCL, that's the one that's moved into the F&O ban. So we'll keep an eye out on that stock. While yesterday, late in trade, I told you that Oracle could be the stock that comes out of the F&O ban. And that's precisely what's happened. So that's another stock that we'll be looking at. And keep an eye out on RBL Bank. There's a high possibility that that one could be making its way out of the F&O ban. It appears that the shorts are getting nervous on that particular stock. So that's an important stock, not just for today, but for the next few trading sessions. That's the one I'll be looking at. And besides that, Adani Group companies, some relief coming in there in the Hindenburg case from SEBI. They've got a clean sheet, so those stocks could be active. And the other one during the day will be Vodafone, because there is a Supreme Court hearing today. So those are the stocks that we'll be looking at.
Indeed, and the other big one to watch on the global front will be a potential meeting between Trump and Xi Jinping. So let's see whether we get any more. We seem to have got a framework deal on TikTok, but whether we get any actual details on US-China trade deal. But let's, break down the global markets and the cues for the Indian markets. Jeffrey Dennis, independent emerging market commentator, is now joining us on the show. Jeffrey, thank you very much for joining in. Another day, new highs, and this time all four indices scaling record highs on Wall Street. The Russell 2000, best levels since November of 2021, 2.5% higher. So first, the first question is, for how long does the euphoria last in the US markets? Can it sustain from here on? And two, yesterday we saw the bond yields go up despite that Fed rate cut. What does that tell you?
Well, first of all, I think the euphoria can continue for a while. I certainly think there are valuation concerns, and of course there are concentration concerns about the where the major part of the rally is coming from, which is technology and AI in particular. But I think the policy mix we're seeing now at the moment, with the Fed starting to cut rates and suggesting that it may cut more now than they had anticipated in the June dot plot, is all very supportive, as long as inflation doesn't run out of control to the upside. So I think, as ever, it'll be choppy. I don't think it's going to be a straight line, but I don't see the case right now for a sharp sell-off in the market at this point. On the bond yields, the initial take, of course, after the Fed announcement was that bond yields came down. 10 years briefly breached below the 4% level, and they've rallied since. And I think that's simply a realization that there's a bit of an inconsistency between the Fed now calling for more rate cuts in the dot plot, and on the other hand, heighten a rise in their middle GDP forecast, and also the actual rise in inflation. So I think people are worried now that if the Fed is going to get aggressive here, as we go through the next year and a quarter, let's say, perhaps inflation isn't going to be so benign as everybody would have hoped. And I think that's explaining partly why the yield curve, why the long-term bond has moved up in terms of yield.
Yeah, Jeffrey, but data is pretty strong as well, right? And it's strong till it's strong. And there are some who say very strongly believe the data is rolling over, actually. This is the last of the hurrah, but, lower jobless claims, big drop there. Philly Fed manufacturing index, earnings growth has been pretty strong in the US. So, yeah, I mean, it's looking strong overall is what I'm saying, basically, for the US.
Well, I think it's fair to say the GDP number in the third quarter will be quite decent, and certainly would not suggest the Fed should start to panic in terms of interest rate cuts. And I think they go slow. The labor market is almost certainly weakening. The jobless claims a week ago were distorted upwards by a couple of factors, apparently. And maybe we're just getting a bit of a correction there in the right direction this time. But at the end of the day, payroll employment is basically stalled out. The unemployment rate's ticking up. And so the labor market is weak. And the Fed has to keep an eye on that, even though you're seeing the components of GDP growth, consumer spending, particularly investment, being pretty strong. Now, what's interesting, I think, about this as an economist, which is what I am, is the labor market is normally a lagging indicator, whereas at the moment it looks like the biggest warning flag we've got on the economy is in fact the labor market. So that's the puzzle we've also got to sort out. Economy's okay for now. The labor market must be watched and is clearly at some risk of stalling completely and are seeing a reasonable increase in the unemployment rate.
Hi, Jeffrey. Good to see you, Ben, this morning. Because of this Fed rate cut, you could continue to see some kind of weakness possibly on the dollar index. And we've seen the dollar index is struggling to get past that 98-odd mark as well, just in the near term. Given the kind of weakness you've seen in the dollar index, how would you position yourself to global equities? The emerging market, MSA emerging market, that's done a big outperformance in comparison to the developed markets. Do you believe emerging markets will continue to lead the way? And the Indian markets, which really haven't moved in step, do you think it's time for the Indian markets as well to keep pace or maybe outperform?
I do think the emerging markets are going to continue to do well because, as I say, with the Fed seemingly now wanting to cut rates twice more over the rest of the year, twice more in 2026, despite a decent economy and some uptick in inflation, and inflation would suggest they're taking a little bit of a gamble here. We may be seeing the beginnings of the politicization, if you like, of the FOMC, but we'll see if that's true over the next few meetings. But all of that is why the dollar slipped yesterday, although it did rally a little bit today, Thursday, in the US. But I see the dollar going weaker still, because I think that's what the policy framework is giving us. And in that event, I think EM continues to do well. We've just broken on Thursday a 9-day winning streak for EM when they were up 6.8% in dollar terms over those 9 days. And I think that winning streak will eventually resume once again. The gap versus DM is about 1,000 basis points for the year. Now, where do we put India in this? India's been very frustrating. I think there's some great things about India. The growth story, the room potentially for further rate cuts, the simplification of the GST, the drop in oil prices. Maybe eventually we're going to stagger towards a US-India tariff agreement that brings the tariffs down. But I think at the moment, what people are looking at is they like what they see in China. I'm not sure I really agree. Market's cheaper, hasn't done well until this year, really beginning to catch up. And some measures taken by the Chinese authorities. So I think eventually the Chinese economy will be seen for what it is, which is a slowdown story with still many, many problems. And that's when people will start to rotate back in towards India. So I'm not sure India is going to be your short-term outperformer, but I certainly think the market goes higher from here over, let's say, the next 12 months.
Jeffrey, great conversation. Thank you very much for joining us. Really appreciate you being here as always. Thank you. I think we're going to just run you through what's coming up here on the program, Interactions. 8:35, we have H.P. Ranina, Senior Advocate, Supreme Court, and Sanjay Asher of Crawford, Bailey and Company joining us. SEBI has, of course, given a clean chit to the Adani Group in the Hindenburg case. 9 o'clock, we'll be joined by Jay Kale of Elara Capital as Maruti announces new car prices. 9:20, Dheeraj Agarwal of Ambit Investment Managers will be a market master of the day. 9:35, the management of Oil India to discuss the impact of GST rate hike on exploration services. Vivek Sharma of Cohance Life Sciences will be speaking with us at 9:45. So there is, of course, that upsizing a block which happened, large block. Towards the end of the program, it's our special segment, it's the economy. Lata speaks with Priyankar Biswas of JM Financial Institutional Securities on the state of construction companies post the GST cut.
Time to slip into a short break. We've got a lot of stock-specific action in our special top 10 segment. For the time being, I give you a sneak peek. Adani Group stocks, JSW Energy, Ramki Infra, you have John Cockerell India, Texmaco Rail, all of them will be reacting to positive news flow. While you add to the list Cohance and Vare Energies as well. On the flip side, Indian Hotels, Unichem, and one more big wick could be the ones that could come in for some red. Slip into that break, come back, we get into further detail on all of these names.
Good morning. It's a Friday and we look all set to wrap up the third consecutive week of gains. This week, the Nifty and the Midcap index is up close to about 1.5%. We got a positive handover from Wall Street, record highs, closes for all the key indices, but the picture across Asia right now is mixed. Nikkei is rallying. That's hit a record for the second consecutive session. The BOJ decision is awaited, but the rest of the Asian markets are a bit sideways. Taiwanese markets are up for you on your screen. The GIFT Nifty, we'll get that up. Implied open is down close to about 40-odd points. So perhaps some of the exuberance from yesterday in the last 1 hour could get tapered off. But let's talk about stocks. Our entire research team is standing by with CNBC's list of top stocks for the day. And first up, it's Vivek on JSW Energy. Good morning, Vivek.
Well, good morning. Well, two independent and separate news flows that have come in as far as JSW Energy is concerned. Again, the company is going ahead and aggressively adding capacity and in fact has gone ahead and preponed its capacity addition target. Now, the first news is the company has gone ahead and entered an agreement with Statkraft IH Holdings. The company will be acquiring 100% equity stake of Taidong Power Generation. Remember, Taidong has a 150 megawatt under construction hydro power project. FY25 revenue for that particular project was at close to 39 crore. Transaction is for an enterprise value of 1,728 crores, taking JSW Energy's total RE portfolio to 30.5 gigawatt. Now, again, an important development, GE Power, again, which is a listed entity, will be demerging the business of manufacturing as well as supplying power boilers. This particular segment will be demerged into JSW Energy. It's not a cash consideration, rather JSW Energy will be issuing shares, 10 equity shares for every 139 shares that investors hold as far as GE Power is concerned. The demerged entity financials at close to 530 crore, constituting approximately 5% of total GE Power's financials. The rationale for this particular deal is JSW Energy wants to enter the boiler pressure parts manufacturing business. Positive development for JSW Energy.
Okay, all right. So we'll keep an eye out on this one as markets open. Vivek, thank you very much for that. Indian Hotels, there's a large transaction there which has been announced. So Indian hotels getting out of overseas property. And this is a marquee one. Mangalam is here with details. Mangalam, over to you.
That's correct. So Prashant, actually, it's not a large transaction that has materialized. It is a large transaction that the possibility of it being materialized was reported, and the company has clarified on that. So they've actually clarified on the possible sale of Pierre NYC. Remember, there were reports in the newspaper yesterday that it would be sold for about $2 billion, and the company, when we reached out to them, said no comments. But now they've said and gone ahead and told the exchanges that they don't own the pier. They don't have any ownership on that. In fact, they just own the leasehold rights for the hotel, and operations for them continue as usual. So any reports on the other side are all speculative and unconfirmed. So as a result of which, they're basically denying any such possibility, and doing so, they're denying their ownership in their hotel as well. The stock had seen a recovery from the lows yesterday on the basis of this news and the possibility of a loss-making asset going out of their books. But the fact is that that asset wasn't on their books in the first place, as the company has clarified. So any sale or not will not affect the listed entity. So on the back of that, I see a reversal on the recovery that we saw yesterday. To starters, red for Indian hotels.
Thank you very much for that. Vamakshi is also joining in with some more stocks which are in the news.
Absolutely, Reema. Take a look at Ramki Infra. The stock will be in focus because they've bagged a 2,085 crore HAM project from Hyderabad Metropolitan Water Supply and Sewerage Board. Now, this is for execution under the Godavari drinking water supply scheme. Now, keep in mind that the order book that the company had stood at 7,650 odd crores, as on June 30th, 2025. So, therefore, this is a huge order, almost amounting to almost 30% of the company's existing order book. Now, the other stock we're watching out for is the name that we don't speak about very often, John Cockerill. Tata Steel has awarded a major contract to this particular counter for push-pull picking line and acid regeneration plant at Jamshedpur. Wadi Energies is the next stock we're watching out for. Its arm Wadi Power will be subscribing to 76% stake of Racemosa Energy for around 53 crores. Now keep in mind that Racemosa Energy is involved in the business of manufacturing of smart meters. Railtel, another order win for this particular counter. They've won an order worth almost 87 crores from Ultratech Cement, and this is for BCFC wagons along with a brake van, which will be delivered by March 2026. And lastly, on the flip side, we'll be watching out for one MobiKwik. Not great news coming in for this particular counter, because they've gone ahead and confirmed isolated technical issues did occur on September 11th as well as 12th, leading to certain failed transactions being incorrectly marked as successful, and that has resulted in unauthorized payouts to some merchants. Now, the total financial impact, in their opinion, has been contained and quantified, and an FIR has been filed with local authorities. Arrests have been made, and around 2,000 merchant bank accounts have been frozen. Now, the company has reiterated that this was not a cybersecurity breach, but a limited internal processing error, which has now been fully addressed. So, red on the screen for one MobiKwik.
Okay, all right. Thanks a lot for that, Vamakshi. Let's hop across to Vinny. She's here to tell us about some more stocks that are on the news. Hey, Vinny, morning.
Hi, good morning. So starting with one of these railway companies, we have Texmaco Rail that has also received an order of around 87 crores from Ultratech Cement. This is also for BCFC wagons with brake vans, and this is expected to be delivered by March 2026. So we're expecting a green coming in for the stock here. Cohance, that's the next one that we'll be keeping an eye out on. This is actually in response to the 6 observations that they had received from the US FDA, which was in their Hyderabad branch. Now they're giving a clarification saying that the company has already filed that corrective and preventive action plan that has to be submitted, and they're working with the US FDA in terms of the stipulated time that they should correct these actions. Now, other than that, do not forget this facility doesn't account much in terms of overall consolidated revenues for the company. As of FY25, it was just 2% of their, less than 2% of the revenue, consolidated revenue, and EBITDA contribution was also below that, or below 1%. So not a major impact coming in, but a mild, up move is what we could watch out for, given that there's a clarification coming in. Lastly, Unichem Lab, that's the one that we'll be keeping an eye out on. Red expected here, as they've received a demand notice from European Commission seeking a payment of around 19 million euros, that's 175 crore rupees, in connection with some drug case that was going on for the company. Now, the company will be accounting for around 5.52 million euros that will be provided in the books of accounts in 2025 and 2026. So we could see some bit of that impact coming in overall for the books of the company.
Okay, all right. Thanks a lot for that, Vinny. Well, let's go across to Sudarshan. Adani Group stocks are going to be in focus. Clean sheet coming in from SEBI. So tell us more.
Good morning, Nigel. So all the Adani Group companies will be in focus today because SEBI has come out with the final order in the case related to Adani Group and Hindenburg. And the one headline is SEBI has given clean chit to Adani Group companies and also to both Gautam Adani and Rajesh Adani. Now, SEBI had probed, so basically Hindenburg had alleged Adi Corp Enterprises and had said that it was used as conduit to route funds from various Adani Group companies to fund Adani Power. So SEBI has probed Hindenburg allegations for any possible violations of SEBI, and also it has probed if listed Adani Group companies made material misrepresentation in financial statements, and another probe was if listed Adani Group companies attempted to circumvent SEBI registration between FY13 to FY21. Now, what does the order say? It says Adi Corp was not a related party of Adani Enterprises, Adani Ports, and say no SEBI rules were violated by Adi Corp. Second, SEBI registrations in effect at time of transactions don't cover transactions between unrelated parties. Third, there is no basis to charge Adani Enterprises, Adani Ports with violations of prohibition of fraudulent and unfair trade practices. Also, manipulative that there is no allegation of siphoning of the money or diversion of funds that Hindenburg had alleged. So overall, it's a positive outcome from the SEBI related to Adani Group and Hindenburg case.
Appreciate you joining in, sir, and giving us all those details. In fact, we'll take the discussion forward. We'll have Mr. H.P. Ranina, the Senior Advocate of Supreme Court, and Sanjay Asher of Crawford Bailey, who will be joining in at around 8:35 a.m. to discuss about this SEBI clean chit in detail. Let's do a quick recap of all the stocks we just discussed. Ones with positive news flow: Adani Group stocks, JSW Energy, Ramkey Infra, John Cockerell, Texmaco Rail, Cohance Life, as well as Vari Energies. While on the negative side, you have Indian Hotels, Unichem Labs, as well as One MobiWick. That's it about the equity markets. Let's hop across to Manisha Gupta. She's joining in to tell us what's going on in the commodity market space. Morning, Manisha.
Morning, and thank you for that, Nigel. Well, I'm looking at mostly a decline coming in for various of these commodities, and I'll start with the crude oil prices, where we are looking at prices actually heading for a second weekly gain, but off its highs. There is a strong statement from the U.S. President Trump saying that he prefers cheaper oil over additional sanctions on Russia. So that kind of takes away the immediate supply disruptions because of Russia sanctions from the market there. Also, the U.S. Fed rate cut by 25 basis points and indications of more rate cuts on the signs of job market weakness. It's something that the markets are looking at with two coins here. On one side, well, yes, it's positive because you have the weakness in dollar and there is more liquidity available. But on the other side, it does tell you about the weakness in the markets as well. Consumption also in the U.S. markets is lower, as can be seen from the data. The U.S. distillate stockpiles gained up by 4 million barrels just in the previous week itself. So that is something that will keep the prices in check there. But it's not just crude. If you look at the steel rebar futures, they are trading at a one-week lows. Demand worries coming in from China. Copper prices are now declined to a two-week lows as well. If you look at gold prices, we are off by nearly $60 to $70 from the day of the U.S. Fed meeting. There is profit-taking not just in gold but in silver as well, which has seen a decline of 3% since that U.S. Fed meeting also. So some bit of a profit-taking still continuing in Asia markets for many of these metals.
All right, Manisha, thank you very much for that. So a little bit of profit booking in some of the precious metals like gold. Well, let's just talk about the brokerage calls of the day, and lots of movement, single stocks. So take it away.
So I have two companies which are in the focus also on the back of news. So first one in that list is Adani Power. So Morgan Stanley has initiated coverage with an overweight call, and target here is 818 per share. It says Adani Power is a good illustration of turnaround in India's corporate history, and it has resolved most regulatory issues and made multiple value-accretive acquisitions. And because of that, it sees strong earnings growth, and that would be driven by timely completion of projects and more PPA wins that company will have going forward, and it forecasts capacity to rise by 2.5 times and EBITDA by 3 times by FY33. Second stock that might be in focus is JSW Energy. MS maintains overweight call with a target price of 659. It says total portfolio of JSW Energy has risen to 30.5 gigawatt, and hydropower portfolio has increased to 1.8 gigawatt, and it has surpassed medium-term guidance. Jefferies also has come out with a note on JSW Energy. It maintains Biocon with a target price of 700. It says company is targeting capacity addition of 4.4 to 4.9 gigawatt in FY26 versus Jefferies' estimate of 3.1 gigawatt. And because of the major capacity addition, it sees an increase in EBITDA by more than 4 times by FY30. So keep an eye on both these names because these two stocks will also be in the focus on the back of news and also because of positive brokerage notes.
All right, Deepan, Sud, thank you very much for that. That's brokerage calls, which we will pay attention to. We'll take a break. We're back. Deepan Mehta with some fundamental stock conversation. Of course, that discussion on the Adani clean chit also coming up in just a bit. A short hit with the Biocon management because there's some positive news flow there. All of this coming up in just 2 minutes.
Welcome back and hope you're having a good morning. Well, let's focus on Biocon. They have secured the US FDA approval for 2 biosimilars. We have Mr. Shreyas Tambe, the CEO and Managing Director at Biocon Biologics, who joins us on the show. Hi, Shreyas. Good to speak to you, and thanks a lot for joining on the show. Before getting to you, we're just going to tell our viewers the 3 big points we're going to focus on. The market size of these 2 biosimilars, how competitive is the market, and finally, when can we expect the launch of these biosimilars? So let's get straight to the action. Shreyas, good to have you on the show. Give us a sense first of the total market size for these 2 biosimilars. If you could give us a rough estimate out there. The estimates that have come in, from various notes are suggesting it's around $4.5 billion, the market size. You can correct us on that. And what is the revenue potential for Biocon? Some are pegging it at around $100 to around $150 million. Your take?
Yeah, thanks first for having me on the show. I think this is a great development that we are sharing with you. It's amongst the several positive developments that we've had over the course of the last 10 months. We've had 4 approvals in the US in the last 10 months, which is unprecedented. So it's a phenomenal achievement both on our scientific capabilities as well as our operations and quality capabilities. But let me answer the three questions that you asked in the beginning of this conversation. First up, you are bang on in terms of the market size. It is $4.5 billion just in the US. But it's a very large asset. It has two products, one in bone health and the other in the oncology indication. And globally, it's an asset which is over $7 billion. So it's a very sizable asset. We have not seen too much competition, so there aren't too many players so far who've secured approval. Of course, when you have an asset of this kind and size, you expect competition. That's a part of how the market plays out. But we've been very successful in the oncology space in the past. If you've seen, we've had over a fourth of the market in all the products that we've so far commercialized our products in the US. And coming to your third question, which was about when do we expect to launch this product, that's pretty soon. We've seen launches only begin a couple of months ago. And now that we have approval, we should be keeping you posted on how we will bring this product to the market and make things better for patients in the US.
So the market.
Good morning. Over the because there are other players who launch this as well. Eventually, there are some 8 players who are going to be there. Is there an estimate broadly, roughly, and we wouldn't hold you to the numbers, but is there a sense of how much will you make off these two products, of these two biosimilars?
We've avoided giving specific guidance on how much you would make, but if you've looked at past to give a good indicator of what it has been for the future, we've had over, this is our 9th product in the US. 3 of them have been approved in the recent past. This is the 5th product that we've got approval in the last 12 months. But if you look at the 3-4 products before that, we've had a more than fair share of the market. There have been more than, so if you say 8 players, then technically we should have more than an eighth of the market share. We've always had more than a fair share. And even if
how many players, Shrihas, are there in these two right now? 8 eventually, but how many are there already?
We see 2 of them who've launched the product so far, to the best of my knowledge. Maybe there's a third, but these are all launches in the last couple of months or 3 months at top. So we expect us to be in the first, if not, the early entrance into this market in the US.
As more players come in, what happens is prices drop precipitously, right? As more and more come in. So is that something you expect?
Again, I say price is an artifact of competition. You will see that. So you're right to that extent. But the assumption that prices fall precipitous is a myth. And for that, we've again looked back at the products we launched in 2018. Those products are still on the market. Innovator still plays in that game. And you have held on to 35 to 40% of the value before patent expiry. So I think this extrapolation is from the small molecules generics world, where you see in the first 10 days, you see 95% of the value erode, which is where the Indian generic industry is very familiar with. But that's not how the biosimilars market behaves. And we've seen that, far more durable in terms of how value is preserved.
Got that. Shreya, just a quick clarification. You said, I think the market opportunity is $7 billion. Is that the number? And you would be potentially the 3rd player to launch.
That's the global opportunity. The US opportunity, I think your colleague was right, it is $4.5 billion thereabouts.
Okay.
And we would be the 3rd or the 4th player in the market at this point.
And any broad timeline of launch and time to peak sales, how long will that take?
For competitive reasons, we've not specifically talked about launch timing because that's not something we want to indicate, but it's eminent given that we have the approval now. Having said that, what should we expect on this? It should be sooner than later. We've entered almost every product that we've got into the market. We've got 2 products this year, and we're looking to bring in 3 products next year. So it's a very, very exciting period.
Okay, all right. Appreciate you joining in, Shreyas. Thanks a lot for giving us a sneak peek into the opportunity. As things unfold, we re-invite you on the show and we get further details as well. Have a good day ahead.
Thank you so much.
All right, well, let's move on then. That's about Biocon. Clearly a big opportunity which should play out in the coming months or coming years. Let's get Deepan Mehta, Director Elixir Equities, who joins us on the show. We also have with us Mr. Sanjay Asher, the Senior Partner at Crawford Bailey, who joins us, as well as Mr. H.P. Ranina, Senior Advocate of the Supreme Court, who joins us to discuss the clean sheet that's been given to the Adani Group. Hi, Mr. Asher. Let me come across to you first. What do you make of this? It's clearly good news for the Adani Group. What's the way ahead?
No, it's certainly a good news, not only for the Adani Group, but for the Indian corporates as well, and for the markets as well, because that reposes confidence in the regulator, in the Indian corporate governance, so on and so forth. So, way forward is, yes, at least now the hanging sword on the Adani Group is now put to rest. So I don't think there would be any further investigation or any further scrutiny of all the allegations which Hindenburg had put on the Adani Group. So, having said that, Adani Group can now be assured that, look, at least the one which was pending has been put to rest.
Okay, so it's shut the door on any further legal scrutiny. Mr. Ranina, morning. Very simply put, can you explain why SEBI legally has concluded that the transaction didn't qualify as a related party transaction or there were any violations of fraud, etc.? Can you explain simply?
SEBI has gone into the facts of the case. Please understand that SEBI is the final fact-finding authority. And they have gone into all the facts, all the details, they've got the documents, they have heard both parties, and they've come to the conclusion based on facts that there is no allegation, that the allegation made is totally without any substance, and there is no need to say that they have violated the law. Now, this being a question of fact, you cannot go in appeal because no court can decide on a question of fact. They can only go on a question of law. And no question of law is involved anymore. The facts have established that this Adani Group has not done anything which is improper, illegal, or in violation of any rules, regulations, or the law. Now, this being a question of fact, therefore, the matter will now come to an end. Of course, they'll have to report to the Supreme Court because this is a Supreme Court monitored investigation. And the SEBI will now give a report to the Supreme Court based on the factual evidence which they have gathered, and where the conclusion has been reached that there has been no irregularity or there is no illegality committed by the Adani Group. This will be reported and the matter should now be closed.
Mr. Ranina, will it have any bearing on the US indictment against the Adani Group entities? As far as I remember, that was connected to violation of the Foreign Corrupt Practices Act, FCPA, and bribery allegations, etc. Will there be any sort of a bearing, any sort of a connection on that?
Well, the facts gathered by SEBI will be put before the US court, and the American court will take those facts into account and then show that there is not any irregularity, because if there is any irregularity, it would be both under Indian law as well as American law. And if there's no irregularity, then obviously the American court will take cognizance of the facts which have been gathered by SEBI.
Okay. Mr. Asher, what are the implications, from a foreign investor point of view about infusing confidence in the Adani Group? It's not that on account of this allegation, we haven't seen money flowing into the Adani Group entities. For instance, GQG, the Qatar Investment Authority, they made some large investments in the Adani Group entities. But what is your take? Now that we've got this clean sheet from SEBI, what are the stock market implications?
To my mind, yes, it's a positive development and a very positive development for the investors as well. Because after the highest court in the country having requested SEBI to get into deep dive and get into the scrutiny, and after SEBI scrutinizing the entire transactions of the Adani Group have come to a conclusion. And as Mr. Ranina articulated, that yes, they have got into all the facts, they've got into all the details, and after scrutinizing all the facts, all the information, all the details, they've come to a conclusion that yes, there was no issues on the related party transaction or other transactions, including the shareholding of the Adani Group, which is illegal or which is something which meets more than the eye. So it's a very, very positive development, and the foreign investors surely will have more confidence not only in the Adani Group but in the overall Indian large companies. Corporates.
Absolutely. Well put, Mr. Asher. I appreciate you joining in, and thank you so much, Mr. Ranina, as well, for joining in and taking us through your quick take on Adani Group getting a clean sheet. Let's go across to Deepan. Deepan, from a stock market perspective, how do you view this? Adani Group stocks clearly will start off quite buoyant this morning. Among the names, what's on your radar? We have a Morgan Stanley note as well. They have initiated coverage on Adani Power, and they are sounding quite optimistic about the prospects. What would be the pick of the pack?
Good morning, and thank you for having me on your show. I think certainly lifts a cloud on the Adani Group companies, and some of the FIIs, especially foreign investors or even some of the more conservative domestic institutional investors who may have been holding on to maybe buying Adani shares because of this ongoing investigation, because of internal reasons. Now, I think that opens the pathway for them to look at Adani in more positive light. So certainly very good news from that point of view. And the management also has been trying to engage and get more and more institutional investors into the company. That have been the issues with the ownership pattern. And this certainly will help in that particular endeavor. Having said that, I think first the disclosure we and our clients are invested. I think of all the companies, they're still trading at a lot of expensive valuation, but I feel that from a risk return profile and reasonableness of valuation, Adani Ports and SEZ certainly is the most attractive, according to us, amongst the Adani Group companies. And it's now become a giant in the entire port and logistics industry. And as and when India's trade grows, I think they'll have a bigger part of that particular, entire journey. And also, I think a lot of the new ports which they've acquired, gradually those will start contributing more and more. And it's a great operating leverage business as well. So I think the assets are on the ground. It's a matter of the returns coming through.
Adani Enterprises, though, is much below the pre-Hindenburg price. If you pull up a 5-year chart, around January of 2023, which is when the Hindenburg allocations came to light, the stock was around 3,700, 3,800. And now today, the current market price is about 2,400. So that stock has not recovered, while many others, like Adani Ports, for instance, has zoomed past. Pre-Hindenburg, 2.5 years back, the stock was at 700, 800, and now I think it's close to about 1,400. So the others have done well, but I think Adani Enterprises, Adani Green, etc., are still not quite recovered to those levels. Deepan, what about Cohance? That was a stock yesterday. Now, two sets of news, one that formed 483, the 6 observations. But secondly, yesterday the stock was under pressure because of the large supply which took place. But the fact that it got upsized shows the kind of interest in Cohance. I mean, how would you weigh on this particular stock?
See, Rima, first of all, good morning. There's a lot of interest in CDMO companies, and there are certain secular trends and very strong tailwinds helping the industry. And it's one of the clear beneficiaries of China Plus One, and I believe there are certain regulations also in US which kind of benefit Indian CDMO companies. And Cohance and Dishman, Blue Jet, and also there is OneSource. I think these are the companies which are in the investors' focus. Cohance has been a great performer. Again, disclosure, we are invested in the company. But its performance has been erratic, and last few quarters have been a bit disappointing. But I think the future prospects are great because the number of requests for proposals which they are getting, inquiries which they are getting, management has said it has gone up significantly, almost doubled in the past few months or so. So I think corrections, as when they come in a company like Cohance, I would view them as positive. And I do feel that it's one of the solid players, strong players within the entire CDMO ecosystem with the merger of Cohance and Suven. So very positive on the stock. But these things are part and parcel of the risk factor, these 483 observations. So I think that's one thing that investors have to look out for, and it's definitely a risk factor. But I wouldn't go by just the valuations. I do feel the prospects are great, and I would look at such a company more positively.
Talking about valuations, the question is Urban Company, 25,000 crore in terms of valuation. The top line is, what, 1,100, 1,200 crore rupees last year. It's just broken even. I mean, what kind of valuations do you play? It's had a solid debut. It followed up with some buying yesterday, up 2%. But at what point, if someone wants to get into Urban Company, what would be an attractive level?
Reema, that's a tough one to answer. But first of all, we have also bought on listing as a measure of disclosure.
Okay.
But I think that, the approach that we are taking is to, just buy a small quantity and just wait and watch and maybe average if the stock price goes lower. See, Urban Company has the benefit of all the great work done by some of the other platform companies, the likes of, say, Paytm or even Swiggy or Zomato. And these companies also got listed with a lot of fanfare. Then there was a correction. We had losses for a few quarters. And now all of these stock prices have zoomed up really well. And within India, I think these entire platform-based businesses are the new growth avenues for investors. And losses notwithstanding, I think investors are taking a long-term horizon on such companies and buying into them. And these companies certainly have great opportunity to grow many-fold from here. So in same light also, I think Urban Company should do well. It's a very strong, aggressive management. Excellent business model per se. No parallel as such. I mean, so no competition per se. And I think they know the business very well. So it's like a leap of faith. You buy it and hold it on for a long period of time, and I think it'll give great returns.
When we spoke to the management, they said last year the total addressable market for home services in India was $59 billion, and they expect that number to rise to $97 billion by 2030. And of that, $10 billion is that InstaHelp, the new segment that they're targeting. And even on Native, it's a very calibrated approach to get into hardware manufacturing. As of now, there are only 2 products, smart locks and water purifiers. As of now, the company doesn't plan to launch more products. They're going to wait, scale this up, get the profitability. So it's a very conscious, calibrated approach. The street seems to like it. Dipan, I request you to just stay on. We will slip into a break on that note. On the other side, we'll also put the spotlight on the big movers of Dalal Street yesterday.
Welcome back. You're tuned in to Bazaar Morning Call. Well, it's that time of the show when Horribles joins us to tell us about all the big movers in trade yesterday, the ones with heavy volumes and possibly delivery-based action as well. Hormuz, take it away.
Good morning, Nigel. And the broader markets have been doing well along with the benchmark indices, but yesterday's session was somewhere where the movers were marked by extremely strong volumes. And you take a look at IRM Energy, was up 20% the day before, added on to gains yesterday, is up now almost 33% in the last two trading sessions. And it fell around the last 10 minutes of the trading session. It slipped slightly from the highs of the day. But take a look at the volumes here. They were the highest on record, of course. We had 1.9 crore shares traded on the stock compared to a 20-day average, which is just under 2 lakh shares. And for delivery as well, over 20 lakh shares were marked for delivery, and the 20-day average here is only 50,000. So it shows the kind of volumes with which the stock traded in yesterday's trading session. And and despite this outperformance over the last 2 days, the stock still remains below its IPO price of 505. A new listing, Denta Water and Infra, listed only this year, and a fourth best listing day gains. Gains since listing was up around 11.5% yesterday. In the last 4 trading sessions, the stock has moved up 20%. We had close to 1 crore shares traded yesterday. Of course, again, the most since listing. 20-day average here is only 13 lakh shares. And even for delivery, only 10 lakh shares marked for delivery compared to 1 crore shares that were traded. But even then, the quantity is significantly higher than the 20-day average of just under 3 lakh shares. The stock has done well from its IPO price, almost 60% higher from those levels. Now, Newgen Software was higher by around 6 to 7% in early trading yesterday. It fell off the highs of the day. But the interesting bit is the volumes. Again, yesterday was the first instance in the month of September where more than 10 lakh shares were traded in a day. We had close to 70 lakh shares being traded. The 20-day average is close to 8.5 lakh. And even for the delivery front, only 7 lakh shares were marked for delivery compared to a 20-day average of just over a lakh. And on the levels, is closed above its 50-day moving average of around 912. And lastly, Shalimar Paints, we spoke about this on closing bell yesterday. There's the biggest single-day gain since December of 23. Volumes the highest since January of 24. 35 lakh shares were traded yesterday. The 20-day average here is only 1.1 lakh shares. Even for the delivery front, 7.5 lakh shares marked for delivery. The 20-day average here is only 60,000 shares. And closed above its 50 DMA, the next on to watch on the upside is the 100-day moving average, which comes up to around 90 rupees. So broader market movers on very, very strong volumes.
Got it. Always a nice, neat list, Hormuz. Thanks a lot for that. But Sudarshan's back with more data. He wants to tell us about some major insider trading action that's been reported on the exchanges. Sir, tell us more.
See, some of the interesting insider trades have been reported to exchanges yesterday, and first on the list is Zee Entertainment, where Puneet Goenka's wife and son have bought additional shares on September 17. So his wife, Shreyasi Goenka, has bought more than 41,000 shares, and his son, Udyan Goenka, has bought nearly 42,000 shares on September 17. Second stock in the focus is Sonata Software, where its Employee Welfare Trust has bought more than 47,000 shares from September 15 to 17, and now the trust stake has increased to 1.07%. For Selzer Electronics, promoter has sold more than 12,600 shares, and that was done from September 15 to 17. For Choice International, promoter has gone ahead and bought almost 1 lakh shares on September 16. And last on the list is Usha Martin, where promoter has sold more than 2 lakh shares, and that was done on September 17.
Thank you very much for that. Get into a break. On the other side, pre-opening, and we'll also be joined by Sudeep Shah and Mitesh Thakkar for some technical trading ideas. Stay tuned. Welcome back. Awaiting the pre-opening rates, the GIFT Nifty is suggesting a mild downtick, but we've had 2-3 good days on the trot with the Nifty Bank scaling almost to levels of 55,700 plus. Mitesh Thakkar, Sudeep Shah are now joining us on the show. Gentlemen, good morning. Mitesh, let me start with you. If there is a mild gap down, very mild, what would the approach to trade be?
Good morning. So, we've kind of advocated that we might actually head towards 25,500, 550 zones. In the best case scenario, even 25,650, which was where the Nifty had peaked out in June. So I think the uptrend is intact. Now the question is, if we get a gap down, when we should buy? I think a 30-40 point gap down might not interest me, but in case we get an entry around 25,340, 330, which is the level which I'm looking at as the immediate support area. I think maybe 20 points higher than that. I think that will be an entry point. And the idea is that then keep a stop below 25,260 and maintain and hold the Nifty for targets of around 25,500 to begin with, and in a good case scenario, even 25,650.
Got it. Okay, all right. Got that. Good morning, gentlemen. Good to have you all on the show. Sudeep, good to see you. Friday morning. Tell us, what's the trade on the Nifty? Buy the dips on a day-to-day basis has been working out. Now, today we're expecting a bit of a soft start, 50, 60 points down. I think the last time I checked on the GIFT Nifty. Do you think you look to buy into the dip?
Absolutely. Good morning, Nigel. Nigel, see, what we feel is now let the pre-opening get settled, but I feel that it'll get settled somewhere around 25,300, 330 zone. So with supports closer to 25,200, 25,230, I guess this dip could be a good buying opportunity, and playing with the trend will actually help us. So I feel keep a stop near 25,200. On the upside, the first levels in the recovery could be 25,450 followed by 25,600. So dips towards 25,280, 25,300, that can be used to add. And I feel buy on dips should keep working from here on also.
Okay, corrective decline serves as an opportunity for accumulation to buy. That's the advice coming. Let's talk about stocks then. Mitesh, what do you have on your list?
I have a mix of buys and sells, but more stocks on the buying side. The first one is Biocon. Very good pricing action took place in most of the pharma names, and Biocon also had a strong price day. It just needs to get past this 370, 371 level. Yesterday, I think the high was around that. So buy about 371, keep a stop at 364. We will look for a first target of 385 to about 388. Then a buy on KFinTech with a stop at about 1124. Here I would recommend a target of around 1190 in the short term. Also have a buy on Hindustan Zinc. It gave a good breakout a couple of days back, has given a 2-3 day kind of a pullback, gives you a fresh risk reward, good risk reward entry point. So buy around 452 to 450 with a stop at 444. Look for 465 and then 472 as the two target areas. One sell call, that's Asian Paints. Keep a stop about 2501. Look for targets of around 2435.
Okay, got it. All right, Sudeep, what about your picks?
Nigel, two buys, one from the pharma space, one from the auto space. To start with, from the pharma space, the stock is Glenmark Pharma, 2110 is the closing of yesterday. We feel that there was a decisive move that had happened in the last week. Post that, then there was some consolidation. The stock retested its supports closer to 2030 zone and once again rebounded back yesterday with the pharma rally. So I feel this is one of the stronger stocks out of the pharma pack, and this can move to 2230, 2250 in the coming few weeks. Can be bought with a stop loss at 2050 on the downside. The second from the auto stock list, which has given a breakout yesterday, is Ashok Leyland. Now here also there was a decent breakout above 135, 136 levels. The stock had rallied last week but was not able to close above this 136 mark, 137 mark decisively. Yesterday we saw that, and that was backed by volumes and a rise in open interest. So I feel from here on the stock could do 145, 147 on the upside in the short term, and this can be bought with a stop loss at 133 on the downside.
Got that. Thank you, gentlemen, for joining in. Let's take the discussion forward now on autos. Now, yesterday, Maruti Suzuki announced sizable price reductions across its portfolio. So, entry-level models like Alto, Espresso, Celerio have seen price cuts ranging from 13 to 22%, while even some of the larger models like Brezza, Grand Vitara, the cut in prices is a little more moderate. But as you can see, for Brezza, it stands at close to about 12%. Now, the big question is, will these lower prices on account of this GST pass-through actually stimulate buyers? Maruti Suzuki has been talking about how entry-level mass consumption has been hit. Jay Kale, Executive Vice President Research at Elara Capital, is now joining us on the show. Jay, morning. Thank you very much for joining in. First, give us your comment on the price cuts announced by Maruti, and how does it compare with the other passenger vehicles who've also announced a cut in prices?
Yeah, hi, good morning. So yes, Maruti has cut its prices, passed on the GST benefit, and over and above that also cut its prices, especially for the entry-level models. We have seen entry-level models being under pressure for quite some time now, also because of the affordability issue. So I think this is the right time for the management to kind of spur demand over there and get the first-time buyers back into the market. And what better way to do it during the festive season? So I think, yes, you will have some bit of spurt on the first-time buyers because of this price cut. And that will also lead to better utilization levels for the company, which could cushion any kind of margin impact because of these price cuts that we've seen.
So, Jay, you said that the price cuts are a combination of GST pass-through plus additional discounts. Do we know the extent of the additional discounts that Maruti Suzuki has priced now, and what will be the impact on margins? Will there be any impact, or do you think higher volumes can offset that?
So, broadly, they've cut prices in the range of, on the entry level around 50 to 18% odd types. Because we have to see the base variant versus base variant price cuts and not up to the price cut that they've given in the press release, because that seems to be a little higher. So, around 17-18% broadly, as per our calculations, is the price cut of the entry level like-to-like models. And normally, you would have expected around 8 to 10% odd price cut because of the GST benefit. Of course, there will be some tweaks in the discounts as well. Some reduction here or there is what our expectation is. Net, we don't see much of an impact on the margins because of this price cut, as it will be a kind of offset because of better utilization levels if the volumes bounce back.
What were your volume estimates, and have you revised it higher?
Yeah, so we've recently revised our estimates for the entire auto sector in the range of, increased our estimates by around 5 to 15% for most of the OEMs. And of course, the incremental delta is coming mainly because of passenger vehicles. We see that incremental delta in growth to be higher for passenger vehicles, followed by two-wheelers.
Okay, and can you, this 5 to 15% increase in volumes for passenger vehicles, can you break that down in terms of which of the companies have seen the maximum increase in volumes? And what about Maruti in particular, especially post these cuts?
No, so the 5 to 15% that I mentioned was the EPS upgrades. The volume upgrades have been in the range of 2 to 4%, more for the passenger vehicle industry than for the two-wheeler industry. And also the EPS upgrade is higher also because we expect a lot of upgrades to happen within the passenger vehicle industry as well. So if someone was going to expected to go for a mid variant, they'll go for a top end variant. So the mix is expected to improve for the industry, which will also lead to higher ASPs as well as margins. And that's why the EPS upgrades are higher than the volume upgrades.
Mm. Jay, I just want to ask you about another stock, Hyundai. If you have a view out there, the reason I ask you this is because around 12 months or so ago, the stock listed. No one was interested. There were various red flags with regard to the big dividend payout to the promoter, the risk of royalty, and various other red flags were pointed out. The stock then came down to, I think, 1,500 rupees odd, but it's making a fresh 52-week high. At current juncture, at around 2,700 rupees, do you think most of the good news is in the price, if you have a view on the stock?
So I think, we don't have it under official coverages yet, but point is that Hyundai is also a beneficiary of the passenger vehicle industry bounce back that we are seeing. It has a slew of launches, its capacity is coming in. So incrementally, things are looking good for Hyundai in terms of both model launch cycle as well as capacity increase. and that is kind of timed well with the GST cut, so to say. So, yeah, things are looking good, but I wouldn't have a target price to as of now to give you.
What would be your top pick in passenger vehicles and then for two-wheelers?
Yeah, so the top picks are Mahindra, Maruti, and TVS. The preference after the GST cut shifts a little more towards the passenger vehicle industry over two-wheelers, but TVS remains our top picks in two-wheelers.
Okay, and between M&M and Maruti, if you had to pick one?
Well, I think I'd pick both, given that one is a beneficiary. There are substantial volume upgrades likely to be seen in Maruti, and mixed benefit will be seen in Mahindra, where they had a kind of already expectation of 15 to 20% volume growth for them was already built into the estimates.
This Maruti also, there was this launch, right, a couple of days back of Victoris. And I think they've announced a price of about 10 to 17, 18 lakh for the petrol variant. I mean, is that going to be a game changer? Are you expecting this to incrementally add considerably to their volumes? And will it in any way, undermine Grand Vitara?
Yes, I think whenever such kind of a model is launched, there is a natural cannibalization, and that is expected. But of course, Victoris is going to be sold in Arena channel, Grand Vitara, and the Nexa channel. So to that extent, there will be some bifurcation. But we've seen Victoris features. I think the ADAS level 2. Maruti has gone all hog in terms of giving connected features for this vehicle. They've given the CNG a new design and architecture for the CNG kit as well. So I think pretty good volumes expected from Victoris, and in the mid-size SUV segment, which has led the growth for a few years now. I think this was long pending. Also, we're expecting better margins for Victoris for Maruti. So cannibalization will happen, but net it will improve their mid-size SUV market share in RP.
Appreciate you joining, and Jay, wishing you a good Friday ahead, and we look forward to chatting up with you as things evolve on ground. A lot of excitement post this GST rationalization. Let's see how demand picks up post that.
Right now, all the excitement is, I think, in the Adani Group stocks.
Yeah.
Pull up that pre-opening. Adani Power, 7%. Adani Green, 5%. In the frontline pack, it's Adani Enterprises and Ports racing away with a 3-4% gain. So this clean sheet given by by SEBI to the Adani Group has really, lifted the spirits of these stocks.
Since you spoke about Adani, I think let's go across to Sud. He's waiting by to tell us about the Adani Power. There's an initiating coverage out there. Tell us more, Sud.
That's true. So besides the news, Adani Power is also in the focus on the back of positive brokerage notes. So Morgan Stanley has initiated coverage with an overweight call, and target has given is of rupees 818 per share. It says company is a good illustration of turnaround in India's corporate history, and also it has resolved most regulatory issues and made multiple value accretive acquisitions, and it sees strong earnings growth, and that will be driven by timely completion of projects and more PPA wins. So it forecast capacity increased to 2 times and EBITDA increased to 3 times by FY33. So keep an eye on not only Adani Power, but most the Adani Group names on the back of also SEBI's order.
Yeah, it's coming as a huge relief, and you can see that SEBI finding no merit in Hindenburg's allegations of stock manipulation or even certain governance lapses. Let's quickly do a quick recap of the top stocks. Well, of course, all the Adani Group stocks will be on our radar after the SEBI clean sheet, but there are new orders for Ramki Infra and Texmaco Rail, so that could keep the stocks in focus. There are other stocks in news like JSW Energy, the clarification coming in from Indian Hotels about the Pierre Hotel in New York, John Cockerell, and the other stocks which are in focus today in news. One MobiKwik, Vari Energy. And not to forget Cohance, a stock which slipped close to about 5-6% yesterday. We should keep that and see the kind of performance today. And finally, Unichem Laboratories.
Okay, all right. Well, let's get Mitesh back on the show. Mitesh, tell us what's your 9-10 call?
I'll go with the buy on Biocon. As I said, I think the stock needs to get past this levels of 371. And once that happens and stays above that, I think good chance that the stock can head towards 385, 390.
Okay, all right, Mitesh, I wanted your view on Reliance Industries. The markets have seen a good bounce. Reliance Industries has managed to take out that 20 DMA. It's hovering in that vicinity, I think, at around 1,430 is where that 50 and 100 DMA is at. if this one gets its act together and moves closer to its 52-week high, that'll be the additional booster shot that we need. What's your take?
Nigel, one slightly positive here. One, the stock, had an intermediate high around 1425, 1430 in August, and it needs to clear that. Once it does that, 1460, which was the gap area, should be visited. Above that, I think the all-time highs or the recent 52-week highs can be tested. But for the timing, 1430 and then 1460 are two levels to watch.
Okay. Mitesh, just, some more stocks. You're seeing some buying in Maruti. We were just discussing with Jay Kale about the extent of price cuts, and it's quite steep, especially for the entry level, going up to 20-22% for some of the variants. Technically, how is Maruti looking?
Extremely overbought. I think this stock is looking strong. It's at all-time highs, but in the short term, on the hourly charts, 2-hourly charts, extremely overbought because it's rallied from about 12,200 to about 15,800 plus. So I think, I would wait for some consolidation or at least a good pullback if I were to buy a fresh. But if I'm holding, just trail your stop losses to about 15,050 or just 15,000, and then let's see where it goes. Difficult to give targets because the stock is in new highs. But for the timing, the medium-term charts are very good, but the short-term charts are extremely overbought.
Well, looks like, from 15,800 on Maruti, 16,000 could be hit. And for all the concern about slowdown in entry level, the stock is up 47% year to date at a fresh record. There goes the opening bell, and it's a flat opening. The Nifty opens down 5 points at 25,417. So holding on to 25,400 at open. It's a very mild downtick of 12 points, 10 points on the Nifty. The Sensex opens lower by close to about 60, 70 odd points. But considering we've had a 1.5% rally in the first 4 days of the trading week, this consolidation and flat opening is par for the course. The advanced decline ratio is firmly in favor of the gaining side. So we pull up the Nifty heat map. It's quite mixed. It's on an even keel now. Equal number of stocks up, equal number of stocks down. But predominantly on the way up, as you can see, it's the Adani Group stocks. Adani Enterprises, Adani Ports, the two which are a part of the Nifty, are racing away. Adani Enterprises up 4 1/4 at 2,500. And as we were earlier pointing out, pre-Hindenburg, that stock used to trade at levels of 3,700, 3,800. So that is one of the Adani Group stocks which hasn't recovered to the pre-Hindenburg levels before all the allegations and investor concerns rose. So that stock is moving up, but you can see bigger, more powerful moves in the rest of the pack too.
Well, that's right. The Adani Group stocks clearly are doing very, very well. Inox Green is another one that's coming on very, very high volumes. I think that one should come up for you on the screen. Massive volumes on that particular name. Let's get that one up. It's up close to around 5%. So big move out there. IRM Energy, Sudarshan had highlighted that stock, about it moving on high volumes yesterday. Today, in fact, that stock has started off on the back foot. It's down close to around 5.5%. Texmaco Rail, that one I think has opened up in the green. They have bagged an order worth around 87 crore rupees from Ultratech for wagons and brake vans. So that's why that stock is up and about. The other one that's under some pressure is Indian Hotels, because they've clarified on reports with regard to the hotel that they have in New York. They're saying that they have only leasehold rights and they don't own it. There was some speculation yesterday that they could sell it for a couple of $1 billion. But if it's leased, then they can't sell it. So that stock as well comes on your radar. What else? Ola Electric. That's opened up a little bit softer. It's down close to around 2% or thereabouts. But the Adani Group stocks, they are catching your attention. Big moves is what we're seeing on all of those names. Up and about in today's trading session. So the broader markets are outperforming today. Headline index is taking a bit of a pause. But otherwise, par for the course, one would say. I think Hind Rectifiers, they have gone ahead and they've done some small shopping overseas. If I saw that correctly, they've gone ahead and they bought a company in France, which was in liquidation. Volume's not very, very high. Only 15,000 shares have got traded. But that one as well opening up with a gain of close to around 4% or thereabouts. Well, what else, Rima? Anything else you've spotted?
Well, let's just quickly run through the large cap action then. Adani Enterprises right on top, 5% up, followed by Adani Ports. That's up close to about 2.5%. The picture for autos today is mixed. On the way up, you've got Hero MotoCorp, Maruti Suzuki and Eicher Motors. So these three stocks seeing some buying. Gains are about 0.5 to 1%. But on the way down, M&M is seeing profit booking. It's been one of the biggest winners. well loved by a lot of investors and funds. And Bajaj Auto is the other stock which is mildly under pressure today. So the picture across autos is mixed, but broadly there is no big stock which is moving up other than the Adani Group. Shriram Finance, HDFC Life, Geo Financial, IndusInd Bank, HUL, NTPC. These are some of the large cap stocks which are opening up in the green on the way down. Eternal is seeing some profit booking. ICICI Bank is subdued. In fact, ICICI Bank is putting pressure on the overall Nifty Bank with a cut of nearly about 1%. That's perhaps the reason why the Nifty Bank is down 100 odd points. HDFC Bank is down about 0.25%. Reliance Industries too is not flat, but with a negative bias. All in all, a very, very quiet day. Let's see whether we manage a positive close by the end. So far this week, it's been a rally of 1.5%. And if it continues like this, we will be on track to close higher for the third consecutive week. Dheeraj Agarwal, Managing Director at Ambit Investment Managers, is now joining in. Dheeraj, morning. Thank you very much for joining in. The consensus seems to be that after a very long stretch of underperformance vis-a-vis emerging markets, no returns for large caps and many mid caps, now is the time. We've got all the raw materials in place, and markets will scale up from here on, move on. The FIs will eventually turn buyers once we get that US-India trade deal. Where do you stand on the market construct from here on for the next 12 months? Are you bullish?
I think next few months I am positively biased. Next 12 months I will reserve my comment at this point of time. And I see a challenge between the macros and the micros at this point. So as you rightly said, macros are still looking good. GDP growth number was outstanding. There is a good possibility that a trade deal will get signed with the US. The GST cuts which the government did should result in some amount of demand revival going into the festival season. But how strong it is, and remember, even after the trade deal with the US, the tariffs will be significantly higher than what it was 4 months ago or 5 months ago. So how do we battle that? How do we manage to grow our exports once again, despite that, into next year? Will determine whether our earnings growth picks up for next financial year or not. So last 4 quarters have been disappointing from earnings growth point of view. Eventually, market will want to see all these macros translate into micro, which is the earnings growth. So jury is still out on that one. So next few months, I'm positive. 12 months, I'm still a little cautious.
Okay, all right. Hi, Dheeraj. Good to see you in. But, earnings in Q2 as well will look a little bit softish, right? You have this adaptation to GST 2.0. So then earnings, we live on hope that Q3 and Q4 will be much better. Is there a possibility earnings actually could disappoint a little bit in comparison to expectations? The scale down expectations is what I'm talking about.
So the current quarter's weak numbers, I think, may not impact the market too much negatively, because I think it's a known fact that post the announcement of GST on August 15th and the actual implementation of GST cut in the third week of September, for 2 or 3 weeks, the consumer demand and consumer sales were likely to be muted, right? Because everybody would have waited for the GST cut to filter into the prices before buying the product. So a little bit of weak earnings this quarter, I think, should not matter much. The acid test will be December quarter numbers. December quarter numbers has to show meaningful improvement for the rally to sustain into next year.
Okay, all right. Dheeraj, the next question I have with you is with regard to this new listing, Urban Company. Clearly, there's a big runway ahead. Most of us use their services, and shareholders will be very happy looking at the listing gains. But if you look at it on a forward multiple as well, it's trading at 100 times. What's your view on these names? In the past, Zomato, you were bang on, or Eternal as it's called. Urban Company, do you have a view, or any other stocks in this new age theme?
No, so this particular company, I don't have a view. But I think the high valuations will have to be seen in the context of, number one, what is the growth? Second, what is the runway of growth potential? So, you gave the example of Zomato. Zomato, our conviction was that the longevity of growth, or the runway of growth, is fairly elongated. And unlike the fears which exist in some quarters of the market, that whole segment has almost settled down to be a duopoly right now. And all new competition is finding it difficult to get their foothold in the market, right? So a duopoly with a long runway of growth visibility, you can justify high multiples or, I mean, in case of low EPS companies, obnoxiously high multiples. But for the others, you'll have to see what is the growth and what is the longevity of growth. Otherwise, it could be a trap, as a general comment.
So for Urban Company, is it the longevity of growth that you're not convinced about? Is it the opportunity? Because unlike an Eternal, this has a monopoly in the business that they operate in.
No, as I said, I haven't studied the company.
Okay,
so
got that. So what else are you extremely convinced or bullish about? What are the themes, the top 2-3 themes?
So, you know, the unique characteristic of the current market is it's actually themeless. So within every sector, you can find companies which are beating the sector's growth and the market growth, and they're doing well. And within every sector, you can find companies which are laggards, and they're actually struggling. So, and that's what is making investors struggle, that what is the theme? That question everybody is asking, and the answer is there is no theme. It's a true blue bottom-up market. The last time I remember, I mean, we have seen bottom-up markets many times in the past, but the most prolonged one was 94 to 98, 99, 5 years. That time, Nifty was not so popular, so I remember the Sensex numbers. 5 years, Sensex oscillated between 2,500 at the low and 4,600 at the high. And it was a true blue stock pickers market. I mean, no theme actually worked. So I'm looking at a very similar environment for the next few years.
So that means a 5-year period of sideways movement, no return on the index? Similar to, we've done 1 year so far.
I think my view is next 3 to 4 years, mid-single digit returns at best. But individual stocks can outshine if one picks the companies correctly.
With disclosure, can you talk about any of these stocks? Or give us a hint?
No, I mean, I can give you examples. So I mean, I generally don't recommend stocks on media, but I can give you examples. So let's say, let's say within IT services space, I mean, there are few companies which are still growing earnings at near 20% per annum, whereas most of the mega caps are growing earnings only at 5% per annum now. So the 20% per annum growth companies like Coforge, Persistent, Emphasis, and one has to take a look at the valuations as well, can continue to do significantly better than the companies which are struggling for earnings. And similar trend in the banking or the NBFC space, there are still companies delivering in the NBFC space 25, 27% growth without taking too much of incremental risk on the balance sheet. And they can outshine as compared to the general sector growth, which has now come down to below 10. So I think every sector will have a pyramid like that, and the companies in the growth, like a pyramid, the companies in the growth portion, the numbers are few, which is the characteristic of a sideways market. So very, very careful stock picking is my mantra and my advice.
Okay, all right, Dheeraj, since you're saying the market is not very themeless to a certain extent, you're not very optimistic about double-digit returns, just in the near term. If you're allocating fresh money, between various asset classes, how would you do that? I mean, what would be the broad breakup?
So, because it's still possible to buy bottom-up ideas in the market at this point of time, I wouldn't be significantly underweight equities. I'm still, as an asset class, I'm still very, very positive on gold from a 3-5 year point of view. Everything which is happening globally, whether it is the trade wars, whether it is geopolitics, whether it is bilateral businesses between the multiple countries, which used to happen, let's say, in the 70s and 80s, and then it started becoming more of a unilateral US dollar-driven system. These are tectonic shifts, and these tectonic shifts will continue to benefit gold as an asset class. So apart from reasonably high weight to equities, I would say some allocation to gold in individual investors' portfolio should be there, whether it is 15% or 20% or 10%. Depends a little bit upon individual risk appetites.
Mm-hmm. Okay, all right. What about, on the domestic front, there are various themes that are potential beneficiaries of this GST rationalization. There's autos out there, cement to a certain extent as well, because they hiked prices a little bit. Now they'll pull back prices, but maybe not to the extent that they, had hiked it. So there could be some kind of gain on profitability front. What would be, or the consumption pack? How would you approach it? The GST 2.0 place.
So the most obvious gainer for such a sharp tax cut are usually consumer discretionary, so which includes automobiles, right? Because in small ticket items, let's say soaps and detergents and toothpastes, I don't think that a little bit of price movement here and there will make that much of an impact on demand. But for, let's say, cars and two-wheelers, television and refrigerators, it does make a meaningful impact. And the GST rationalization has been large. It's not a tinkering, it's actually a significant move down. And that should have some positive impact on consumer discretionary demand, including the automobiles. So that's the space which I think is a clear gainer. Cement benefits, but it's end of the day still a commodity, and most of the gains will eventually get completely priced down. And I don't know if a little bit of a price cut would actually spur, I mean, the demand elasticity to price is so high that it'll actually spur volume growth. In consumer durables and automobiles, I think it should spur a volume growth.
Okay, and within equities, if you had to allocate money, since you're saying that the headline may not move too much, between the mid and the small caps, what would your allocation strategy be? There was a time at the start of this year where there's a lot of fear that came in, and we have had a set of challenges on earnings, on geopolitical issues as well, slowing down in terms of economy. If you're allocating fresh money to equities, then what would you break it up into if you put it into three buckets?
So I call it N-1. You can call it large mid caps or small large caps or smaller large caps if you want. I see earnings growth struggle in the top 10, 15 names in the market. The sweet spot is the next 20 or 30. So not exactly Nifty next 50, but excluding the top 10, 12, 15 names within the Nifty, and maybe some of the top names of Nifty next 50 also. So large mid caps and slightly smaller mega caps, because most mega caps I see will find it very difficult to grow earnings in double digits for the next year or two. So that I think is a sweet spot at this point of time, not really small.
Dheeraj, any view on the solar theme in India? I think today we've got an IPO which is opening up, Satwik Green Energy, small one. They're looking to raise close to about 900 crore rupees. Market cap will be about 5,500, 6,000. Not this particular, but broadly, what is the call on the solar theme in India? Because we're seeing a lot of mid-caps, small caps emerge from this sector and attracting huge investment.
So a disclaimer right up front, Satwik Solar is an ambit IPO, so obviously I'll be bullish on solar.
Okay, but so you're bullish on the entire theme?
Yeah, I think renewable energy as a theme is here to stay and here to grow. So after many decades, many years, the energy demand or the power demand is on a structural up move, right? Because of data centers, AI consuming a ton of energy. But it's very clear that globally we want more and more renewables as compared to fossil fuel energy. Europe is already at 40%. We want to be at 30-40%. So it's one of those structural growth themes which I think will keep growing for the next 20 or 30 years.
Okay, all right. Good to have you on the show, Dheeraj. Thanks a lot for joining in and filling us in with your take on the markets. Wishing you a good Friday ahead, and we look forward to chatting up with you rather soon. A lot of stocks, though, that are buzzing around from the broader market. So let's get straight to that. Vivek joins us to give us a recap of the news on Ramki Infra. Vivek, take it away.
Well, that's right. Ramki Infra, quite a large order win for the company that has come about. The company has received an order win worth over 2,080 crore. Now, this is from the Hyderabad Metropolitan Water Supply as well as Sewerage Board. The construction period for this particular order is at close to 2 years. The operation and maintenance period that the company will enjoy is close to 10 years. So the total quantum over 2,080 crore. Remember, the order book at the end of Q1 FY26 was at 7,650 crore, indicating that this is a pretty significant chunk of the total order book that the company has received.
Okay, that's Ramki Infra moving up. Vivek, what about JSW Energy?
Well, a quick recap as far as the developments concerning JSW Energy are concerned. Two separate news flow. The company has entered into an agreement with Statkraft IH Holdings that has completely exited their India power plants. The company will acquire 100% equity stake of Tidong Power Generation. Remember, the company has close to 150 megawatt under construction hydropower project. FY25 revenues that the company had was close to 39 crore. Transaction is for an enterprise value of 1,728 crore, indicating that JSW's total portfolio has now exceeded 30.5 gigawatt. Now, also interestingly, the company is acquiring a small business of GE Power India. This is the manufacturing and supply of power boilers. Now, this particular business, it's via a share swap agreement. JSW Energy will issue 10 shares for every 139 shares that GE Power shareholders actually have. So the demerged entity financials constitute close to 5% of the total revenues as far as GE Power is concerned. The rationale mainly is for backward integration as far as JSW Energy is concerned.
Thanks a lot, Vivek, for joining in and filling us in with that take on both Ramki as well as JSW Energy. By the way, don't lose sight of the markets. We need to stop for a bit of a breather, but I think, the markets have now pulled back a little bit. 100 points, par for the course. What's struggling, though, today? One of those indices that are still underperformers for the year is the IT index. In the last 1 month or so, it managed to outperform, but now it's coming for some profit taking. So the tech index is now down close to 0.7%. And Infosys, the big boy in there, that's actually slid to the low point of the day. So I think that's putting some pressure on the index. Let's get to our next management then. We have Mr. Ranjit Rath, the Chairman and Managing Director at Oil India and Chairman at Numaligarh Refinery, who joins us on the show. Hi, sir. Good morning. Thanks a lot for joining in. We've got a lot of questions for you, coming to you in just a bit. For the time being, just highlighting the three broad points we're looking at. FY26 volume growth outlook. That's what we want to know. The GST hike impact on the exploration services, the impact out there. And finally, the impact of the rupee volatility as well is something that we're looking to understand. Well, Mr. Rath, thanks a lot for joining in. Let's get to the first point. When is the Numaligarh refinery expansion expected to come through? I think it was expected in the next few months. You could give us an update out there. And how will it aid GRMs as well as the overall earnings of the company?
Okay. First of all, thank you very much for having me. Good morning to you and all your viewers. We had an excellent AGM yesterday, followed by a press meet. Very happy to be here. Number one, the year just passed by, FY25. We had a landmark year with highest ever production of crude oil and natural gas, that's 6.71 million metric ton oil and oil equivalent. As far as FY26 is concerned, we are looking at about 7.5 million metric ton of oil and oil equivalent. We are looking at a much higher number of drilling. We are looking at a much higher number of exploration acreage and seismic data coverage. As far as Numaligarh is concerned, I must give you an assurance that the expansion is on track. As we speak, the primary units, that is the CDU and the VDU of 6 million metric ton crude throughput, we will start commissioning by December 2025. And the DHT, that is diesel hydrotreating unit, will also be ready, but we need to have the sulfur unit ready first, because I would like to explain that these are all batch basis commissioning and always linked. Therefore, we would start doing the remaining units commissioning by 31st March. By FY 2027, we would be looking at about 40 to 50% capacity utilization and some time of to 28 for complete stabilization of 9 million metric ton. The second question that you had asked, before that, I would also like to say...
Just one more point, sir. So on the Numaligarh refinery, what will be the initial capacity utilization levels, if you could help us out? And when do you hit peak capacity? So we clear that out of the way.
Okay. So currently, the capacity utilization of a 3 million throughput is 100% plus. Last year also, it was 100% plus. And going forward, we are looking at that number also. In addition to that, beyond the Numaligarh refinery expansion, Honorable Prime Minister has already laid the foundation stone of a polypropylene unit. That's another 7,000 crore investment. The basic design is in place, the detailed design is in place, the licensor selection is in place. So we are looking at 28, 29 to complete that as well. That will give us 4 as the index number, they say, petrochemical intensity index. So that's the Numaligarh story.
Okay, got it. All right. So I just want to clear that the longer term targets on both oil as well as on gas, I think you had mentioned around 4 MMT on oil as well as 5 BCM of gas. By when do you hit these levels? If you could break it up for us, sir, between both of them, 26, 27, 28.
So it's like this. 4 million metric ton while you produce crude oil, movement of crude oil or transportation of crude oil is primarily done through the infill lines and then the bowsers, and then you have the trunk line to feed the refineries. The gas piece is contingent upon having a robust evacuation facility. So currently we are doing about 8 million standard cubic meters per day gas evacuation in the regional customers. And we are looking at taking it to 13 million standard cubic meters per day. And that is going to happen by the connectivity of Northeast gas grid. The phase 1 of Northeast gas grid has already reached Numaligarh from Guwahati. GAIL has already connected the mainland India to Northeast by taking the pipeline to Guwahati. We have one dedicated line which is Duliajan to Numaligarh. The capacity expansion is expected by this year end from 1 million standard cubic meter to 2.5 million standard cubic meters per day, which will cater to the Numaligarh refinery expansion post. We also have a fertilizer plant which has come in there through the Namru 4, which is a urea and ammonia plant, 10,600 crore investment. Oil India has got a stake of 18%. Government of Assam has got 40% investment. There also, we are looking at a 0.7 million standard cubic meter per day natural gas supply. Once the Duliajan feeder line gets connected to the mainland pipeline, we will be able to evacuate minimum 5 to 6 million standard cubic meters per day. That will give us the evacuation opportunity. Till such time, we have already strategized our drilling program and we will be prepared to generate or develop or produce 5 BCM of natural gas. As far as crude oil is concerned, we have enhanced our drilling efforts. Our rig counts are going to be 28 to 30 in number. Last year, we had spotted 70 wells, completed 59. This year, our target is to do 80. Basis this, we intend to achieve by this year end 7.5 million metric ton oil and oil equivalent. And going forward, it will be 8.5 with 4 million metric ton of crude oil.
Okay, 7.5 million tons this year, 8.5 million tons the following year.
Absolutely.
Sir, any clarification?
No categorization.
Okay.
This is from the production of our near field exploration efforts, from our mining leases. Should there be any new discovery from our exploration acreages, there will be addition to it.
Got that. Sir, there has also been an increase in the GST from 12% to 18% on exploration services. How big of a cost burden is that going to be for you, and will it impact your bottom line?
It could impact, but it is not much as far as the Oil India's balance sheet is concerned. This year, we are looking at about 300 to 400 crore for that matter.
Will be the impact on the bottom line?
Bottom line, we haven't calculated. We are just waiting to see how our investments will pan out. But the more or less impact is about 400 crore as far as the GST is concerned.
Okay. So because of this additional 400 crore, will there be any change in the kind of investments you would have made otherwise? Will you bring that down?
No. We are a E&P company. We will continue to undertake seismic. That's the data acquisition, processing, and interpretation. We will do drilling because without that, nothing happens in terms of our exploration efforts or in terms of our production efforts. So no change in the investment pattern.
Okay. So what's your own expectation of crude prices? Because there's so much pressure on India reducing its purchases of Russian oil. If that were to happen, there is a risk of crude prices moving up. I mean, as you make all these assumptions, what is your base case?
I wish I could predict, but the outlook that we have for ourselves is about $65 per barrel plus or minus. And as we speak today, it is 67. Two things which comes to my mind. The supply side has got a pretty good number while there is a subdued demand. So we are looking forward to a $65 plus or minus per barrel throughout this year.
And plus or minus is what, sir?
We want assurance here. What we have done, realizing or having taken note of this outlook, we have actually initiated a lot of cost optimization processes within the company, whether it is manpower rationalization, asset utilization, operational efficiency in terms of our productivity, in terms of our drilling efforts, in terms of our workover efforts, the turnaround time of our drilling. So all that has already kick-started.
Right. So what is the potential saving from cost optimization that you're targeting?
I would not like to offer any saving per se, but in terms of physical component, I can give you a perspective. When last year we were doing, say, about 50, 60 number of wells, this year we target to do 80 wells by virtue of optimizing the interlocation movement, the turnaround time of the drilling, and despite undertaking more deeper wells. Similarly, while last year we did about 290 plus workover, this year our target is to do 300 plus workovers, where we would like to do optimum cycle time for our workovers. And that is how we intend to operate. Plus, we will also have a good revenue stream, that is our outlook, from the refinery margin that we witness, which is going strong in case of NRL.
Okay, all right. So final question before we let you go. ONGC and Oil India, where you all have signed a joint agreement, right, for 3 exploration blocks. Could you tell us what is the share breakup? Point number 1. Point number 2, give us some color on the total investment.
Okay, so it's like this. As part of earlier also, Oil India and ONGC are there together in couple of blocks. And one of them, as we speak, is happening in Bengal, that is onshore. As part of the OLP 9 bidding round, we submitted 9 bids, and all of them Oil India was successful to secure, out of which in one block, Mahanadi Deepwater, we are together 50-50. In one block in Meghalaya, we are together, that's an onshore block, we are together. One block in Cambay Basin onshore, we are together. Otherwise, as part of our portfolio, we have got one standalone block in Cambay Basin onshore, one standalone block in Meghalaya. But more importantly, Oil India has got, as part of its 1.12 lakh square kilometer of area of exploration acreage, 40,000 square kilometer of area in the Mahanadi and KG Basin of deep water and ultra deep water exploration blocks. There, as part of our investment commitment, the onshore blocks are easy. We don't see, because these are all lower depth wells. The commitment will happen as far as the deep and ultra deep water block is concerned. We are going to place the work order for engaging a deep and ultra deep water 2D and 3D seismic survey, which is about 800 crore to start with. Then once we establish the prospectivity, we will undertake about 3 to 4 deep water wells. That's possibly happening year after or year after that, because we require about 12 months to complete the seismic activity, which is going to kickstart from December. So that's the outline.
Thank you very much, sir, for joining in. This was a very comprehensive interview. Thank you for breaking down so many aspects of the company's business model. We will slip into a break on that note. By the way, the markets have corrected now. 100 points lower on the Nifty. We breached 25,400, breached 25,350. And the problem is IT is under pressure. Banks have seen a correction, profit booking after 12 good days on the trot, and FMCG too is on the back foot. So all these heavyweight indices are lower today, and that's exerting pressure. Midcap index, for now at least, is managing to hold on to the green line. Get into a break. On the other side, Vivek Sharma of Cohance Life Sciences will be joining in to talk about the observations issued by the US FDA and the emerging opportunities in the CDMO business.
Welcome back. Markets down 80, 90 points. Nothing to worry. Par for the course. When you sprint so fast, then you want to cool down a little bit before continuing to sprint, or maybe pause for breath for a little bit. I think that's precisely what's happening. The Nifty Bank has actually been leading the way. That, in fact, is down close to 200 points. The IT index as well is lower. So that's why, in fact, when both the pillars of the market are under some pressure, that explains why we are seeing that the markets are down. But otherwise, in the broader markets, there's plenty of action, mind you. FDC is a stock that's up close to around 7%. I'm not sure whether or not there was a large trade out there, but volumes are larger there. Reddington, another stock that was up, I think, 20% a few sessions ago, that's resumed its winning ways. So that's up as well, close to around 6%. So keep an eye out on that one as well. Reddington, we should get it up for you on the screen. Well, let's get to our next guest then. We have Mr. Vivek Sharma, the Executive Chairman of Cohance Life Sciences, who joins us on the show. Hi, Mr. Sharma. Thanks a lot for joining in, and good to have you on the show. Before I come to you, just highlighting the broad points that we're going to be focusing on for the next few minutes in this interview. The promoter offloaded close to an 8.9% stake in an upsized block deal. So some clarity on that front. The company's response to the US FDA Form 483 with 6 observations. And finally, the broader outlook for the sector, right? What are the opportunities in the CDMO space? So all of this is top of mind. Well, so let's get to the first data point itself. The promoter entity, they went ahead and they sold close to an 8.9% stake. Obviously, they still have a large holding. Give us some clarification on that front. Is there a plan to sell some more? Is there a period that they will not sell? And what is the holding ultimately that they're comfortable with? Please give us some clarity.
No, thanks for having me. Good morning. So yeah, Advent still remains after the sale as our key anchor shareholder. After the sale, they are at 57.5%. The intent of the sale was to broaden the investor base by bringing in top quality institutions. And importantly, Advent has chosen a longer term lock-in, which reflects their stronger conviction in the business. So I would view this as a positive, trend. The strong demand from institution highlights a strong conviction in the business and the management team.
Right. So no more sale is what we are looking at. You're comfortable with that holding as of now. They're done for the time being, right?
So I can comment on their behalf, but that's my understanding. I think, right now they're committed to the business long term. And as I said, we are excited as management team with the broadened shareholder base. and excited to work with the Advent team. Yeah.
Okay, all right, Mr. Sharma. I'm going to get an Ekta as well. She's joining in for this interaction. Ekta, take it away.
Yes, absolutely. Mr. Sharma, hi, good to see you in. The 6 observations that you received for your formulation facility in Hyderabad, I know it doesn't contribute that much in terms of revenue as well as EBITDA as a total. But what is the nature of the observations? When do you expect a resolution for this particular facility?
Sure, Ekta. Hi, good morning. So a few things. Yes, we did receive 6 observations. We had 2 US FDA inspections actually in the last few months. One of them we received 6 observations. The other one was also on our API site in Jagiapet, where we received 0 observations. On the one that you are referring to, there were 6 observations. This is a site that produces drug products. And yes, as you mentioned, the revenue contribution from this site is less than 2%. EBITDA contribution is less than 1% of our total revenue. This was our first inspection actually under the Cohance ownership from a US FDA. The nature of observation is around some material management controls, some cleaning procedures, and some internal processes. As a company, we are committed to the highest level of quality standards, highest level of processes, and we have started working on the remediation of those actions. While we are doing internal processes optimization, internal processes things, we have also retained services of a US FDA accredited agency to help us with those cleaning up processes. We have sent a response to US FDA as per US FDA guidelines, and there is a timeline that within which they are supposed to respond. While we're waiting for the response, everything that we need to do, we have started working with proper procedure control and help from some external resources.
Okay, all right. So we don't expect too much of a concern from this particular formulation facility in terms of escalation. Just wanted to focus on the opportunities which are emerging in the CDMO space. And one of the key things that I wanted to talk about was the US Biosecure Act. We understand that it is back under consideration in the US. It might be a more watered down version from what existed before. But the fact is that there could be an opportunity which could then re-emerge for Indian CDMOs or, CDMOs ex of China. Just give us a sense in terms of what kind of opportunity are you anticipating? And is that already playing out with regards to China Plus One for you?
Right. So listen, as a company, I have said this in the past, as India, I'm very excited and, very optimistic about India's potential in the CDMO space. I think India has a lot to gain and India will continue to evolve and continue to grow. That's my own projection. From a Biosecure Act perspective, the act was being put on the floor, I think December last year. It did not pass. Now it is being pushed again. Generally, my observation, meeting with customers, meeting with other key holders, is that listen, the damage is done. People are looking at as an alternate to really have a backup and then move out of China if that is part of their supply chain. We are seeing improvement and we are seeing RFPs that are coming now that were not there before, and they're in larger quantities, compared to what it used to be before. We are seeing more visits from customer to evaluate our sites and capabilities. So trend-wise, I am seeing traction there. In pharma, it's a very sticky supply chain. It takes time for it to materialize. I can also tell you in my interactions with customers in the US and other places, depending on company's strategy, there are companies that have a China-free strategy. So people are looking for opportunities to really de-risk their supply chain from China wherever it makes sense, and we are seeing traction in that space.
So you have spoken about the RFPs or the request for proposals as well as the site visits which have taken place. You've, spoken to your shareholders about that in the past couple of quarters. So give us a sense in terms of how much of these RFPs have actually converted into business for you all when it does come to the CDMO China Plus One opportunity.
Right. So, so yes, there have been some RFPs that are converted, but we have a large number of them that decision is pending. It's a complex process when an RFP is involved in a phase 3 and a commercial product. It takes a long time to understand, to really work on it, to price it, to share with them and for them. So that process is going on. I want to just give you an example. One very large pharma company has given us RFPs 3 times in the last 45 days. The first batch of RFP, we have submitted the prices. They are evaluated. They have come back with some negotiation. We are discussing with them. The second batch, we are working on submitting. The third batch just came in last week. So even the first batch that was submitted more than 40 days ago or something like that, we have not heard back. They are still internalizing, evaluating. So it does take time. I'm very optimistic that the fact that they are evaluating and there are more RFPs coming, we will see traction from there. So it's all moving in positive direction.
Okay, so you've had one innovator company reach out to you in the past 45 days for 3 RFPs.
More than 3 times. First time it was and I don't want to give the numbers yet. It was a much higher number of RFPs, but it has come in 3 different batches, 3 different stances.
Okay, is this for the ADC opportunity?
All of this and the one that I'm talking about is non-ADC. This is small molecule, but they are phase 3 and commercial products.
Okay, but ADC itself, anti-drug conjugates, which is basically a type of cancer therapy, it is expected to be the big opportunity for you all and for the market itself, $4 billion by, say, 2029, 2030. So give us a sense in terms of the kind of opportunity you are seeing from ADCs.
Yeah, sure. So yes, you're right. ADC is a big driver of growth for pharma services, including us. And we have 2 sites, one in Nacharam in Hyderabad, where we provide commercial payload to commercial customers in the West and in Asia, and then the NJ site, which does early stage, linker conjugation. So we are seeing significant traction there. This is all at discussion stage at our Nacharam site, where we are talking to other customers which are working with on some early stage products. So existing customer is looking to extend the therapies, and if they expand, then we will see traction there. New customers are working on early stage projects based on our camptothecin-based technology, and if they progress, we should see traction.
Okay,
In New Jersey, we have committed capital to expand our capacity there. That was publicly announced, and we have been talking, and we have actually received the first order for an integrated linker, payload, and conjugation RFP there, project that is being worked on by the team in NJ Bio. So there is traction there, and directionally it's moving in the right direction.
Okay, and just quickly then, what does this mean for guidance? Because you have that FY26, you will see acceleration. So put a number to that in terms of growth. And then eventually your $1 billion target and say eventually 30% margins.
Yeah, so listen, we remain committed to the 1 billion, 30% margin in 5 years, 2030. And that's the only guidance I will give you at the time. Otherwise, we continue to remain focused on delivering the commitments that we have made to our customers and delivering that long-term guidance that we have shared with everyone.
Got that, Vivek. Thank you very much. I just want one thing. Those 3 RFPs that you earlier said, is that in relation to, the US government signed an executive order asking federal authorities to stockpile critical APIs for 6 months. So do you think this is because of that?
So first of all, it's not 3 RFPs. We got RFPs in 3 different batches. The number is way higher than 3.
Okay.
It came in 3 batches. Just to give you an example, this is supply chain de-risking RFPs, very clear. They are working with other providers in other geographies, and they are evaluating companies like us to really partner with them.
So this is new stuff in that sense.
That's exactly right. This is new stuff in that sense.
All right, okay. I just wanted to clarify because if this is that 6-month thing which got a bunch of people excited, but this is much better in the sense it's diversification and it's kind of sort of new customers in that sense. Thank you very much. A bunch of more questions, but out of time, and I hope you come back on this channel and program, and we'll chat more. Thank you.
Thanks for having me. Thank you very much.
Okay, well, I think we'll just run you through what markets are doing. And Vinay Rajani is with us, Senior Technical Analyst and Derivative Analyst at HDFC Securities. Vinay, what do you have and how would you trade things now?
Yeah, good morning. So today is looking like a profit booking day. Yesterday, there was a formation of hanging man candlestick pattern on the daily chart of Nifty as well as the Bank Nifty. So basically, it is a sign of possibility of a profit booking in overall uptrend. So positional trend has been up and we have been bullish, but we could see some sort of profit booking in overall uptrend because yesterday we saw there was a depreciation in rupee and rupee has resumed its overall downtrend. So there rupee has been giving an advance signal to the equity markets in the recent past, and that is repeating again. So that can give some profit booking sign in the Nifty as well. So there is a strong support around 25,200 to 25,250, which can be utilized to go long. But as of now, for today, it might happen that we may see a profit booking in today's session. And overall, we have already seen out of last 14 session, 12 session has been positive. So we cannot rule out the possibility of the profit booking in the benchmark indices. But as far as broader market is concerned, I am expecting a continuation of participation in the broader markets, because only 69% of the NSE 500 stocks are still above their 200 DMA, which is not overbought yet. So there is no extreme case as far as broader market is concerned. There has been a gradual improvement in the broader markets. So there is no euphoric sign in the broader market. Buyer dips should be bought into. And as far as Nifty is concerned, 25,200, 250 is a zone where one can initiate again long and definitely we can expect a level of 25, 500, 550 in the coming days. So today is a profit booking day. Wait for a dip to come, and support is around 25,200 to 25,250.
Okay, all right. Specific stocks, Vinay?
Yeah, so basically I continue to see strength in metal stocks. So NMDC is a stock which I like on the chart. So it is into a continuation of an uptrend, and continuous outperformance is there. So around 77.50 one can initiate long in NMDC. I would suggest a trading stop loss at 76. On the upside, I'm expecting an immediate target at 80. The second pick I would take from the auto ancillary space, Subros. So yesterday there was a nice breakout and clear-cut resumption of an uptrend. So Subros is looking good around 1028, 1030. I would suggest a stop loss at 1000. On the upside, I am expecting an immediate target around 1080. So these are the two stocks I would trade with the mentioned stop loss.
Absolutely. Vinay, good to get that. Thank you very much for joining us with that. I just want to play out an interesting piece of the conversation. So I spoke with Jairam Sridharan. He's, of course, the head of Piramal Finance and this large NBFC. And Jairam made an interesting point. He said that lower-end customers are not doing nearly as well as the average picture looks like. I mean, so the baseline for NBFCs is looking all good, but that's extremely skewed. So this is Piramal's MD, Jairam Sridharan. This was at the sidelines of the Banking Transformation Summit that happened just a few days ago. He also actually highlights on the MFI side, microfinance side, actually a new cycle has started, and it's the upcycle. Listen in.
What we are seeing is an environment in which the lowest end of the customer is not doing nearly as well as the average picture looks like. So you can look at India's average numbers on anything, and much of it looks like it's all trending upwards. But unfortunately, it doesn't seem to be evenly distributed. And at the lowest end, you find not as much growth, not as much sort of prosperity, not as much ability to lever themselves. If you look, for example, at housing loans, you see that at the top end of the spectrum, things are looking pretty nice. I mean, there's enough growth, and you have all these news stories of this project was opened and the average ticket size is 10 crore and was sold off in 2 hours or whatever. Like, you hear all these stories, but at the same time, you see at the lowest end, you see kind of the less than 20 lakh, less than 25 lakh rupee kind of housing loan market. It's degrowing. It has been degrowing for a year and a half now. Second piece, the second example I'd give you is, this was for individuals. The same is happening in companies. In companies, the largest companies are doing remarkably well in terms of borrowing, not necessarily in terms of growth and profitability, but certainly in terms of delevering themselves, balance sheet strength. They're doing remarkably well. But the smallest companies are really struggling in terms of balance sheet strength. In many ways, this is the MFI sector growing up. It's the first big cycle in the post-deregulation era after RBI kind of changed all their rules and made the sector kind of let the sector go in 2022. This is the kid going to college for the first time and kind of having way too many drinks and having a massive hangover. So it's a coming of age thing for the sector. So the sector has reacted really well. I agree with the point that Sudipta is making that kind of new business, particularly post Diwali of last year, new business that has been booked is looking actually very, very good in the sector. And this is a sector in which old business runs off very quickly and new business starts to dominate. So I think certainly if I were a betting man, I would say we are at the beginning of an MFI cycle, not at the end of the previous one.
Okay, interesting takeaways coming in from the Piramal management there at the start of an MFI cycle and not at the end of one. We need to take a short break on that note, but Manisha Gupta will join in. She'll be focusing on the commodity space. Stay tuned. Welcome back. Well, a little bit of profit booking for the markets. The Nifty is down around 100 odd points. We have the Bank Nifty, which is under pressure as well, so down around 0.4%. Remember, it's been a couple of good days for the Bank Nifty, so now seeing some amount of profit booking. But let's shift focus now to the commodities market. Manisha is here with us. Manisha, over to you. Which is the metal that you're tracking today?
Well, I'm looking at aluminum, and that is because in the near term, when you look at the last 1 week, 1 month, even 3 months for that matter, this one has been an outperformer. We have seen prices gain up by 5%. It's not too far away from its 2022 highs as we speak. And aluminum clearly from a surplus commodity seems to be getting into a deficit one, and that clearly would support commodity going forward. But let me tell you, we are trading at around $2,700 a ton, and most of the banks and brokerages are calling aluminum at $3,000 by the end of this year as an average. There are 3 or 4 factors that you need to keep an eye on. First one really is about tariffs. Remember, there is a global 50% US tariffs on aluminum imports, and much of that really comes in from Canada. So we are looking at Canada actually moving away from US to other markets. And if you look at the overall numbers, in the first quarter, the aluminum exports from Canada to US were at around 95%, which has declined to 78%, with an expectation that you could be looking at lower numbers as we move ahead in the year there. The second thing clearly has to be about about China. Remember, nearly 60% of global production and much of that consumption as well now comes in from China. Interestingly, China has moved into this space very, very gradually. So when you look at these numbers, Chinese production in 2002 was just about 4 million ton. Fast forward to 2024, China now produces 43 million tons. So China basically knew where to get in, and we have seen Chinese investments in smelters outside China as well. So China clearly playing that big game there. Also, when you look at the Chinese exports, that were at a record high as well in last year at 6.7 million tons. China has interestingly put a production cap at around 45 million tons. The capacities are much higher, but with China now calling it cap at 45 is one of the factors that you have seen support come in for aluminum. The other has to be about Russia, one of the major players yet again in aluminum, and the metal produced after April 2024 cannot be delivered on London Metal Exchange has been the sanction that has been put on Russia. Having said that, we do understand that a lot of metal is still coming out from Russia. But the second factor, the point that you should look at is the LME inventories itself. Now, the markets take a lot of sense and sentiment from this one, and this is what we are working with. In 2021, aluminum stock was at 3 million tons, much higher, and we did not see the prices outperform. And then you come to 2024, the inventories fell to 1 million ton. This year has been interesting. We've seen inventories not just below 1 million tons, but constant decline as well. In the month of May, it was at 700,000 tons. Right now at 375,000 tons. Markets are taking a lot of cue from that. Is the reason there are very less sellers into this and buyers aplenty. Now, when you talk about the new aluminum smelters as well, and this is a report coming in from Indonesia, that you could be looking at 7 million tons of capacity by 2030. But remember, aluminum is a very power-hungry as a metal, and with power being fought between AIs and energy transitions and various other sectors as well, captive energy is something that Indonesia perhaps will not be able to work out with, and that is the reason markets are slightly sarcastic. So this is an area that could continue to be bullish going forward.
Manisha, thank you very much for that. So those are commodity cues coming through. Reddington stock at the bottom of the screen on the back of that iPhone 17 appearing in stores. So interesting one, and we'll have more a little later. We'll take a, there you go, 9% higher. We'll take a break. On the other side is our special segment. It's the economy. Lata in conversation with Priyankar Biswas of JM Financial Institutional Securities and PP Gupta, CMD of Techno Electric and Engineering, on the state of construction companies post the GST cut.
Welcome to It's the Economy. This is a slightly less discussed part of GST. How is the cut in GST in cement and some renewable power equipment impacting construction companies who may have negotiated term contracts a little while ago? Will there be a price pass-through or will they have to renegotiate? Will they have working capital advantages, lower requirements, since the cost of some of the raw material like cement has fallen due to the cut? Will capex, on the other hand, come down because the government may have a little less money given all the tax cuts? For all these questions, I'm joined by Priyankar Biswas of JM Financial. He's an expert on this industrials area, and PP Gupta, the chairman and managing director of Techno Electric and Engineering Company, an extremely successful company in the power cycle, the power output and construction space. Mr. Gupta, Priyankar, good morning and thank you very much for joining me. Mr. Gupta, first up to you. All the older contracts that you'll have, is it just a pass-through? Or are the people who are giving you the contract saying that now that you may have lesser cost, can we share the benefit? I mean, is it smooth or is there some negotiation?
Ma'am, firstly, this reduction in GST has happened only in the renewable generating space, number one. And there is no change in GST as far as transmission is concerned, space is concerned. 12% to 5% has happened only in generation space. Secondly, power is not in GST as of today. So this is, to my mind, this benefit cannot be passed on to consumers because there is no GST on power. It is only on capacity building, which has come down. So there will be a saving of around, to my mind, about 15 to 20 lakhs a megawatt, no doubt, in setting up of the capacity of the power stations. But the bigger challenge which we are seeing today is there is no demand for power in renewable power. In the day times, we see the cost of power in power exchanges is as low as 50 paisa or below. So that is hampering the further capacity augmentation in this space. Government need to look into power reforms or bring power also in GST. That will benefit government hugely, even if they bring it in 5%, you see. We sell 2 trillion units a year, ma'am, every year in this country. And the bill is no less than 10 trillion rupees, 10 lakh crore. If we take 5 rupee also as a power cost on an average across all the segments. Taking it in 5% slab also will mean 50,000 CR.
I take your point that there is no way to claim.
Tariff in the country to the consumer will come down by 15% straightway.
Because you can pass on the cost.
Because capex cost will go down by 18%, and hence the tariff will go down by 15%. So government won't have to provide so much of subsidy, to the discoms.
All right. I got that. And anyway, the surplus solar capacity is a recent development because of the low demand. One hopes that it is only seasonal. And with all the data centers that you are servicing, this will not be a longer-term problem. But I'll come to that in just a minute. Let me get the GST thing out of the way. Priyankar, thank you for your time. But did you hear from any of the construction companies that, there could be this tug of war between I'll keep some of the benefit and, renegotiate the contract in some fashion? Is that a possibility?
So this is a very unlikely possibility. That is how I'll put it, because generally a lot of it is actually government capex that is happening today. And within that, generally it is covered in what we term as a change in law. So essentially what happens is, based on the changes, the contract values will of course be renegotiated, and there should not be any impact as such. But the benefit that we see is earlier there was this inverted situation. For example, certain inputs used to be at relatively high GSTs.
18, cement obviously.
Yes, so like that. So because of that, there were this input credit build-ups which could not either be utilized or it took a lot of time to wind down. So that situation, especially from a working capital standpoint of view, should actually be better, and better compliance as well, because everything is now essentially at relatively similar rates.
So you expect that working capital cost or amount needed for, say, companies like L&T, for people who use a lot of cement, maybe even KEC, Kalpataru, I don't know, the people who use large amounts of cement, you think that will go down considerably?
Yes, the it may not be considerable, but it would definitely be a meaningful impact. So what we had highlighted as an example in our report is that, for instance, it's almost like 15,000 crores is what is there on L&T balance sheet as of FY25.
Unclaimed ITC credit?
No, it was mentioned as advances to suppliers and indirect tax balances, of which most of it would be indirect tax balances. So that indirect tax balances number could actually come down materially in let's say, once in the relatively medium term.
Okay. Mr. Gupta, to come back to you and continue with the power theme that you referred to. Clearly, all those solar contracts signed with SCCI now are not getting PPAs from DISCOMs because DISCOMs are somewhat oversupplied. But do you think this is a short-term problem? One good year of early and plentiful monsoons has meant that temperatures have been low in various parts of the country, and therefore demand is lower for solar power. But this could be only maybe 2025 problem?
Ma'am, in power, we have always dealt more as a essentiality commodity than as a commodity facilitating quality of life. Let me put it in two parts.
Okay.
That is the challenge we face always. The tariffs of power is all-time high in our country, which does not aid consumption more. If we can, the issue is seasonal, of course. That is a compulsive part of the demand. But more important is to induce the demand in the system. If we can bring down our tariffs by 15-20% or 25% more easily by taking away all these taxes, baggage of taxes, and also cross subsidies as existing in the system, you will see that more and more consumers will like to consume, power for more aids, more, automation, mechanization, data consumption. Society's quality of life will be a lot better if power is more affordable.
Okay. Just to refer to the issue that Priyankar mentioned, are you also, those who are constructing renewable power projects, are they also likely to be saddled with unclaimable input tax credit? Is that a likelihood since, as you point out, they cannot claim there is no GST on power?
To my mind, that is unlikely, ma'am, because there is always some value-added component involved in the capex. It will more or less should neutralize. That is not the challenge I see.
Okay.
But bigger challenge is feeders are not available in the market to the generators today. That also is stagnating the more capacity becoming operational in the system.
Okay.
That is also choking the system today.
Okay.
The biggest,
you will see private sector companies entering and correcting that?
Yeah, all are private only, ma'am, today. Even generation is all private by and large.
Yes.
By either, it is all through private investment.
Okay. So a temporary mismatch of one element of the power cycle.
I will say temporary, ma'am. It is going to last in this country and grow further bigger, my mind.
Okay.
Because we are not planning advanced capex in evacuation, in transmission. We want to do capacity to capacity and often right of way, acquiring land parcels and deploying these feeders is taking no less than 3 to 4 years.
I agree with you, sir. I have gone through enough of power cycles, and in the 2008 point where we were trying to provide excess capacity, we ended up only having huge NPAs simply because other parts of the system were not up to speed. Certainly not DISCOMs.
Right, ma'am.
That's a big discussion for which I'll invite you. But Priyankar, is there a worry that capex pipeline will reduce because the government has given away 1 trillion by way of income tax and another $500 billion by way of GST cuts. There is a huge advance spending already done, front-loaded. Are we going to see lower pipeline?
Yes, there is a worry. So, for instance, as you were rightly highlighting, there has been a fall in the tax collections. So, besides the GST angle, like $500 billion that you said, the direct tax collections have been relatively weak. Now, essentially, some of the sectors where we can have worries is, for example, water, that we had highlighted in our report as well. So where there is a disproportionately strong dependence on, let's say, the central government budgets, even significant portions of the railways as well. But the good part is a lot of this capex that we think about today. So let's say power transmission, for example, even generation on the renewable side, by and large, these are private in nature or PPP in nature.
Or PSUs.
Or PSUs in nature, yes. So essentially, we do not see impacts there at least. So those sectors should largely be shielded in our view.
Okay. They are not dependent on the fisc. I agree. Actually, we're run out of time. We have tried to attempt too many themes, perhaps. I'll invite both of you again to discuss separately the many gaps in India's power cycle theme. Thank you very much, Mr. Gupta and Priyankar, for joining us and helping us understand the situation better. Wrap up on Bazaar. Chartbust is coming.
Stocks of the Adani Group surge after the SEBI gives a clean chit to the group companies over allegations by short seller Hindenburg.
Acquisition tailwinds for JSW Energy. The stock is higher in today's trading session. The company is set to acquire Tidong Power Generation for around 1,728 crore rupees, while it will also acquire GE Power's India Durgapur unit via a share swap.
Ramki Infra surges over 3% as it's bagged a near 2,100 crore rupee project from the Hyderabad Metropolitan Water Supply Scheme.
Unichem Labs, well, it's under some pressure. European Commission levies a 19.5 million euro fine over the company breaching the competition laws. Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam, and the market's today taking a bit of a breather, but it's a market that's been running very, very swift. So for the time being, pausing, taking some breath, and maybe it resumes its upward trajectory. But Mangalam, we've had a good run, 1,000 points in less than a month. You couldn't ask for a better run, but let's see how things move from here on. My gut is that maybe towards the end of trade, we'll get off the lows.
Yep, lows are being bought into, and this rally, the 1,000-point rally that we saw, Nigel, was being missed by a lot of people because it was a gradual up move that we saw, and lo and behold, suddenly it's 1,000 points higher. So maybe all those guys were feeling the fear of missing out, may look at this dip as a buying opportunity. So let's see how that goes. The broader market's something I'll be watching out for the overall texture of the market right now. The broader markets in terms of the mid-cap index, the small-cap index, overnight in the US as well, the Russell far outperformed the other indices and closed at the high point as well. So the mid-cap and the small-caps outperforming, telling you that this dip may be perhaps a little shallow. But that's about the secondary market. Let's shift focus to the primary market. Satwik Green Energy, the company's IPO opens up for subscription today. We're joined by the MD, Manik Garg, to discuss three key focal points. The most important one, the peak returns behind the industry. Is localization as a scheme helping, and the export opportunity for the company as well? Thanks a lot for joining in, Manik, and always a pleasure having a guest in the studio, but more so when they're at the opportune time for the IPO, the public market. So we'll obviously have these conversations a lot more once you're listed. But I'm looking at you raising funds and some of the things that you will do with those money. You have around 4 gigawatts PV module manufacturing facility for which you'll be spending about 500 crore rupees. And you'll be investing in a subsidiary for 165 crores for debt repayment. Two-part question. What is the asset turnover on this PV module manufacturing facility for the 477 crore rupees that you invest? And with the 165 crore debt repayment that you do on a consolidated basis, what does your debt come down to?
Right. First of all, thank you, Nigel and Mangalam, for inviting me to the show. It's a pleasure to be here in the studio. And so regarding the IPO proceeds so the 700 crores that we are raising as a primary issue, most of it is going towards the capex plans of establishing a 4 gigawatt solar PV module facility that we are putting up in Odisha, Gopalpur. So currently, as a company, we are at 4.8 gigawatt of module manufacturing capacity, and if you see our return on capital employed, it's over 60% for the last year as well. So we aim to establish and sort of maintain that position as we expand, our module manufacturing capacities. And that is the kind of, asset turnover ratios that we're looking at in terms of revenues. You've seen that we've grown consistently, and that is the same trajectory that we aim at.
So roughly a 500 crore investment would yield an EBITDA of 250 to 300 crores?
See, again, I can't.
I'm just doing the back calculation. You spoke about the ROCE.
Yeah. So the trajectory that you've seen in the past 2 years in terms of the capacity utilization that we have had in terms of the overall capacities that we have. So the forward-looking numbers I can't comment on directly, but yeah, that the past numbers can give you a guidance of how the future will look like.
All right. Good to have you in the studio, Manik. Give us a few more details then. What does your capacity go to? Post this, capex that you're undertaking, point number one. Point number two is with regard to the debt. You're going to be repaying some debt, right, to buy the subsidiary. So what is the total debt in the books, and how much does it come down to?
Sure. So let me first get on to the debt. So currently, a long-term debt stands at around 450 odd crores on the books.
That includes the debt in all your subsidiaries as well.
It includes the overall debt in the subsidiary as well, and it includes the working capital limits as well. So the long-term debt is about 170 odd crores, which we're completely repaying through the IPO. So post the IPO, we won't have any long-term debt on the books as of now. The only working capital fund-based limits will be there as part of the debt.
170 crores, right?
Yeah, 176 crores. Yeah.
So around 17 crores of interest saving is what we could see.
Absolutely.
Perfect. Let's get to the capacity.
Yeah, in terms of capacity, we are currently, like I mentioned, 4.8. Another 4 gigawatt of modules will bring us to 8.8 gigawatt of module capacities. And as far as cell is concerned, we are also backward integrating into cell manufacturing, which is 4.8 gigawatt. And all these capacities will be operational by FY27.
So what does that take your overall revenue and margins to? Because there will be backward integration. So I suppose there'll be a couple of 100 basis points at least in terms of margin levers. Then you have, your capacity, which is near doubling.
Right.
So does that mean your revenues also go to that extent? Because over the last 1 year or so, we've seen obviously your revenues double. But that typically happens when a company comes in for an IPO.
Right.
Numbers look incredible. Post-IPO, a few quarters, what are we looking at? FY27 when the entire, shebang is on the street.
Right. No, that's a very valid point. But I think for us, IPO was not the reason why we're doing so well. I think it's more about the way we work in terms of our capacity utilization, our diversified customer base, and I think that will continue to help us in we will be able to leverage all of those things to establish and keep.
So at peak, what is the potential? How many, what proportion of your margin savings are ahead of you, and what kind of revenue scale can you see at peak? We're not asking for a forward-looking number,
right?
But what is the potential? You can give us a rough range.
Yeah,
and you could give us also a revenue potential.
Yes,
right? You did 2,200 crores last year.
Yeah.
You're putting up this big capex. You're sounding very optimistic about the asset turn and the likes. So at peak potential, at current prices, what can you do?
Right. So if you see current prices, they range around 15 to 16,000 rupees per kilowatt. So that can give you sort of at our current capacity utilization, that can give you an indication of the kind of revenue that the company can generate with the future capex.
Revenue potential is fine. The regulator also is okay with it. You could tell us the potential revenue from around 2,200 crores. The potential. We're not asking you forward.
Yeah. So with an 8.8 gigawatt and with the current capacity utilization, if we see, then we can go up to 10,000 odd crores in the coming years. Yeah.
Okay. And what about the margin levers? Because of the backward integration, your margins were what? Mid-teens. How much better can they get from here?
Yeah. So in terms of margins, again, this is a fluctuating market in terms of backward integration. And right now, if we see our peers who already executed cell projects, we see their margins crossing the 20% mark. So I think if not, and as per our estimates, not a lot of cell capacities will come online by FY27. So the margins can be in that range.
All right, so high teens at least, if not 20%.
Yeah.
But I think the 10,000 crore number also that you're talking is a little conservative, because I multiply 15,000 by 8.8 gigawatts, 15,000 per kilowatt. The basic number that I get is 13,200 crores.
Yeah, but
assuming you lower utilization.
Yeah, 75 to 80% is the industry utilization, though we are one of the best, but still have to be conservative.
That's 9,900. All right.
You want to give us a rough market share number?
See, market share again.
Back of an envelope calculation, according to what your internal team has projected. If you could give us a sense about that, and also the Chinese competition, right? What was it, say, a few years ago? Do you think now we can battle them easily with the kind of protection that you've got as well, and the way ahead?
Yeah, I think in terms of competition from China, definitely. In terms of just pure play modules, I think we are almost at par with China in terms of operational efficiency and operational cost, as well as technology. So I think we can totally battle that, given the fact that the government is supporting the industry. And sorry, what was
your market share?
Market share, we were at 5 to 7. We were at 5 to 7% for this fiscal, and I think we can defend that market share easily.
Just one number before we let you go. I'm looking at your order book. The domestic order book is just about 4 gigawatts. For all the other peers, their order book actually is a lot higher than their current capacity, and you are announcing capacity while your order book is less than that. So just trying to figure out, are you expecting some order wins in the very near future?
Yeah, so by now you must have understood we were a very conservative company, in terms of how we do business. We only consider orders where we have a financial commitment. That is the confirmed order book that we consider. And at the same time, this order book does not consider a channel and spot sales revenue, which contribute around 30 to 35% of our overall sales.
Okay, all right, Manik, appreciate you joining in. Thanks a
Thank
lot
you.
for giving us some fair color with regard to your company, as well as how do you see the industry pan out. All the best for the IPO.
Thank you so much.
On listing, you're back on Chartbusters at 10:30 a.m. and we'll try to squeeze you a little bit more for some numbers. Thanks a lot.
Absolutely.
Thanks a
so
lot
much.
for joining in.
Pleasure to be here.
We'll slip into a short break. On the other side, we'll have another IPO. GK Energy will be coming in with details of their IPO. So stay tuned. It's an action-packed show.
Welcome back. You're watching us here on Chartbusters. As you can see, above our heads, the Midcap index, which is doing well. The other indices pausing for a bit of breath. It's a Friday. No real worries after an 11-12 day rally that we've been putting on for both the Nifty as well as the Nifty Bank. But let's talk about, the primary market action once again. We did speak to Satwik earlier, and now we do have GK Energy, which is eyeing a D-Street debut ahead of its IPO, which has opened today. Gopal Kabra, who's the CMD and CEO at GK Energy, joins us now to obviously discuss the IPO, the proceeds, the three key points that we'll talk about: the status of PM Kusum extension, order visibility post PM Kusum, and diversification as well as opportunities. Thanks a lot, Mr. Kabra, for joining in. The obvious question: nearly 83% of your revenues come in from the PM Kusum scheme. Everyone we've been speaking to, they are hopeful of an extension out there. Have you heard anything? If not, then what happens to the business?
So basically, historically, it has been always there that, as the phase get over, the new phase get launched. And it is such a successful scheme where already Ministry of New and Renewable Energy has given the notification and invited us for the discussion. And we had a discussion couple of months before, which is publicly available. So definitely it's going to be renewed. As this is one of the flagship program as well as one of the successful growth story for the farmers and renewable energy.
All right. Hi, Mr. Kabra. Good to see you in. You're sure it's going to be renewed? By when do we get clarity?
Sir, first scheme is going to be over by March 26, so we should have the clarity before that, hopefully.
Okay. All right. Now you're raising some money from the market. So could you tell us the utilization of that? Basic, I think the fresh issue is close to around 400 crores, if I got that number correct.
Yes.
So utilization of that, I think you're going to be using some part of that to deleverage your book as well. What does the debt come down to?
Basically, we are going to use the IPO fund for the working capital only. Growth is what we are looking and we are eyeing positively. So we need the money for the growth of the company.
And working capital requirements, how does it ease things, in terms of using this money?
It is completely going for the working capital only.
Okay, all right. So tell us, right? How does it? Must be paying some interest, which it will be some interest savings once you use part of this 400 crores. So when you pay, say, 200 crores back, then it eases things up, and maybe you save closer on 20 crores. So if you could help us out with that data point.
So basically, the way we are growing multifold year on year, we need more working capital, and we utilize this money for the better negotiation with our vendor. So we could save more money than the interest over there.
Right, but the problem is that as your sales increase because of the increased contribution of PM Kusum, the requirement for working capital also increases because, there are, what we hear from people who are also supplying to this scheme, there are delays in payment. So what is the typical receivable cycle of supplying via the PM Kusum, and what are you doing to actually manage that?
So my working cycle, which is reflecting in my books as well, it is almost less than 120 days, and that is on the annualization basis. And when we see the January to December, then it will be 90 days only.
Okay, all right. Give us a few more details then, in terms of geographic breakup as well. It seems a high amount of concentration towards a state like Maharashtra. Going ahead, do you see some kind of geographic diversification? If you could give us the way you see things panning out going ahead?
We are basically in Maharashtra because the major volume of the country is coming from Maharashtra, but definitely looking towards the future, we have already expanded to Haryana, Rajasthan, UP and MP as well. And these are the states where the agriculture is, or the number of the farmer is quite higher. So India have the 11 crore farmers. So out of that, 3 crore have the grid power or the diesel pump sets. So this, whatever the addressable market is present, out of this addressable market, majority market belongs to this 5 states. We already expanded in Haryana, Rajasthan, UP, and this year we expanded into the MP as well.
And you would earlier buy a lot of pumps from Oswal Pumps. It was later that you switched from that. What was the reason for that? Could you give us a sense? And what benefits does the new vendor get you?
New vendor, it's basically the more better pricing, fastest delivery, as well as the better quality. And Oswal is also quite good. We don't have seen such a huge problem in that. But we want to control our OEM supply. We want to control our QC very well. So we have deputed at the new vendor my complete QC team who take care for the complete production line.
And what are you, okay, and what are you doing to, improve your non-Kusum order book? Currently, Kusum is close to around 83%. How is the non-Kusum part of your order book growing, and what is that likely to contribute to your overall sales by?
We have already moved into the Magil Tala, which is a state-run scheme. And we are out of 2 lakh pump, what is allotted out in that 34,000 odd pump we have received. So we are already having a market share of the 17% in the non-Kusum segment.
Is that potential for exports? If you could help us out with what is it at and where do you see that number headed?
Definitely export can be done. India is leading right now in the solar agri pump in the world. We are eyeing on the few more countries, but right now the Indian market itself is so big that we would like to serve our own nation. Then definitely we would, with the additional capacity availability, we would do the export as well in the future. But right now I may not like to go into that. Let's concentrate country. It's a huge volume here itself.
And do you think your market share can increase? I think the back of the envelope calculation, what we have with us is that your market share is around 7%. Do you think you head into double digits?
We will try to, to do as much business we can. Rest, it's pan-India development is already going on. So hopefully in few years it may grow. But the sector is growing so big. So my percentage may remain the same, but the business overall is going bigger.
Got that. And, if you could give us a sense on what kind of order inflows are you likely to see over the next 2 to 3 years? Because currently you're sitting on an order book of 1,000 crores. if you could give us a split on that as well. How much of that is Kusum? How much of that is private?
See, we are eyeing on the PUM Kusum 2.0 right now, and the private market, we have already started the rooftop. And this much I can say because I cannot talk as we are in IPO on forward-looking numbers. You can understand that thing.
Okay, all right. Mr. Kabra, appreciate you joining in, filling us in with all of those details. It's a very interesting space. The only problem is in terms of payable and collection days as well. But as you're saying, you believe things are under control and you believe there's a long runway as well. We'll chat up with you again once you list on the bourses. Thanks a lot for joining in. Take a break, come back, continue to focus on markets which are now down close to under 100 points. Stay with us.
Welcome back. Even as the Nifty is down about 102 points, a couple of stocks are moving higher. We have Asian Paints, which has moved to the high point of trade. Eternal continues to do well. Yesterday, in the last hour of trade, had seen a bit of a surge. Influential investors getting into Eternal, 1.5% for Mr. R.K. Damani. And now we have that stock opened slightly softer today, but has recovered. But don't lose sight of the recent listing. Urban Company, what a stellar third day it's been having. After listing about 60% higher, there was a pause for breath yesterday, and today, right off the bat, the stock is up nearly 6.5% at the high point of that counter as well. Electronic Smart is the other one which is moving higher, and the iPhone seller, Reddington, continues to do well, 7.5%. Not sure how much of that will come to their revenues right now, but Nigel, that's the mood of the street. They make an association, they bid the stock up. But speaking about association and the iPhone, are you buying one?
Definitely not.
I was thinking of looking to sell this one and get the iPhone 16 for a cheaper price. Maybe.
Actually, Mangalam, I've got a message from Sonal. She says that probably, my man, you could be due for a Diwali gift. So
I think that's a scam message. That's definitely not Sonal's message. But
I'll tell you what. We'll wrap up on this show. Sonal will be on the other side. Maybe she'll tell you all whether or not she's buying the iPhone for Mangalam. But we'll wrap up on this edition of Chartbusters. Stay with us. The team of Trading Hour is waiting by, Sonal included.
Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Hormuz Patakia. Hey Hormuz, happy Friday finally. But looks like markets in a mood for profit booking. We did see markets ending above the 25,400 mark yesterday, but we have actually taken that off the table by a big margin. So 111 points gone on the Nifty as we speak. Midcaps, yes, they're outperforming the benchmarks, but still there is some weakness that has come by. But if we talk about this week itself, it's the PSU banking index which has outperformed the market, 5% higher on that particular index. Today as well, it is gaining and it is up around 1.2%. It is followed by Nifty Realty, which is up 3.5% this week. Small cap index too has done well. So this week, 2.8% gains on the small cap index. And if we look at the performance right now, it is outperforming the mid caps as well. Other than that, Nifty is up 0.8% this week. We did have some contribution coming in from the IT names, the pharma names. So
all these stocks continue to remain on our radar. But that's what's happening as far as the benchmarks are concerned. Let's talk about the broader markets. Hormuz has gone across to the big wall and is going to put spotlight on the top movers in the market this hour. Hormuz.
You know, we've been speaking about this over the last few trading sessions, that the stocks that are moving in the broader markets are moving on extremely high volumes, and today is no different. You know, start off first off with the Adani Group stocks, of course. They are the ones, of course, news-driven names. But take a look at the volumes here as well. Now, Adani Total Gas is the top gainer within this pack. 73 lakh shares having changed hands in the first couple of hours itself. The 20-day average is only 2 lakh shares. And the same for Adani Green Energy as well, almost 10x the 20-day average volume. And Adani Power as well, that has had over 2 crore shares that have changed hands, and that is well over 4x the 20-day average volume. So Adani Group stocks moving on high volumes as well. Now going on to the broader market movers. Now Redington, of course, is surging on the launch of the iPhone 17 in India. Apple, despite having their own stores in the country, still remains a significant client for the company. There are 34% revenues in the first quarter coming from Apple. The stock this week itself was up 20% on Tuesday as well in anticipation of this launch. And back then, we had over 11 crore shares change hands. And in today's session, in the first couple of hours itself, we've had around 3.5 crore shares change hands. The 20-day average is only 35 lakh shares. And 30% higher this month is Redington, of course, with today's move and from Tuesday's move. And this has already turned out to be the best month that the stock has had in 2025. The third one on the list today is Trigen Technologies. There's a 20% upper circuit on the stock, the biggest single-day gains in September of last year. And of course, the volumes in today's session are the highest since January of this year. And this 20% upper circuit has come on the back of over 5 lakh shares changing hands. So take a look at the 20-day average, only 9,000 shares. Shows the kind of volume moves that you're seeing. And as a result of this 20% move, the stock has broken about all of its key moving averages, be it the 50, 100 and 200 DMA. The 200 DMA placed at 87 rupees, so it's trading above that as well. And lastly on the list is a Midcap, is a small pharma name called FDC. The stock is around 6.5% higher, it cooled off slightly from the highs, but the third straight day of gains for the stock. The volumes already are the highest since September of last year. You had close to 40 lakh shares having changed hands, and take a look at the 20-day average, only 22,000 shares. And as a result of this move, is trading above all of the key moving averages and has also turned positive on a year-to-date basis, having gained over 25% last year as well. So broader market names continuing to move on very, very strong volumes in today's session as well.
Oh, yes, some interesting names there. Thank you so much, Hormuz, for bringing us that list as always. Let's talk about stock-specific news and why some stocks are in focus. JSW Energy is one of them. There are 2 acquisitions that the company has made. Vivek is joining us with more details on this one. Vivek.
Well, that's right. You know, on an acquisition spree, on a capacity addition spree, the entire JSW Group and JSW Energy has very aggressive capacity addition targets. So in fact, they have gone ahead and beaten their own guidance of reaching the 30 gigawatt mark. Let's have a look at both of the news. Number one, they've gone ahead and entered an agreement with Statkraft IH Holdings. The company will acquire a 100% equity stake of Taidong Power Generation. It's a small unit, 150 megawatt under construction hydropower project. Revenues of just around 40 crore as far as FY25 is concerned. The transaction is at an enterprise value of close to 1,728 crore. With this, the total portfolio has exceeded the 30 gigawatt mark. Now, coming to the second part, interesting development. Again, a smaller unit, basically JSW Energy is making this particular move to go ahead and do backward integration as far as the boiler pressure parts manufacturing business is concerned. So GE Power will demerge the business of manufacture as well as supply of boiler power boilers. Now, this particular business constitutes close to 5% of GE Power's total turnover. So, close to 530 crore was the total annual turnover. Now, this particular deal, it's via a share swap. So, 10 shares of JSW Energy will be issued for 139 shares held in GE Power by stakeholders. So, overall, 2 capacity additions that have been announced by JSW Energy overnight.
Indeed, on an acquisition spree, capacity expansion spree. Vivek, thank you for that. 1.5% higher on JSW Energy as well. And by the way, a lot of other movers in the broader markets. You can't take your eyes off these. And Orchid Pharma is one of them. Is 9% higher now on the stock, even as the index currently trades around 100 points lower. Take a short break. On the other side, put the spotlight on the crypto markets with Manisha on the other side.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back, and on Crypto Corner today we talk about the big move that has come in from the US, and this is coming in from the US SEC, where they have approved generic listing standards this time around for cryptos. Well, remember, there are hundreds of crypto applications right now lying around for ETF launching, but with what SEC has done, the standards will now allow exchanges to list spot commodity-based ETPs, including cryptocurrencies as well. So this comes in as really big. Remember, the first one that we saw from US was in 2024 in the month of January. This move will now reduce barriers to access digital assets products in a regulated manner. This is something that the street has been watching out for a very long time. Remember, this opens up the way more for the institution markets as well. So until now, you have Bitcoin and Ethereum, but with this now, you will have more cryptos and more tokens now listed in sense of ETF. So until now, as I said, the SEC was approving ETF filing on a case-on-case basis, but now this is standardized, this is open, and you will see more cryptos now coming into the fore. So Bitcoin and Ethereum ETFs already are on. We do understand that Solana, XRP, and the meme coin Dogecoin also actually has filed for an ETF, and there are hundreds of tokens awaiting ETF launches for their cryptos there as well. So this is a big one that has come in from the US markets there. And on the back of this as well, we've seen crypto prices gain quite strongly in the overnight markets also. Just taking a step back and telling you that US continuously, totally seems to be leading this. US did pass the Genius Act. This was in the month of July in 2025. So this is the stable coin law, and US has been very bullish on that. US also is the first one to allow the spot Bitcoin ETF in Jan 2024. And since then, we've seen billions of dollars of inflow into this one. This actually has been one of the best inflows and the successful launches in sense of ETFs that we have seen come in the traditional markets vis-a-vis the cryptos as well. We also have seen SEC approve Grayscale Digital Large Cap Fund. Now, this is yet another second very big one. This is the first time this is happening. And now you have a digital multi-crypto asset ETP in the market there. So you don't have to really look for one crypto or the other. Via this, you can invest your money, and the fund will continue to ensure that you get your returns here. So the GDLC provides exposure now to 5 cryptos via this multi-fund. You have Bitcoin, Ether, XRP, Solana, and Cardano as part of this. So, and US, by the way, is not the only country. We've seen various regulatory frameworks continuing from other countries as well. Japan, Australia are also working in the framework. You also have Canada, Switzerland, and various other countries which also are working in this sense. When you talk about the Indian markets, then the cryptos are here legal. It is permitted to purchase, hold, and sell cryptocurrencies. This is done via the Income Tax Act. And also, there's 30% taxes that you have to pay when you are closing that trade that you have in case of cryptos there. So markets are looking at more coming in. There also is a discussion paper that we understand that the regulators are working on right now. Trading that can be done in the Indian markets, in domestic or international, but they have to be FIO-IND registered. And at this point in time, it also is about investing in cryptos. That is absolutely allowed in India, but that's just about it. More than that is something that the street is still waiting for. With that, that's all the time that we have on Crypto Corner, but back to you guys.
Okay, yes, that was an interesting update that is coming in from the crypto world. But let's do one thing. We'll slip into a short break. When we come back, our CNBC TV18 exclusive with Sanjiv Goenka comes up next.
And welcome to On the Record with me, Shireen Bhan. Every year, my guest joins me to talk about the road ahead as far as the diversified conglomerate is concerned. Joining me once again on the program today is Sanjiv Goenka to lay out the roadmap for what he has in store for a whole host of his companies. Mr. Goenka, it's always a pleasure. Many thanks for joining us here on CNBC-TV18. It's great to have you back. It was last July when we spoke, where you laid out a very clear roadmap for each of your businesses on CNBC-TV18. Before I get to the individual businesses, I want to understand from you the sense of confidence and optimism that you have with respect to the larger economy and each of your businesses today. We had the finance minister yesterday speak about the fact that the government has done all it can to try and get industry to do more, to invest more. Has the government been able to unleash the animal spirit, so to speak?
Well, thank you, Shireen, for having me once again. It's always a pleasure. Since we met last time, I think the confidence has grown a few notches in both our ability to implement what we had laid out, and that is largely because of what the government has done in terms of policy, in terms of environment, in terms of approach. I think this whole Modi vision of build for the world in India, and believe in yourself, believe in India, as an Indian, believe in what you're capable of. That confidence, that self-assurance, that backing that the government gives has been great. Not only for us at RPSG, but I think for the entire corporate India. And that's why you will see lots of corporates committing to large-scale capital expenditure, and of a kind that has never been committed. So since we met last year, I remember telling you that our target is a 2 lakh crore market cap. That we are now fairly confident of doing. Our internal targets have actually been scaled up since then, despite the stock markets not being at their best. And we had talked about investments. That number has gone up considerably. And as we move forward, the implementation part of each company, each project, each improvement is actually a lot more secure because A, we've made a very good start, and B, now we are that much more confident. So from a plan, it is now in action.
Well, let's put some numbers down then. As you pointed out, that internally you have decided to revise upwards a lot of the targets that you had spoken of. So from an investment point of view, from a capex point of view, what should we now expect given the sense of confidence that you just shared with us?
So over the next 5 years, what we are committing to is a total capex of about 1 lakh crores, largely in the energy area. It'll go also in chemicals, but chemicals is not that capex intensive, as you know. So renewables is going to be a large part of our investment. When we met last year, we talked of 3 gigawatts. Now 3.2 gigawatts is under implementation, advanced stages of implementation. Another 4 gigawatts is getting close to closure. And our target is to get to about 10 gigawatts over the next 6 years.
10 gigawatts by 6 years. So would it be fair to say that at this point in time, the renewable push is what is most exciting for you within the group? Of course, not to say that you're ignoring the rest of your businesses, but both in terms of investments as well as in terms of the kinds of bets that you intend to make, it's the renewable side of the business that will get the lion's share of the attention and resources.
Well, renewables is certainly something that's very attractive for us. And let me make an announcement today on CNBC-TV18. It's not only solar and wind hybrid projects that we are implementing. We propose to get into module and cell manufacturing. Our first gigawatt of module capacity goes on stream in the next 45 days. So that's something we've been quietly implementing. And in the next 3 years, there'll be 3 gigawatts of cell and 3 gigawatts of module capacity that will go on stream.
Well, thank you, A, for breaking the news here on CNBC TV18. So you heard it first right from Sanjiv Goenka on CNBC TV18. But, what will the benefits be on account of these bets that you're making? You just gave us an outline of what you expect over the next few years, both in terms of cell as well as the module. How do you see this benefiting your business and also the numbers for you going forward?
Well, one is that given the thrust we're doing on renewables, a large part of it will come into our own facilities. Mm-hmm. But the market for these products is growing. I mean, the more companies invest and the more self-reliant India becomes, the more cells and modules manufactured in India will get sold. So therefore, we do believe that there's a very good business model for that.
So from an export point of view, is that going to be something that you're looking at?
Yes, absolutely.
As well?
Absolutely.
I want to come back to the push on renewables and understand what it could potentially mean as far as your own bottom line is concerned in terms of cost savings, because you do intend to disproportionately move towards being able to use your own renewable energy.
So our target is to get about 45 to 50% of our total sold power sourced from renewables. And we will try and see that it largely comes from our own capacities. It's always not possible because sometimes, you have, not sometimes, you have to have tenders. And so it really depends upon how competitive we are. We're confident of being competitive, but at the end of the day, we have to be competitive. But the very fact that you can get from generating sources which are under your control gives you that much more security of supply. So I think there is a delta in the pricing between thermal and renewable. And regulatory commissions don't always give you your entitled fair return. And to that extent, this mitigates the need for tariff increases or the extent of tariff increases.
You still haven't left me with a number, the ballpark. What could it potentially mean in terms of savings as well as addition to the bottom line?
I think what it will do is huge cash flows, which will be additional. So in terms of the regulatory assets that the companies have accumulated, I think that could get liquidated very fast.
Well, speaking about the energy business, since we are talking about that, more states looking at privatizing. UP, of course, is the big one. The expectation is perhaps by the end of October, we should get done as far as the RFP is concerned. How aggressive do you intend to go after that market?
We are keen to get a share of that pie. We already operate in UP, in Greater Noida, and that's one of the most successful privatization cases of power in the private sector. And it is UP's most successful utility. So we have now begun to understand how to operate in UP. And Yogi Ji's government provides a very secure law and order, and so helps a utility for sure. Mm-hmm. We're keen, and we are going to bid.
You're keen, you're going to bid, but is there a preference on where you would find yourself best placed strategically? Because, of the 5 zones that the government is looking to bid out?
Yes, there is, but I'm not about to spell it out here. Okay. Not yet.
Not yet. Hopefully the next time
yes.
we meet. and there should be a decision. But that's as far as UP is concerned. What's the indication that you get from other states at this point in time in terms of their own privatization efforts?
I do get the impression that if the UP one happens fast, which it is likely to, there will be a couple of other states which will move in. In Maharashtra, you're already seeing applications for parallel licenses by Torrent, Tata, Adani. So I think this whole thing is moving, and it's moving reasonably fast. So you could see a couple of other states jumping into the fray before the end of the year, before the end of next year.
So let me.
The big conversation there with Sanjiv Goenka and the announcement that he, of course, made going into cell and module manufacturing, looking at exporting them as well. Some capacity about to come on stream in a few days from now. So the big announcement that Sanjiv Goenka made in that conversation with Shireen Bhan. Just pull up the module manufacturers as well just to see if there is a reaction to that. Vari Energies and Premier Energies, both of them were trading around or above the flat line as of now. There was no major reaction all through the morning in both of these names. Vari Energies has slipped off the highs of the day, though, is now nearing towards that flat line. And Premier Energies is the other one. Both of these companies recently listed, both of them into cells and module manufacturing. Premier with a completely domestic focused order book, Vari with some exposure to exports as well. So will be interesting to see if these have some reaction as the day goes by. But on to the big story of the day, and that is clearly the SEBI clean chit to the Adani Group in the Hindenburg case against some of their allegations and the rally that has followed the decisions. We are now being joined by Deven Choksi, the MD at DR Choksi FinServ, to take this conversation forward. Deven, good morning. Thank you for joining in. Now, with this, is it fair to say that matter has now been put to rest and that major overhang that laid over the entire group has now come to an end?
Yes, good morning. And a good breather too, frankly. I think the Indian regulator has already cleared the matter. Maybe I think in some other places, if this matter is still pending, they will take a cue from what Indian regulators have given them as clean chit. In my viewpoint, I think it's important to establish the integrity into the market. And that's what the regulator has done. A false allegation followed by, I think, a severe attack on the stock price and resulting into, I think, wealth erosion for investor is something which is not a healthy sign of a good market. And I think if this is initiating the entire integrity of the market, then in such situation, I think it's such a onus is on the regulator to act fast and I think give the verdict, which is what I think they have given in a reasonably good time. So all congratulations to the regulator as well in this process. And with an expectation that such kind of events, when an unregulated entity operating from other parts of the world, where Indian regulations do not have the teeth to go and nab. So such kind of entities, I think if they manipulate the market, I think the regulation should be made stronger so that repeat of such situation shouldn't happen. That's an expectation along with it.
Okay, we take that point, Deven. So out of the group, anything that you like in terms of listed names?
Yeah, absolutely, Sonal. The companies which are looking good within the group, certainly I think Adani Enterprise, which is incubating a lot of new businesses, and they are due for monetization over next 3 to 5 years from now. So obviously, I think the business like roads, the business like airports, the data center, even mining, which is a cash cow for Adani Enterprise. And along with that, I think the new energy business, which they are building in my viewpoint, I think each of these businesses are assuming significantly large amount of addressable market. And that's where they have the leadership. So we like the group more because I think they keep on building the infrastructure for each and every businesses. And in turn, this infrastructure generates significantly large amount of cash flow. Today, they have about 90,000 crore EBITDA on a trailing 12-month basis, which is growing at a speed of around 15 to 20% on a CAGR basis. So which is giving a good amount of visibility for growth going forward. And as long as I think they manage this entire growth without expanding the debt side of the balance sheet as much, today I think they're better off with 2.25 lakh crore kind of a debt on a 50,000 crore cash in the balance sheet and on a 90,000 crore EBITDA. So they're better off today. If that discipline continues, certainly I think some of these businesses are going to see a significant amount of value appreciation for investors in my viewpoint.
Deven, just hang on. The flash on a screen on Cohance Technologies, Rajesh Sharma has resigned as the CEO of the company. The stock has come off the highs of the day. That's the announcement that the company has just put out on the exchanges in a few minutes earlier. So that is one announcement from Cohance Technologies. Deven, you mentioned about Adani Enterprises. Other than that, we've already had some analysts also starting to warm up to some of the other group companies. We've had an initiation on Adani Power today. We've had a positive note coming in on Adani Green Energy as well. Is that the area you would want to look at, especially considering the government focus on green energy as well going forward, other than, of course, the main incubating business?
Yes, absolutely. In fact, I think each of these businesses are generating significantly large amount of cash, and that's a good point. If you look at port, I think a similar situation, expanded capacity of more than 500 million metric tons of cargo handling and covering the eastern western coast at the same time, along with some of the international ports for cargo handling. The power and power utility businesses both are looking brilliant. I think the generation of power from the conventional sources as well as from the renewable sources. And the companies like Green definitely remains in a formidable situation where they are actually operating the larger amount of capacity and will be operating larger amount of capacity. Even Adani Transmission or Energy Transmission, whatever you call it as, that company is significantly generating large amount of EBITDA as well. So yes, I think each of these businesses are really in a good shape, and we believe that I think the opportunity would still continue to be bigger going forward as well. So yeah, no denial on the aspect of, I think, selecting these companies in the portfolio.
Okay, we take that point, Deven. By the way, Cohance Technology has seen a sharp fall from the highs of the day. It is down 1.2% as we speak. The stock chart should come up for you on the screen. It has been an outperformer in industrial products company and has been doing well in terms of performance as well. With respect to the CEO, Mr. Rajesh Sharma, he has a background in accounting and finance for over 15 years, and he has previously held positions at companies like Siemens. There's Allegan Private Limited as well. And if we talk about Cohance Technology, the stock has done really well in last 6 months. It was around 4,500 rupees back in March, and now we are seeing levels of 7,200s already. So a big outperformance is what this particular stock has done. And look at that, 57% higher in last 6 months. And management change continues to be a big thing that the shareholders look out for as well. I remember when Naveen Florey and Mr. Radesh Welling resigned, the stock was down 20% that day itself. Today we have the CEO of Cohance Tech resigning, and the stock is down around 3% odd. So it is always the management, the CEO, which drives strategies for any company, which drives the future outlook for any company, and maybe this has come in as a disappointment, especially after the outperformance that the company and the stock price has seen as well.
Let's get a word in from Deven as well, if you can. Deven, you heard the announcement as well from Cohance. A CEO change, a sudden announcement like this, never a good sign. But considering the outperformance that the company has had, would you believe that this would just bring it back to some healthier valuations for people to enter into?
Let's wish for it. I guess I think whatever changes which are happening in the universe in respective companies, I think they should be seen as a healthy change. I don't think one should be negative about any change taking place. At the same time, be aware about few things, that if the companies are quoting at a reasonably premium valuations, I think they have very little chance to protect themselves from any negative news, and that's what I think some of these companies are getting victimized with. It's a signal to all the investors that when you give the premium valuation to businesses and the companies, be mindful of the situation that any negative news could possibly affect those valuations, in some cases very severely. No particular view on Cohance and the transaction which has happened, resignation transaction which has happened. I have no particular view at this point.
Yes, we take that point, Deven. Thank you so much for joining in with your views and thoughts on our big story and the stock as well. By the way, the resignation letter says that he's been with the company for 4 years, and of course, major milestones like listing were also covered in that journey. And in last 4 years, the revenues have grown from 421 crore rupees to as much as 2,700 crore rupees right now. Margins from 10% to 15%, and profit profits as well from around 10 crores to almost 300 crores. So yes, that's why it has come in as a disappointment, because he was a driver of that growth as well for the company. We'll discuss that in more detail, but we have to slip into a short break. When we come back, we'll discuss market technicals with Apur Sheth of Samco Securities and discuss the top trading bets. Welcome back. You're still tuned in to Trading Hour. The Midcap index has slipped into the red. The Nifty is lower by 115 points. But let's get a technical check on the markets. Apur Sheth of Samco Securities is joining us now. Apur, good morning. Thank you so much for joining in. If you can quickly tell us the next important levels to watch out for on the Nifty and any individual bets. You are on mute, Apur. Yeah.
Hello?
Yeah, I can hear you. Go ahead.
Yeah. So Nifty is currently in a no man's land kind of a position. So 25,500 and 25,700 is a major resistance for the market. And we would recommend to buy Nifty once it dips lower to around 25,150 levels with a stop loss of 25,000. So until that happens, we are on a sidelines. And two picks for the day are NMDC. The NMDC stock is breaking out of a falling trend line drawn from the April top. So the target for NMDC would be around 85 with a stop loss of 75. And even JSW Steel is also looking good. It has broken out of an ascending descending triangle pattern, and the target for JSW Steel would be 1200 with a stop loss of 1075. So globally as well as in India, metal stocks and metal and mining stocks are looking great, and that's why we have these two picks.
Apurva, thank you for sparing time and joining us today. By the way, flashes from Vodafone Idea on your screen. The Supreme Court has deferred the hearing of the petition for next week now. And the Supreme Court has observed that there has to be some finality to these proceedings. Remember, Vodafone Idea had filed yet another petition to reconsider the AGR dues, the additional AGR dues, of course. And that was listed for hearing for today. And now that has been deferred on to next week. The stock has now down around 0.25%. It's, of course, come off the highs of the day. And of course, we'll get Ashmit as soon as we can. And Tushar Mehta, the Solicitor General, also mentioning the fact that in light of the larger public interest, the government had also infused a 49% equity in the company. Of course, this was after converting a part of their dues into equity, which is when the government became the largest shareholder. But there have been clarifications that have come in from both the Telecom Minister, Jyotiraditya Scindia, as well as other officials from the department, mentioning the fact that there will be no further relief granted to Vodafone Idea. The government has done what it could have. They have no intentions of making Vodafone Idea into a PSU. And the government stake will stand where it is at 49%. So these are some...
There's another important point which our colleague Ashmit is reporting. The government is seen relaxing its position with respect to grant of relief because the government has told the Supreme Court, we are not opposing Vodafone Idea's plea. Some solution is required. Government is also an equity holder. As you were pointing out, 49% equity there. So, of course, there is some relief, not a relief, so to say, but they are relaxing their position as per the conversation which is coming in. Facts have changed between earlier petition and now, so a lot of updates coming in there, but some solution may be required is what Centre is telling the Supreme Court as well right now. But
and with that relaxation of sorts of what Ashmit is mentioning, that they are not opposed to their plea. Take a look at the stock as well. The stock is now moving higher. It had earlier come off and it was down to the lows of the day, but now it's moving higher by around 1.5%, reaching those levels of 8 rupees again is Vodafone Idea. 21% higher in the last 1 month. Of course, it has come off significantly. It trades well below its FPO price, the FPO that it had last year. The price was 11 rupees, so it trades well below that, and it also trades well below its 2024 peak as well, which was around 19 rupees. So some 3% higher on Vodafone Idea. Yes.
All right, that's about Vodafone Idea. Some relief which could come by 3% higher on that stock. But let's talk about the other big story, Kaynes Technology, where the CEO has resigned. Let's get in Jairam P. Sampath, who is the CFO of Kaynes Tech, joining us with more details on that. Mr. Sampath, good morning. Thank you so much for joining in. If you can explain the reasons for this resignation, because, you know, since the time the CEO has come on board, you've seen that massive listing, you've seen 12 times return to shareholders as well, the improvement in revenue and profits as well. What led to this resignation?
Yeah, I have Mr. Ramesh Kannan also, who is the other promoter.
See, he would like go back to Bangalore, and we are also expanding our company's senior management
cadre.
So he wants to go back to Bangalore, and then he has been discussing with us. He wants to move on and like that. So it is well planned, and then we have already brought in the various people, which you will come to know.
So was this in discussion for a while, or has this resignation come to you suddenly?
Discussion with me that he wants to move on to Bangalore, and that we would like to keep our headquarters here, and our major operations are in Mysore, so we would like to do that. So it has been friendly discussed and then well planned and done.
Sir, you mentioned your major operations lie in Mysore, and Mr. Sharma wants to move to Bangalore. And is that the only personal reason that has been cited as the reason for his departure?
Yes. Okay. Otherwise, we are only continuing with the movement.
So, since you said these conversations have been going on for a while, have you started scouting out for another CEO, or will it be somebody from the company itself, somebody who's worked for a long time and will be elevated to the position of CEO? Because the thing is, the stock saw a sharp decline when this news came. So, of course, the investors want clarity on what happens next to the CEO position now.
There will be one or two more senior people coming in. There will be one or two more people coming in who has been with me for a long time, and then some people who have been with me for last 1 year, say around 8-9 months, who has been working along with me to take this position.
So you are trying to say that you have two prospective candidates for the position of the next CEO, if we heard that correctly, sir?
No. I have one person who will be moved up and another person who will be coming along, has two senior position will be inducted into the...
So you already have somebody in mind for the position of CEO. He or she will be able to join from 1st of November, since 31st October is the last date for Mr. Sharma?
Your understanding is right.
All right. So you do have somebody who will be able to replace the current CEO. The last date for the current CEO is 31st of October, and 1st of November is when the new CEO joins as well. And the understanding that it is somebody who's been working with the company already, is that also correct?
You are right. He has been with me for the last 1 year, and he will be taking that position.
Okay.
So the conversations were on for the last year or so, and the succession planning was already in place. And now that the resignation has officially been announced, you already have a candidate in place to take over from the 1st of November, if we hear that correctly.
We have succession planning in all positions made in our company. So we have enough internal people who have been working as backup for everything.
Okay. We take that point. So, the other thing that, of course, the stock has done really well, 60% higher in last 6 months itself. And we have seen the capex plans come by as well. You've been talking about that big semicon opportunities that we are seeing, 1,500 crore revenues by FY28 as well. All of it is on track. The idea is that the growth plans that were set by the management, the top management, they continue to be on track as per earlier guidance.
Yeah, as per me, everything should be in track only. There is no problem at all.
Okay. All right. So the question is basically because we have seen that outperformance come by in terms of financials, the stock performance as well. This came as a bit of a negative development as far as shareholders are concerned, but the stock is seeing some recovery, as you've pointed out, that from 1st November, the new CEO will be joining in once the older CEO leaves as well. By when will you be putting out that name for the new person who will be joining as well as the CEO?
In another 2-3 days, it will come on.
Right. And all the opportunities for the semiconductor business that are in place, have you earmarked capex as well for this? Has there been any increase to your capex plans, sir, or do they stand as they are in terms of what they were earmarked for earlier?
We have to first complete the earlier earmarked capex. That itself will take 2-3 years before we can complete it and then fill in the factory before we can declare the new ones.
Okay. All right, sir, thank you so much for joining us. Yes, please continue.
CEO of our semicon is doing really well, and he is taking it into a good shape.
Okay. So, sir, when did he actually resign? I just wanted to understand the date. Is it yesterday that you got the resignation and you approved it today?
Yesterday evening.
Okay, yeah. But then why did you file it to the exchanges right now? Why wasn't it filed immediately?
Yesterday late evening, only late evening in the night only he has sent it.
No, of course. So you approved it in the morning, is it? You approved it right now?
Yeah.
Okay, all right. So the resignation came in late last night, and it was approved right now, and that is when the exchanges were notified as well of the resignation coming in from the current CEO. The stock, which was down around 4% at a point in time, has recovered. It's down 2.5% as well, but again, the management change is something that the street is a little nervous about. The management says they will announce the next candidate's name in 3 to 4 days. They have somebody in mind already. Thank you so much, gentlemen, for joining us today and giving us clarity on this management change, because usually that is something that impacts the shareholders' confidence as well. But they have assured somebody will join in from 1st of November, and there will be clarity on the name in next 3 to 4 days.
There was clarity in the fact that they mentioned that they already have someone in mind, and the succession plan was already being put in place. There were discussions that were going on, and over the next 2 to 3 days, we would know who would be the next CEO of Cohance Technologies, almost 2.75% lower.
I think the CEO of Cohance Tech currently is also online. So if you can hear us, just wanted to understand. Yeah, okay, all right. We will take a short break. We'll come back on the other side with more news and updates. Welcome back. You're still tuned into Trading Hour. Well, Vodafone Idea is the stock on our radar. If you've just tuned in, we have received some update on the AGR case where the government has told the Supreme Court they are not opposing Vodafone Idea's plea. Some solution is required, and government is also an equity holder of around 49%. This hearing has been deferred to some other day, but let's get in some reactions then. Vaibhav Kakkar, senior partner in Saraf and Partners, is joining us now. Mr. Kakkar, good morning. Thank you so much for joining in. What do you make of the tone coming in from the government? Do you think some relief could be on the cards? What do you make of the deferment that has come by when the Supreme Court is saying some more details would be required as well?
Yeah, hi, good morning. Thank you for having me on your show. Look, I think it's a step in the right direction. Still very early days, but, as most of the commentators were commenting that given the fact that government already owns 49% in the company, any demand which results in further wiping off companies' top line and bottom line would be viewed negatively by all stakeholders. And of course, the entire decision of the center to convert its debt into 49% equity was done in the backdrop of trying to ensure that there is a revival plan in place. While, of course, Vodafone seems to have certain grounds to challenge the demand from the DOT, that some of these bases of these demands are somewhat irrational. But be that as it may, I think government needs to figure a long-term solution. I think the Solicitor General's remark in the court that some solution has to be thought through, I think has been made in that light. So all in all, very early days, but still a positive direction given in the court. And one needs to see eventually what kind of solution is formulated. And certainly the fact that the government of India itself is owning 49% of this company will weigh in on any solution that is thought through for any additional demands that come through.
Right. Mr. Kakkar, fair to say that the ball now lies in the government's court because they have 49% equity at stake here. They have made it very, very clear that the Indian telecom industry has space for a three-player industry. So is it their prerogative now to find a solution? Because Vodafone Idea has made it very clear that if they don't get any relief, their ability to continue as a going concern beyond this financial year is under threat.
No, you're quite right that I think, overall government's policy is that, as it is, the sector is now consolidated down to three players, with MTNL pretty much becoming, MTNL and BSNL becoming redundant. In that backdrop, I think government does have a clear policy objective of ensuring that there are enough telecom players. But it's a bit of a give and take. It cannot be that whatever are legitimate dues of the government are completely given a go-by for that larger policy objective. There will have to be a balancing act in play. Perhaps, DOT will also need to revisit if all the demands are legitimate, if there is a middle ground that can be found, some additional deferments on some rightful claims of the DOT. I think a constructive solution in all lights will have to be thought through. Remember, the fact that government already owns 49%, there is no more wiggle room available for the government to convert any more of its dues into equity, lest it becomes a public sector company. So I think government has done whatever it could have. Any solutions on additional demands will have to be thought through creatively, taking into account already a limitation of not being able to go beyond 49.
Take that point, Mr. Kakkar. Thank you so much for joining in with your views. In fact, our colleague Ashmit is bringing us the latest. Any more updates that he's getting from this one? Ashmit, over to you.
Well, clearly this was a important matter, and what we are seeing is that there's a marked difference in the stance that this government appears to be taking, that the DOT appears to be taking. The similar petition came up in the month of May is when in fact Vodafone Idea had said that we'll go into insolvency, we'll desperately need help. At the time, the government stance was that either saying one thing or the other, not swaying either in favor or against, but in fact had left it to the wisdom of the Supreme Court. Supreme Court, as we all now know, had dismissed that application for relief. Now, however, there's a marked difference in the government's position. The government is squarely batting for some kind of indulgence, for some kind of solution. In fact, those were the words that came from the Solicitor General Tushar Mehta, appearing on behalf of the DOT. When being asked, there are previous decisions in this matter, the Solicitor General responded by saying that there's a change in context, there's a change in facts of the case as things stand. especially when it comes to relief that needs to be granted to Vodafone Idea, saying that there is a need for a solution. There is a need felt for the Supreme Court to grant an indulgence, that there is a need felt for some kind of resolution to this entire issue, and that, importantly, the government for the first time also saying that it is no longer simply the regulator or an oversight mechanism. The government is an active shareholder, has equity stake to the extent 49% being clarified here before the apex court. So a marked change in position from the DOT, from the government. The Supreme Court for now has deferred the hearing till next week. Next week, Friday, is when this case will come up once again, and that's when perhaps we'll begin to get some picture, some clarity on what solution, what resolution, what indulgence can be granted from the apex court, especially in light of this renewed position, renewed stance coming in from the DOT, from the government.
Right. Ashmit, thank you for putting things into perspective. Friday the 26th then is when we hear next from the Supreme Court on this Vodafone Idea case. Take your leave on this edition of Trading Hour. We leave you with the Nifty at 25,300. From Sonal and me, thank you for watching. Halftime report on the other side.
Frontline indices cool off even as midcaps pick up the baton. Utilities and energy gain while IT, financials and FMCG drag.
SEBI gives a clean chit to the Adani Group and its top executives on some allegations made by US short seller Hindenburg, finds no violation of laws, fraudulent practices, market manipulation or insider trading. Adani Group stocks perk up.
JSW Energy inks an agreement with Statkraft to buy its 150 megawatt hydro project for about 1728 crore rupees, taking its total capacity to 30.5 gigawatts ahead of its guidance. The company will also take over GE's boiler parts, making a business via a share swap.
India's Solicitor General tells the Supreme Court some solution may be needed on Vodafone Idea in the larger public interest, with government holding 49% stake. He adds that the facts have changed since the earlier petition and the Apex Court defers the hearing to next week.
Good afternoon. You're watching us here on Halftime Report on CNBC-TV18. I'm Mangala Malu, with me Vinny Motiwala. We come to you live from the CNBC-TV18 Motilal Oswal studio. It's a Friday and not a bad one would say. Yes, the Nifty is down about 134 points. The Nifty Bank down 324 points. But remember, behind us, we've put in 12 days of gains. From the lows, the Nifty has actually rallied about 1,000 points. And today's dip may just be that, a bit of a breather after a big rally that we've seen on the frontline index. The other thing that we're looking at is the broader markets. They're doing a lot better. So the mid-cap index is mildly in the green. And we have the small-cap index, which is doing a lot better as well. So when typically the broader markets outperform, the sense that the street gets is that dips are shallow. So maybe let's see whether at any point in time we will get this dip being bought into or not. Hi, Vinny.
Hi Mangalam, good afternoon. Absolutely a bit of a breather that we're seeing coming in, at least on the benchmark indices side. But some of these sectors that are doing well, let's pull up those PSU banks, right? Because Nifty PSU Bank is among the top sectoral gainers. So that's something that's managing to hold on to good gains in today's trading session. And among those names, let's watch out for some of these names that are coming up. Bank of Baroda, that's managing to hold on to gain. Bank of India, Canara Bank, Central Bank, all these PSUs are holding on to very good gains. And in terms of news flows also, we have a lot of moves that are coming in on the back of brokerage front or even on the back of news flow today. So on the brokerages, we have those Adani Power, which are a note from MS, but Adani Group stocks obviously have a different reason for buzzing in trade as well. So JSW Energy, that's another one that's buzzing on the back of brokerages. But a whole host of these other names that are buzzing in trade today. Vivek is here to give us the roundup on that front. Good afternoon, Vivek. And which are these stocks that today we're seeing a lot of move around?
Good afternoon, Vinny. Action-packed session, especially in terms of individual stocks. Quite a few stocks that are reacting quite sharply, both to news flow as well as brokerage upgrades. Well, first on the list has to be, the telecom names, both Vodafone Idea as well as Indostar. Remember, both of these stocks were under pressure, but since then have recovered very sharply post the deferment of the hearing and some positive commentary coming in as far as the council is concerned. The second stock on the radar is FDC, amongst the top gainer as far as the NSE 500 index is concerned, significantly higher volumes compared to its usual daily traded average. The other stock on the radar is Redington. This particular stock this week has seen a significant up move, the stock higher by over 6% today as well. Sammaan Capital, another stock from the broad end of the markets, amongst the top gainers as far as the F&O space is concerned. We'll wait and watch in case there's any development as far as Sammaan Capital is concerned as well. On the other hand, quite a few stocks are under a bit of pressure. Keynes Tech, important clarification on a channel just a few minutes ago. Despite that, the fact that the CEO has resigned has something that has led to a bit of selling pressure from the intraday high as well. Coromandel International, fertilizer stocks today under a bit of pressure. Coromandel down almost 4% now. Hospital stocks under a bit of pressure, seeing some selling from the high levels of both Fortis as well as Max Healthcare under a bit of pressure. And IT Pack, while not under significant pressure, all of them are seeing a bit of profit booking from the recent highs. So names like Coforge, HCL Tech, Infosys, all of them seeing a bit of selling pressure today.
Take that point, Vivek. Thanks a lot for that. You spoke about Keynes Tech. We had the management join us saying that they are looking for a replacement. In fact, they're sure they will announce the replacement CEO in the next couple of days. And on the back of that, the stock actually has seen a bit of a recovery from the lows as well. So that's a CNBC-TV18 impact. What we'll do is monitor the situation as it goes. But on the other side, we have an interesting lineup for you. We have Pratik Jhawar of Avendus Capital along with Ashish Rai of Orient Pro Solutions joining in on India's data center boom. What is the opportunity here? How can players actually benefit from this? And how, as investors, you benefit from it as well?
Welcome back to Halftime Report on CNBC-TV18. Now, what we're seeing in the recent time, and we're going to shift focus on that, is going to be India's data center boom. Factors such as low power cost, telecom dominance, and then we have data driven by AI, the development there. So what are the advantages for data centers? Where is India in this? To discuss this and more, we're joined by Prateek Jawahar, MD and Head of Infrastructure and Real Estate Investment Banking at Avendus Capital, as well as Ashish Rai, Group CEO of Orient Solutions as well. Ashish, as well as, Prateek, thank you so much for joining us on the show. This is a topic that, we've spoken in the last couple of years as well. But in the recent time, given the AI boom, power costs being cheaper, I mentioned all of that. And these factors will lead to a better growth is what everyone's assuming. Ashish, let me start with you. For Orient Solutions, or even as a sector, where are you all seeing yourself currently in this data center industry? How do you see yourself shaping up going forward, and what is the current revenue contribution that maybe comes in from this side?
Yeah, so look, it's a very important line for us, and we've talked about this before. I think we've been in the business for some time now. It's north of 15% of our revenue probably at the moment, something of that range. We don't declare the specific numbers publicly, so I won't get into that. Look, I think for us it's been a key demand driver. The business has grown at between 40 and 50% for the last 4 years. When we got into the business, I think it is the demand runway is fairly long. India has always been undercapacitized from a demand standpoint. So I think from data, for example, I think it's probably well known we generate almost 20% of global data demand, and the DC capacity is probably 3% or thereabouts, right? So I think there is a massive headroom to catch up on the demand. Plus, there is a lot of demand drivers in general in terms of, whether that's 5G, whether that's AI, that's payments volumes, the need for latency, and as you go into more AI inference, right? So there is a massive demand. We see the business growing fairly strongly over the next, I would say, 5-7 years. There is a significant investment coming in. The policy environment is good, and we've built out a very high quality business in terms of working with our strategic partners in building out capacity for them, right? So I think we see a pretty strong runway ahead.
You see a pretty strong runway ahead, Prateek. Ashish, actually one more follow-up to you. I just want to understand what would be the percent of growth now you expect to see, right? Industry is expecting around a 40-43% growth globally in terms of AI market. Do you think that would also lead to a similar boom coming in here in this sector? And are you open to more tie-ups? Because OpenAI is also talking about data centers here as well. So are you in touch with any global players? Are you looking at tie-ups now?
Yeah, so look, especially when it comes to AI compute, I think there's a lot of conversations, and depending on where it is, we got some global tie-ups as well, and they're sort of partnerships that we'll announce from time to time. It's like, I think as right now, if you look at AI compute specifically, there's probably 70-80% of the compute is still training workloads, right? But as sort of inference workloads increase, you will need a lot more capacity closer to the end user, which means you'll need to see a lot more capacity come on stream in India, which is actually probably, one of the largest bases of user bases around, right? I mean, for OpenAI or for anyone else for that matter, right? So I think there would be a significant demand for compute coming in if you're talking AI compute specifically, but even otherwise, given the undercapacity, there is a lot of interest in global players coming in anyways.
Right. All right, Ashish, just hang in there. We'll invite Prateek as well, and we'll come to you in just a bit. But Prateek, the facts are all there for everyone to see. 2024, the capacity was 42 gigawatts. 2027 expected to be 70 gigawatts. By 2030, go to 100 gigawatts. India accounts for just 3% global data center capacity, while it owns or consumes 20% of the global mobile data. What investors would like to know from here on is, where will the returns come? If one has to play the data center capacity or the data center business, the returns would be maximum where? At the operator level, at the high-tech cooling level, the racks, the power systems providers. Which part of the value chain will a lot of this be captured in?
No, thank you. Let me come in. I hope I'm audible.
Yeah.
So the interesting part is, see, there's an ecosystem built out which is happening, right? India is frankly, in a percentage terms, we are around 3% as you're talking about the global data center capacity. But predominantly, almost 70% of the capacity today for data centers is in the US and China. The global capacities are catching up. From an India perspective, whatever we have built till now was for domestic demand by domestic players. There has been interest from global investors, global operators who want to kind of come in and set up capacities, which was being driven by local enterprise requirements, mostly driven by data sovereignty, which we've been talking about. But the bigger change which we are going to see now, and whatever projections which we are looking from an India perspective are going to be driven by the AI-led demand, and how much of that workload is going to kind of shift to India. I think the point is that, as Ashish was rightly mentioning, that we have almost 20% of data generation or data consumption happening in this country today, whereas we have a capacity of around 3%. Most of our data is being stored outside India. So our first bit is like you have enough latent requirement which will kind of shift in, which will give an impetus to kind of put out that capacity from a developer operator perspective. You have to invest almost around 6-7 million for a gigawatt. 600 million goes for a gigawatt capacity, which kind of goes in. So the amount of capital which is required is going to be divided into three segments. The way, say, an IT services business got built over, say, 3 decades, there is a segment of real estate developers who went ahead and kind of built out cold and shell. There are operators who are building up capacities, which is almost 4x the capex which is required over and above the operators, and then obviously the operators and implementation partners or the IT services companies, which kind of comes in play. So from a money-making perspective, if we are talking about, there is going to be a huge amount of capacities which is going to get implemented. And we're talking about a growth in India, the requirement is going to be around, say, 25 billion just to kind of set out this capacity to meet the requirement which is being envisaged. Which is going to be driven by the AI-led demand. I'm talking about the real estate and implementation part of it. So the entire value chain is going to get created locally. We see that probably when it comes to kind of setting up data centers, it's going to be the global operators who have the relationship with hyperscalers, are the ones who will probably take up the lion's share of capacity built out. They have the probably access to the lowest cost of capital as well. So the data center capacity will be consolidated or concentrated with large developers, operators. However, the entire value chain play is going to get established locally. So when you're talking about the cooling solutions, the power solutions, which are going to kind of be given out, the equipment manufacturing. So all of this is going to get benefited out of this entire expansions which are being planned over next, say, or requirements which are coming over next, say, 10 years.
Pradeep, good afternoon. What I also want to understand, now, while you're saying, you know, most of India's data currently is also outside, right? So first we'll meet our own domestic data point of view and get all our data back to India, and then for the global level. How much capacity, are we actually going in the right direction? Is this enough in terms of what the government is providing, or the capex story that you hear on ground? Is it enough, or much more is still required to actually reach at the global level or compete maybe with global countries like Singapore and Malaysia, which are ahead in terms of us?
Frankly, I think Singapore is not the right comparison. They are not competitive. Most of the Singapore's data is also stored outside Singapore. They're expensive. I think one of the key components which kind of makes a difference in data centers creation has been power requirement, and government is doing all their bit, including now obviously the taxation reforms which has come in place to kind of give a benefit to the developers to kind of come and set up data centers in India. There has been works which are happening on the infrastructure layout as well, which means providing data center parks, which is going to kind of make sure that you have the efficient supply of power, green power for the which is going to be available at a decent cost. So that it is the, I think, going to be the drivers which we are seeing going to make shift in India. Lot of large developers and data center operators are looking at India, are looking for opportunities to kind of build out in India. Hyperscalers till now have been kind of consuming or storing data in India basis the need and whatever is minimal required. I think that shift which is happening from the government to kind of bring the data sovereignty and kind of really store more data in India and locally in the local markets, I think that's going to give the boost for sure. Further, I think it will all depend on the economics and the way, the quality of efficiency of the infrastructure which gets created will drive out India as a preferred partner for maybe storing not only data for India, but maybe become one of the global centers for developers to kind of make it a place where they kind of store more data.
You've laid it out for us. Let's go back to Ashish and ask him. Ashish, from an Orion Pro Solutions standpoint, how much revenue comes in from data centers right now? How much do you expect it to go over the next 3 to 5 years? And where does that place you when it comes to peers?
Yeah, so look, we run one of the top sort of design and program management outfits out there. We work with strategic partners in terms of really designing, especially the complex data centers. I believe, we are one of the stronger players around. The business is meaningful for us. Something between 15% plus of the revenue now, been growing at 40-50% for the last 5 years since we've been there. A lot of very strong strategic partnerships. We're getting into a number of international partnerships now in terms of really bringing both our IP as well as partners' IP into the game. So I think we'll be one of the strong contenders as the business grows overall. Really, there is space for a large number of players to exist within the ecosystem. I think there is a significant headroom for growth in the business, given the sheer scale of investments that need to come in. And that's just to service Indian demand, right? So I know there is this conversation around India becoming the sort of center for the world. But I think at the moment, we are like so severely undercapacitized, and there is just very strong policy push, localization push in terms of both RBI, SEBI, etc. So as long as the local regulators are supportive, I think the domestic demand itself is fairly significant to drive growth for a fairly long time, and we intend to be one of the top players in this game in terms of helping our partners.
So this 15% goes where in the next 3 to 5 years?
Look, as a business, we've been growing at 30% plus overall. Anyways, we are one of the very few tech firms which have been growing at that rate. So I think the rest of the business will also keep on growing. I would not really give an overall percentage share, but I think it's been climbing up the last few years, and it will probably climb up a bit more.
Okay, Ashish as well as Prateek, we'll leave it there. Thank you so much for joining us, explaining us where this global data center boom is actually going to go, where India is placed in this story as well right now. Thank you so much for joining us on the show and giving us more details on this front. But on that note, we're going to slip into a very short break. Don't go anywhere. Ajit Mishra of Relicare Broking will join us with trading strategies after the break.
Welcome back to Halftime Report on CNBC-TV18. As of now, Nifty 25,298 is what the Nifty is at. A 126-point downtick is what we're seeing for the Nifty, 0.5% down. But what's happening in the world of F&O? Mangalam is at the F&O desk to give us all those details. Mangalam, over to you.
Well, if you look at all the action in the F&O desk, it's a little about unwinding of some of the positions, maybe a bit of profit booking, but largely nothing really to worry about. Why do I say that? Because the Nifty and the Nifty Bank, they are underperforming after 12 days of outperformance. We have the mid-cap and the broader indices, the small cap index, both of them are actually doing a lot better. And yesterday we had made that point that, the India VIX may be pricing in complacency. So for the market to move higher and make further uproom, the India VIX has to spike. So the India VIX is now back in double digits, and that's a positive. That's not a negative because it's still contained, but it's not pricing in complacency anymore. So that's a positive. The other thing that we're looking at, where the Nifty is right now, the 400 mark or 300 mark, all of that depends on whether the Nifty Bank towards the end closes above the 50 and the 100-day moving average or not. Because it's captured that after a 1,000-point rally, maybe today it's testing the lower end of that range. It's slightly below that. Closing above 50 and 100-day moving average for the Nifty Bank will be extremely crucial. Now that brings us to the levels. 25,400 call writers are fairly active. 25,500 was already a psychological support, a congestion zone for the frontline index. So the 25,400 call has a premium of 50 rupees. So roughly 25,450 to 25,500 is where we are likely to see some bit of supply. But at lower levels, the level where we are right now, 25,300 is extremely crucial because those put writers haven't unbound their positions. In fact, 25,300 put still has a premium for almost 60-65 rupees, telling you around 25,250 we will see support for the frontline index. Were the index to break the 25,250 mark, then these guys will have to unwind their positions and perhaps we see a deeper gash. But nothing in the data suggests that that would happen right now. Why do I say that? Because a broader swathe of stocks are all doing very well and they are fairly well bid. Case in point, look at the Adani Group stocks, the relief that is coming from the SEBI, Adani and Adani Green, Adani Energy Solutions, all of them up between 4 to 5%, and all of them seeing a lot of long positions being added. And just as we speak, a bunch of other stocks also in the green. So we will watch out for whether this dip that we got in the first half of today will be undone in the second half or not.
Absolutely, Mangalam. We'll be keeping an eye on that one. But on that note, let's also bring on board now Ajit Mishra of Religare Broking, joining us on the show now to talk to us about the technicals. What are we keeping an eye out on as well? Ajit, good afternoon. Mangalam has given us some levels that we should be keeping an eye out on, right? 25,250, I believe that was one of the levels he mentioned, right? That's going to be important. But today, instead of seeing an up move, if we see the downside, then how much of a worry does that become for the Nifty? And what are the levels of the Bank Nifty as well?
Yeah, good afternoon, Vinny. So yes, what Mangalam have shared according to the derivative data, it's aligned with what we are seeing on charts as well. Means if you see, we are in the third week of rise when it comes to the Nifty index. We have just surpassed the August month highs around 25,150 levels, and since then we are seeing this momentum continuing. But we have a trend line hurdle at 25,500 mark, and almost we have tested that area in yesterday's trade. It's a normal profit taking and consolidation so far, and the previous swing highs would continue to act as a support area. So 25,150 to 50 would be the zone where one should look for buying opportunities. So it's a buy and dip market, but yes, to surpass this 25,500 hurdle, we need further support from the banking index. So for banking, 56,000 is a critical hurdle. So once we surpass that, because today we are seeing that the private banking measures are slightly on the back foot. Maybe it could be due to this FTSE rebalancing. But the PSU banking pack, they are still holding strong. So for banking index, we believe that 54,900, 55,000 will continue to act as a strong support area. At the same time, stock-specific opportunity, Vinny, is something that one should be focusing on because consolidation after 3 weeks of rise is completely normal.
Okay, and what are the stock opportunities or trading strategies you are looking at, Ajit?
Right, so the first recommendation from the pharma space, because defensive, they were slightly on the back foot and started seeing fresh traction in some of these names. So Dr. Reddy's from the pharma basket is something that we like. The stock has just moved out of from a consolidation range. And 1380 is what we are eyeing as an immediate target. So with stop at 1290, one can go long in Dr. Reddy's at current levels. Then from the PSU banking basket, SBI the leader, almost like 3-4 months of consolidation, which has finally ended with a strong breakout, price action, volumes, everything is confirming the trend. So we expect a newer high in days to come. 910 is what we are eyeing as an immediate target. So with stop at 840, one can accumulate SBI also at current levels.
Okay, Ajit, thank you so much for that and joining us, giving us individual stock names, what we should keep an eye out on the Nifty as well as the Bank Nifty. On that note, time for a very short break. On the other side, Manisha Gupta will join us, and along with her will be Kishore of Motilal Oswal Commodities side to talk to us about the world of commodities. Stay tuned in.
Welcome back, and joining us on the show now is Kishore Nane. He's Director Head Commodities at Motilal Oswal. Kishore, hi, thank you so much for joining in. I want to start with gold first because we saw a huge build-up ahead of that US Fed meeting, and since then it has been nearly $60 or so of a decline already in the prices. I remember you telling us that this perhaps is not a great time to buy, but now since the event is done with and some fair, vague guidance perhaps for the future on how the rate cut scenario will emerge, how are you looking at, one, the rate cut scenario, two, the dollar index moves from here, and three, the the gold prices itself?
Manisha, the overall background picture which is brewing right now is basically is an average worker in a position to keep negotiating a salary rise or a maybe wage hike at this point of time. So if that's not the case, as the labor market has slowed down considerably, probably the people would like to actually, the average hourly earnings would start to fall. So that to some extent will give cushion for Fed inflation may not be rising as quickly as it was anticipating, number one. Number two, the tariff impact on the inflation numbers, especially on the consumer spending and core inflation, is not immediately evident. So actually, it is what we are terming it as not a dovish, but it's a hawkish cut. So the term hawkish cut is basically the Fed remains to be hawkish. It's not actually still not worried about the inflation spike. It is still have that worry. So keeping that worry in the background, the rate cut has been announced under current circumstances. So the speed of the rate cut cycle is what the markets are trying to rethink, reprice into the markets. That's where actually some of these corrections came. And as we already discussed, that 25 bips rate cut was already discounted in the markets well ahead of the meeting itself. So the disappointment to some extent is that some of the people who might be anticipating a 50 basis point rate cut has unwound their positions and all, but this is a temporary blip. And again, I was warning that if anybody who is investing in current levels in either gold and silver should be and must be prepared for these kind of short-term price corrections. So long and medium term looks bright. There is absolutely no doubt in that, but short-term volatility is expected to continue.
How are you looking at the dollar index from here on, and what are your targets for gold, let's say 6 to 8 months from now?
6 to 8 months is little difficult. Again, 12 to 18 months, we're looking at around 25 to 30%. Again, the 30% mark is where you start from. So if you're looking at 3,400, 3,500 as a starting point, that will take you to around 4,200 to 4,500 mark. Again, 18 months is a trajectory because what we anticipate is that the impact of tariffs could be more evident in second half of 2026 calendar year, as most of the trade deals will be done and whatever the impact will be done. And also there is a lot of you all have to remember that before the tariffs have been announced, actually a lot of leeway was given and a lot of time was given. So there are a lot of upfronting of imports happened in that case. So there was a huge amount of imports went into US before the tariffs kicked in actually. So those will actually cushion out these inflationary pressures to some extent. But by the time of end of 2025 and early 2026, when you actually consume these inventories and actually you start to placing new orders, that's where actually this will kick up. So keeping that in mind, so dollar index should be around 96.5 to 98.5. That's what the range which I'm looking at next 2 months or so. And for the gold, probably anything close to 3,400, 3,500 is a good level or a better level to enter.
For a target of 42 to 4,500, as you said, in the next 12 to 18 months.
Yes.
All right. How are you also looking at silver then? Because this is an area where also we have seen some profit taking. $40 an ounce holding at this point in time, but would it continue to hold? And if yes, then what kind of levels here as well?
See, downside could extend to 37, 38. Again, 10% in silver is not a big deal. So 37, 38 is possible. So that's around $3-4 downside. And upside, actually, we have reiterated and revised our targets to around 50 and 52, depending on the trajectory. But the direction keeps to be going up. And again, we all know that fundamentally, as a commodity, if you remove the monetary aspect of or the precious metal aspect of silver, as a basic commodity, it has much stronger fundamentals in play. So that actually keeps pushing silver also up. But again, because this is a larger volatility metal, and so probably you should be prepared for a 10% downside at any point of time. So anything close to 37 is a good entry for a medium to long term investor, and the upside could be anywhere between 47 to 50, which can extend to around $52.
Kishore, a lot of people would be looking around to buying because now this asset class seems to be getting mainstream, and a lot of people who were not buying it earlier perhaps also want to have a piece of that pie. What is your recommendation for, let's say, slightly longer term if people are buying at the levels that you are advocating on the lower side from here? The next 3 to 4 years, is that a great time to be in gold and silver? What kind of your portfolio should be parked there?
See, Manisha, I think as an analyst, as a commodity analyst, once we actually look at the large price cycles, actually, after almost a decade of kind of a sideways movement, if you ignore gold and silver for a moment, most of the other commodities like base metals, energy have been in a tight range despite a lot of geopolitical issues and all. So I think I'm a firm believer at this point of time for the next 7-8 years, that larger cycle, the commodity super cycle is going to start and it's going to kick out. I think there's a lot of talk around the global investor community, as well as a lot of hedge funds, etc., that the allocations towards commodities have to increase, and there are a lot of under investment in these sectors, both on the mining side, both on the smelting and refining side. At the end of the day, even the investment portfolio size also has been much lesser after, if you remember, after the European crisis and the banking reforms, globally, the exposure of the banks and hedge funds have gone down in commodities. So now we're looking at minuscule amount. So even if the percentage wise, it could double easily in the next 2-3 years. So that actually could kickstart this mega commodity cycle. So if we start to believe that, probably you have to believe in 2 or 3 major commodities. One is copper, nickel, of course, gold and silver will be leading from the front. So the overall allocation has to be in absolutely, if you don't really like commodities, you should have another 5% or so. But if you're it's a little bit of risk averse, and probably you're better off, and you're not that into debt or fixed income kind of side, probably can go up to around 15 to 20% of your portfolio into commodities and commodities related assets as well.
All right, so mega super cycle coming in for commodities. Next 7 to 8 years do belong to commodities, and gold and silver could lead from the front. Kishore, as always, thank you so much for making us, joining in and making us, taking us through those commodity cues as well. But with that, that's all the time that we have on this segment. We go for a short break. We'll come back and get you more on markets and stock specifics.
Welcome back. You're watching us here on Halftime Report. Meanwhile, just keep an eye out on a bunch of stocks which are surging. The Adani Group stocks, they found a fresh lease of life once again. They opened fairly well. Thereafter, there was some moderation. And now as we speak, Adani Total Gas, we have Adani Energy Solutions, Adani Green, all of them. The intraday charts come up for you on the screen, and that tells you that there's been a big up move that we're seeing. The other big up move that is being seen is on Vodafone Idea as well. Remember, Supreme Court has deferred the hearing. But now what we understand, and Ashmit has been telling us, the government is, or rather the court has taken the cognizance of government's ownership in the company as well, and perhaps given it a little more in terms of understanding than anything else. Obviously, it does not speak on the quality of the judgment that may happen a week later, but this is something that the street believes could be a slightly more compromising position that has come in from the Supreme Court. As Ashmit has been telling us, the stock higher in double digits, 10.5%. on the counter. Meanwhile, Graphite India too has acquired nearly 7% stake in a US-based company for 170 crores. That stock too spiking higher. Let's put the spotlight on Cohance now. The stock was in focus yesterday amid a block deal which saw Advent sell stake in the company. We spoke with the executive chairman Vivek Sharma on the stake sale by the private equity and more importantly, the Indian CDMO space as well. Let's listen in to a slice of that conversation.
Advent still remains after the sale as our key anchor shareholder. After the sale, they are at 57.5%. The intent of the sale was to broaden the investor base by bringing in top quality institutions. And importantly, Advent has chosen a longer term lock-in, which reflects their stronger conviction in the business. So I would view this as a positive, trend. The strong demand from institution highlights a strong conviction in the business and the management team. Generally, my observation, meeting with customers, meeting with other key holders, is that listen, the damage is done. People are looking at as an alternate to really have a backup and then move out of China if that is part of their supply chain. We are seeing improvement and we are seeing RFPs that are coming now that were not there before, and they're in larger quantities, compared to what it used to be before. We are seeing more visits from customer to evaluate our sites and capabilities. So trend-wise, I am seeing traction there. In pharma, it's a very sticky supply chain. It takes time for it to materialize. I can also tell you in my interactions with customers in the US and other places, depending on companies' strategy, there are companies that have a China-free strategy. So people are looking for opportunities to really de-risk their supply chain from China wherever it makes sense, and we are seeing traction in that space.
Buddy.
Welcome back to Halftime Report on CNBC-TV18. As of now, Nifty is at 25,300, where we approximately started the show with. That's where the Nifty is trading at. But broader end of the market, that continues to do better than the benchmark indices even as of now. So that is what we'll be keeping an eye out on in the second half of the trading session as well. But with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next to Business Lunch.
Markets continue to hover near the lowest point of the day. The midcaps rally also fades after the first half of the session. Utilities and energy are outperforming, while IT and financials along with FMCG leads the indices lower.
SEBI gives a clean chit to the Adani Group and its top executives on some allegations made by US short seller Hindenburg. Finds no violation of laws, fraudulent practices, market manipulation or insider trading. Adani Group stocks perk up in trade.
JSW Energy inks an agreement with Statkraft to buy its 150 megawatt hydro project for 1,728 crore, taking its total capacity to 30.5 gigawatts ahead of its guidance. The company will also take over GE's boiler parts making business via a share swap.
India's Solicitor General tells the Supreme Court some solution may be needed on Vodafone Idea in the larger public interest, with government holding 49% stake. He adds that the facts have changed since the earlier petition. The apex court defers the hearing to next week.
It's the final 2.5 hours of what has been an action-packed week for our markets, and we are here to bring you business lunch on CNBC TV18. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me, as always, is Vamakshi Thoria. Vamakshi, good afternoon. Well, the bulls were looking to end the week on a high. That does not appear to be the case, but right now they are trying to defend some very important levels.
Absolutely, Hormuz. Absolutely not the Friday the bulls were hoping for, and of course, it's been an absolutely action-packed week, and in fact an action-packed day for you as well. But for now the Nifty is trading lower, down almost 108 points, and that move on the Nifty is largely being driven by the IT pack as well as the banks. If you take a look at some of the top laggards for the Nifty, ICICI Bank tops that list. 40 points lower is what the contribution has come in from there. Infosys is also around 1% lower. HDFC Bank, Kotak Mahindra Bank, HCL Tech are some of the stocks that are pulling the index lower in trade today. But when we look at the midcap end of the market, that is doing slightly better because the midcap index is actually in the green, up almost 0.1%. When you look at the advanced decline ratio as well, largely in favor of the declines, but it is mostly 1:1. Now, apart from that, as far as some PSU banks are concerned, on the flip side, they continue to do well. Union Bank is up almost 3%. UCO Bank is up 2.4%. Canara Bank is up almost over 2%. So the PSU part of the banking space continues to do well in trade today, Hormuz.
Indeed, and there are a lot of movers. Although broader markets have cooled off from the highs, you can't take away from the fact that there is a lot of stock-specific activity that is taking place. There are a couple of names that I wanted to highlight. Reddington is one of them, and of course, we've all seen the visuals of the of the Apple iPhone 17 launch in the city. 6% higher for Reddington. Aditya Vision is the other one, and Electronic Smart. These are the three names that have been buzzing. Reddington, of course, being one of the top suppliers for Apple in the country. So that stock has moved. The stock had moved 20% higher earlier in the week as well. So almost 4% higher for Electronic Smart, and Aditya Vision as well doing fairly well for itself in today's trade. But of course, the big talking point of today has been the Adani Group stocks. They pull up Adani Power at one point, had continued to trade around that 7% mark, and it's now trading with gains of around 12.5%. Adani Enterprises has moved to the highest point of the day. Adani Ports is starting to build on to those gains as well. So the Adani Group is doing fairly well for itself in today's session, and that is after market regulator SEBI cleared the Adani Group firms, Adani Ports, Adani Power and Enterprises of all Hindenburg allegations. Yash is joining in with more details on this. Yash.
Well, it is very important to note that this is not an interim order from market regulator SEBI, but a final order from SEBI, which comes as a huge relief for, of course, the Adani Group and its chairman, Mr. Gautam Adani, and this relates to the allegations which are leveled by Hindenburg Research. Essentially, market regulator SEBI, in its order, has cleared Adani Group and its chairman, Mr. Gautam Adani, of all allegations which were leveled by the US-based short seller Hindenburg Research. Essentially, these allegations were primarily around two important points. One was siphoning of funds, and the second part around the allegations was about hiding related party transactions. Now, SEBI came out with two separate orders. In the first one, the SEBI has said that the regulator has found no violations with respect to the related party transactions. They've said that nothing at the time when these transactions were undertaken with unrelated parties, these parties did not qualify as related party dealings because the definition of that was amended in the year 2021 itself. SEBI also noted that the loans which were passed on were repaid with the interest that they carried, and hence there was no siphoning of funds, and hence there was no fraud or any unfair trade practice. Accordingly, with the verdict on these two investigations, SEBI has dropped all proceedings against Adani Group as well as its chairman Gautam Adani. Just a quick context, if you remember, in January of 2021, Hindenburg Research had alleged that Adani Group used three companies, Adhicorp Enterprises, Milestone Trade Links and Rehvar Infrastructure, as conduits to route money between the Adani Group firms.
Absolutely, Yash. Thank you so much for bringing us all of those details. That explains why all of these Adani Group stocks are flying high in trade today. In fact, some of them are perched at multi-month highs. Now, the other stock that we can't take our eye off is Vodafone Idea. Now, in another big development in corporate India, the Supreme Court has deferred the hearing in Vodafone Idea AGR dues case to September 26th. And my colleague Ashmit is joining us for more on this. Ashmit?
Well, a hugely important day as far as Vodafone Idea is concerned, especially in light of Supreme Court proceedings. Now, bear in mind, there are multiple petitions that had been filed earlier, review, curative, modification. All of them were dismissed. In the month of May, there was a fresh petition filed once again. And at the time, the stance of the government was that it was neither in for or against any relief to be granted, had left it to the wisdom of the Supreme Court. As we all now know, the Supreme Court had rejected that earlier petition. Now, there appears to be a dramatic change in stance by the government. The government now saying that the facts on the ground have changed. The Solicitor General Tushar Mehta appearing on behalf of DOT, on behalf of the government, saying that there is a need felt for support. There is a need felt for the court to grant its indulgence. Basically saying that the situation has changed. We want the Supreme Court to intervene and help with a possible solution, a possible resolution to this issue. Bear in mind, this is a petition where the Vodafone Idea has said once again that the AGR burden is too much for us. It will impact the very existence of the company. And now it seems the government siding with Vodafone Idea, saying that we're stakeholders here. In fact, at one point, Tushar Mehta also highlighted how the government is an equity shareholder to the extent of 49%. So essentially, the message being that facts have changed on the ground. Now the government's fresh stance is we want the Supreme Court to help with a possible solution to the Vodafone Idea issue. This hearing will resume once again. That's next week, Friday of next week.
Well, Friday the 13th, Friday the 26th. We'll keep an eye out on both of that. Ashmit, thank you for that update on the Vodafone Idea. The stock doing well, though. At one point was up 10-11%, still holding on to gains of around 8.5%. Putting the spotlight now on Cohance. The stock was in focus yesterday after a block deal which saw Advent sell stake in the company. We spoke to the executive chairman, Vivek Sharma, on Advent's stake sale and on the opportunities in the CDMO space. Listen to a slice of that conversation.
Advent still remains after the sale as our key anchor shareholder. After the sale, they are at 57.5%. The intent of the sale was to broaden the investor base by bringing in top quality institutions. And importantly, Advent has chosen a longer term lock-in, which reflects their stronger conviction in the business. So I would view this as a positive, trend. The strong demand from institution highlights a strong conviction in the business and the management team. Generally, my observation, meeting with customers, meeting with other key holders, is that listen, the damage is done. People are looking at as an alternate to really have a backup and then move out of China if that is part of their supply chain. We are seeing improvement, and we are seeing RFPs that are coming now that were not there before, and they're in larger quantities, compared to what it used to be before. We are seeing more visits from customer to evaluate our sites and capabilities. So trend-wise, I am seeing traction there. In pharma, it's a very sticky supply chain. It takes time for it to materialize. I can also tell you in my interactions with customers in the US and other places, depending on companies' strategy, there are companies that have a China-free strategy. So people are looking for opportunities to really de-risk their supply chain from China wherever it makes sense, and we are seeing traction in that space.
Well, that was the management of Cohance Life Sciences. But Keynes Tech, that stock was trading under pressure after it announced the resignation of its CEO. But we also caught up with the CFO, Jairam Sampath, and he told us what lies ahead for the company. And after that, we saw a brief recovery in the stock. So let's listen in to what he had to say.
Discussion with me that he wants to move on to Bangalore, and that we would like to keep our headquarters here, and our major operations are in Mysore, so we would like to do that. So it has been friendly discussed and then well planned and done. There will be one or two more senior people coming in. There will be one or two more people coming in who has been with me for a long time, and then some people who have been with me for last 1 year, say around 8-9 months, who has been working along with me. to take this position. So we have enough internal people who have been working as backup for everything. In another 2-3 days, it will come on.
Recovering from the lows of the day is Kaynes Technologies, almost a 6% slide from the highs, and is now trading with losses of just around 1.5%. Now, from Hindenburg to another short seller, Viceroy, a bench of the Supreme Court has recused itself from hearing a PIL listed on the 8th of September seeking investigation into Viceroy's allegations against Vedanta. Now, the Supreme Court has also directed for the PIL to be listed before a different bench.
Well, earlier today, Sanjiv Goenka, who's the chairman of RPSG Group, spoke to Shireen Ban about the group's big capex push, growing renewable energy, ambitions, and much more. Listen in to that.
For the next 5 years, what we are committing to is a total capex of about 1 lakh crores, largely in the energy area. It'll go also in chemicals, but chemicals is not that capex intensive, as you know. So renewables is going to be a large part of our investment. And let me make an announcement today on CNBC-TV18. It's not only solar and wind hybrid projects that we are implementing. We propose to get into module and cell manufacturing. Our first gigawatt of module capacity goes on stream in the next 45 days. So that's something we've been quietly implementing. And in the next 3 years, there'll be 3 gigawatts of cell and 3 gigawatts of module capacity that will go on stream. We're keen to get a share of that pie. We already operate in UP, in Greater Noida, and that's one of the most successful privatization cases of power in the private sector. And it is UP's most successful utility. So we have now begun to understand how to operate in UP. And Yogi Ji's government provides a very secure law and order, and so helps a utility for sure. Mm-hmm. We're keen, and we are going to bid.
All right, let's slip into a very short break then. More news and updates follow on the other side, so stay tuned.
Welcome back. Now, the United States has revoked its sanction waiver on Iran's Chabahar Port, something which could have implications for Indian interests in the region. Now, what has actually happened is that there were waivers granted to the sanctions by the US in 2018 for that Chabahar Port in Iran. And the decision will take effect from the 29th of September. And the sanction exemptions. Now, this exemption revocation is part of the US's strategy to impose maximum pressure on Iran. Now, why is the Chabahar Port or the waiver, why was it important? Now, this was granted during Trump 1.0, the first term of Donald Trump's regime as president, and in 2018. And this was under the Iran Freedom and Counter-Proliferation Act, and it allowed India and other countries to develop the Chabahar Port. Now, where is the port located? The port is located in southeast Iran and has two separate ports, which are known as Shahid Kalantri and Shahid Beheshti. And why it is also geopolitically important is because it's very close to the Gwadar port in Pakistan, where China has a lot of influence. Now, it acts, the significance of the Chabahar port is the fact that it acts as a gateway for India towards Central Asia and to Afghanistan, and it also acts as a counterbalance to China's influence on the Gwadar port. Now, this was first planned in 2003 that India will develop the Shahid Beheshti terminal of the Chabahar port, but that could not happen back then because of the sanctions that were imposed on Iran. Now, in 2016, now there was an agreement that was signed between there was a trilateral agreement signed between India, Iran and Afghanistan during Prime Minister Modi's visit to the country there. And there was a commitment that India had made to provide $500 million line of credit to develop the port. And Prime Minister Modi had also said back then that exports from the Kandla port in Gujarat to Chabahar and to Afghanistan will now become easier because of this. Now, what has happened recently? Last year, India and Iran signed a 10-year operations contract to operate the Chabahar port, which is already under India's control, the Shahid Beheshti terminal, since 2018. Now, under this, India was supposed to provide $250 million line of credit for port development and $120 million for equipments. So this was the pact that was signed last year, and already so far we've had 6 mobile harbor cranes that have been supplied. Other equipment worth $25 million has been supplied. 2.5 million tons of wheat, 2,000 tons of pulses from India to Afghanistan has been supplied, and a lot of, and when Iran was fighting the locust menace, there was 40,000 liters of environmental friendly pesticide also, something that India had supplied via the Chabahar port. Now, the no listed entities involved in this, barring one, was Ircon International, which was an unlisted entity back then when the contract was signed back in 2016. We were supposed to construct this 628-kilometer Chabahar-Zaidan railway line, but in 2020, Iran decided to drop India from the project because of delays on funding and on construction activity as well. Now, and they said that they will continue with the project by themselves. What next? Now, with all these investments that India has already made, that comes at risk because of this, the sanctions that will take effect from the 29th. There are also geopolitical tensions going on between Israel and Iran, so that continues to remain in the line of fire, and there is no official response yet from the Indian authorities on this, but it will be interesting to see what turn do things take, because it's not only investments, there is a lot of maritime back and forth exports and so on and so forth that pass via the Chabahar port that could be at risk because of this development.
Absolutely. So not such a great development when you think of it from India's perspective. And of course, we'll be waiting for some clarity that could come through probably from the Indian government or any comment on this particular matter. But take a short break, then more news and updates follow on the other side, so don't go anywhere.
best.
Welcome back. Apple has officially rolled out its latest lineup of smartphones in India today. A massive crowd gathered overnight outside Mumbai's BKC store to get their hands on the new iPhones, while long queues were also seen outside Apple's flagship stores in Delhi and Bangalore. The new iPhone comes with several upgrades, with price starting at 82,900 rupees. The iPhone 17 runs on Apple's new A19 chipset, while the iPhone Air and Pro models feature the A19 Pro for enhanced performance.
Moving on, the US President Donald Trump is expected to speak with Chinese President Xi Jinping today in a critical call that could finalize a deal allowing TikTok to continue operating in the US. The conversation may also pave the way for a potential leadership summit to resolve the ongoing trade tensions. Trump, who has credited TikTok with helping him win another term, says that the US holds the platform's fate in its hands. Officials say a framework deal had been reached, but key issues including ownership, data privacy, and control of TikTok's algorithms remain under discussion.
All right. Thank you so much for that, Hormaz. But, as we wrap this edition of Business Lunch, take a look at the Nifty. There has been some recovery that has come through. Now the Nifty is trading with a cut of around 89 points. Some recovery coming in since the show started. So I guess we're the good luck charms, Hormaz. The Midcap index also doing slightly better, up almost 0.2% now as compared to 0.1% when we started the show. But
and the fact that we are sitting in the studios is evident that we are not at the Apple store to buy the latest iPhone. I'm sure you would be heading out after the day is over to buy the latest iPhone. But we take your leave on this edition of Business Lunch for the final time this week from Amakshi and me. Thank you so much for watching. But the day is not over yet. Midcap Radar on to the final 2 hours of the trading session on the other side.
Hello and welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Finally, it's a Friday, the end of a very long week in terms of trading action. But yes, for now, the Nifty is down around 99 points. I'm sorry, actually, my rates are not updating. I think, yes, it's an 80-point downtick that we're seeing currently. Mid-caps have recovered from the lows. It did dip into the red, but there is some recovery. But the advance decline ratio, absolutely flat. For 1,300 stocks on the advancing side, there are around 1,300 stocks on the declining side as well. But a lot of stocks on our radar.
That's right. Good afternoon, Sonal. Again, very interesting session. It's been quite choppy. A lot of news flow. On the back of that, we are seeing quite a bit of choppiness in the markets. A lot lined up on the show, an important corporate conversation as well. Let's start off with the top headlines. Market near the day's lowest point. Mid-caps also fade after a rally in the first half of the session. PSU banks along with oil and gas gain, while IT and private banks drag.
India's Solicitor General tells the Supreme Court some solution may be needed on Vodafone Idea and the larger public interest, with government holding 49% stake. He adds that the facts have changed since the earlier petition. The apex court defers the hearing to next week.
Keynes Tech under pressure after CEO Rajesh Sharma resigns. The management tells CNBC-TV18 that they will announce CEO candidate's name in the next 3 to 4 days, and the candidate will be a company insider.
Unichem Labs under pressure after the European Commission levies €19.5 million fine over the company breaching competition laws.
Well, you're looking and you're watching Midcap Radar on CNBC-TV18, and what's essentially transpired in the last half hour of the session has been quite a bit of a sharp bounce, especially as far as the bank Nifty is concerned. Some of the private banking names have seen a recovery from the day's lowest points. Have a look at a name like ICICI Bank, have a look at Axis Bank, have a look at Bandhan Bank. All three of these stocks have recovered from the day's lowest points. Axis Bank up almost 0.7%, Bandhan Bank up 0.6%. Another stock, one from the cable and wireless pack, that was under a bit of pressure in recent times, was KEI Industries. That stock too has perked up to the day's highest point. But one of the big stories of the day is Keynes Technology. There was significant volatility in the stock after the announcement of the resignation of the CEO and the subsequent clarification that came in from the management exclusively on CNBC-TV18, post which you can see the stock that cooled off almost 5% from the day's highest point has recovered quite sharply. But Sonal has moved across to the wall. This is our special segment, Midcap Movers. Sonal, take us through the midcaps that are moving around in the session.
Well, yes, advancing stocks in line with the declines, but some big movers on the positive side. Let's talk about Vodafone Idea first. Of course, we've been discussing the commentary coming in, the government stake as well on what happens with Vodafone Idea going forward. The Exicom Tele stock is up 10.5%. Welspun Specialty, that stock is up 7.5%. Netweb Technologies been going good, and today as well, adding 7% to that. We have Redington as well, which is up around 6.5% as we speak. The other names include the likes of Inox Green, there's Anant Raj, we have JK Synthetics and Diamond Power as well. Some of the stocks which we don't talk about so often but are making big moves in trade today. In terms of losers, you have Jaiswal Neco. That stock was in focus in last couple of trading sessions. IRM Energy up 35% this week, but today come in for some profit booking. Sigachi is the other one, down 3.5%. One MobiKwik, a lot is happening with this particular name. It was a big gainer last week, and this week has shed some of those gains. DCM Shriram and Coromandel International are the other losers in trade today.
Well, thank you so much for taking us through all of the mid-caps that are moving around in the session. Amidst the volatility, a very good time to welcome Jay Thakkar from ICICI Securities for a quick technical check on the market. Good afternoon, Jay. Thank you so much for joining us. Well, what do you make of the markets at current levels? The Nifty or the headline index has cooled off a little bit, but do you feel the underlying momentum is intact?
Good afternoon to you, Vivek, and good afternoon to Sonal as well. Vivek, see, we have already seen a good recovery coming in market from the lower levels of 24,400 approximately, and we saw 25,400. That is 1,000 points recovery. Slowly and gradually, we have seen that coming in, and not much of short covering yet seen from the FIs. I mean, their selling pressure or in the equity cash segment has eased off, but we haven't seen much of short covering happening in the index futures, despite which Nifty has bounced back by 1,000 points. I mean, they were down by around 7.5 to 8% net percentage long in index futures, and that has come to 14% as of yesterday. So still they are short, and if at all they cover shorts from here on. I mean, definitely the probability of Nifty thereafter inching towards 25,700, the previous levels of maybe, thereafter 26,000 plus levels also increases because we haven't seen much of short covering. In fact, what has happened is since past 1 month or so, we saw the GST-led stocks or the sectors perform quite well. I mean, maybe, starting with FMCG, auto, and thereafter, cement and all of that, and which gradually shifted to the short covering in the beaten down sectors, maybe defense, power, capital market stocks, all of which had seen good short build-up. But still, definitely, PSU banks have been doing really good since a week or so, but we didn't see much of short build-up there. Rather, a few of them have shown a good breakout and a long build-up as well. Maybe, SBI led and, the PSU banks. Is the private sector banks, and the IT, which have shorts, but have not seen short covering. So I think this net 14% long only in index futures is mainly because of these two sectors, private sector bank sector and the IT. And if at all we see some good short covering there, which I'm anticipating, probably, if not in September series, then in October series, that should happen. And if that happens, you will see Nifty probably, climbing towards 25,700 and 26,000. So for me, as of now, 24,800 on Nifty is a good support Vivek. Until those levels are held, the short-term trend should be positive. High on dip should be the strategy.
And what would your individual stock picks be, Jay?
Sure. Sonal, PSU banking names are doing good. So I would say that a few names from there as far as Midcap ideas are concerned. So Bank of Baroda is looking positive. I mean, that can inch towards 275 to 80 in the near term. Both Canara Bank and Bank of India trading around the levels of 118 to 121 respectively are likely to inch towards 135 levels, as far as Bank India is concerned and Canara Bank is concerned, that could inch towards 130. So these are the short-term ideas as far as PSU banking names are concerned. And Sonal, short covering cannot be ruled out in IT names. So LTI Mindtree, I'm trading around the level of 5,500, can inch towards 5,800. And Tata Elxsi trading around the levels of 5,700, can inch towards 6,000. So I think, IT from a short covering point of view and PSU banking name from the long build-up, these are the few stocks which I recommend, for the September series.
Thank you so much, Jay, for joining us, giving us a review on the markets as well as your individual trading picks. But it's now time for a quick break. The management of Insecticides India joins us next to discuss their FY26 outlook and more.
Welcome back. You're still tuned into Midcap Radar on CNBC-TV18. Let's talk about a corporate conversation. Rajesh Agrawal, who is the Managing Director at Insecticides India, is joining us now to discuss the big update that has come by. India has become the third largest exporter of agrochemicals. So what is the path ahead when it comes to agrochem exports, export opportunities in the US, and outlook on capex and financials as well? Mr. Agrawal, good afternoon. Thank you so much for joining in. Well, $3.3 billion in terms of exports for now for the agrochemical industry in FY25. Can you give us a sense of, is it largely volume-led or there has been some pricing improvement as well? And which are the segments or the geographies which are leading this growth that we are seeing in terms of exports?
India exports to the entire world. So all the countries, particularly the USA, America, South America, North America, Europe, Africa, ASEAN countries, even CIS, everybody imports from India. The things change because certain countries are the countries which import the basic technicals. So there are countries like South American countries, America, also some parts of Europe, and then CIS sometimes, and some Asian countries. Others prefer to take white labeling. So both of the businesses are flourishing. So the maximum business which takes place for export is, I would say, the CRAMS type of business where you are making the technicals for some of the companies and they are consuming it in their countries by making the formulations.
Right. Just one quick clarification. You did mention that, as a country, we do export to the US market. Now, amidst the headwinds of tariffs, what we want to understand is, number one, are agrochemicals largely exempt from tariffs, or is it just particular segments? And India versus China, what is the differential? And for insecticides, we understand the total top-line contribution of tariffs is around 5%. What can that go up to?
Okay, so let me come to the broader markets. When you are supplying to the other countries, yes, you have to compete with India. But now companies are looking at China plus one policy. Under that strategy, they are ready to pay if your quality is better, a little extra. You can get, and sometimes you also get the freight advantage because freight from China and freight from India is little different, because whenever the freight prices goes up, India gets the advantage being the better placed country in the center of the sea. So you are able to compete, and then you are exporting. And then this is a restricted industry. When I say restricted, because you have to register your product in every country. So that is the challenge, not only with the Indian company, but also with the Chinese company. So if the product is registered into the country, then only it can go. So you have the fight with the registered players and generally not with the unregistered players. So you get the opportunity. So these type of opportunities are everywhere. Talking about Insecticide India, yes, our contribution in the international business is quite low, but we are working with our partners, particularly the Japanese partner, to open up the export window, not only for Japan, but for some other countries also. And we are also bagging a lot of registrations in South American markets. We are focusing on Europe, we are focusing on Asia, Africa. So our focus is all around. Though, again, I would say that the total contribution of international business to my company is just 5%, but I see it growing in the passage of time. And this year itself, we are going.
Yes. How much will it grow to, Mr. Agrawal? It's 5% currently. When do you reach that double-digit mark? And when you say registrations are the big, I would say, compliance point for reaching that export markets, how much do you have to spend on a registration? Is it a costly affair overall?
Yeah, definitely. That is the cost which goes into crores per product. So you have to invest that amount and be prepared for everything. And then it takes a lot of time. So there are two types of data. One is the toxicology and chemistry data, which you have to generate in your country. And then there is additional bioefficacy data, which is generated in the country where you are exporting. So when both the data become okay and you are granted a registration, then only you can do it. So some countries take 1 to 2 years, other countries take 4 to 5 years. So that is quite common for our sector. So it's a tedious process, and we have been pursuing our registrations for several years in many countries, and we are bagging more and more registrations. So which makes me quite hopeful that international business will be going up for me. And I can say in 2 to 3 years, we should be in double digit.
So in 2 to 3 years, international growth will catch up and will become close to double digit as far as your top line contribution is concerned. That's what you're guiding us to. Okay. So let's now focus on the domestic market. especially when you're looking at Q2. This time around, you actually had the monsoon that was quite late. So Q2 last year was quite strong. So on a year-on-year basis, will you see some amount of softness? Number two, what has been the impact of floods as far as demand is concerned?
Yeah, unfortunately, there has been good monsoon, but monsoon is quite erratic since last 2-3 years. So last year also it was impacted. This year we had an initial dry spell, and then it was a wet period, very long wet period, which has impacted the companies. But again, it's the dry spell, which is good for the industry, and we are getting the opportunity. So I believe that Q2 is going to be a positive quarter, though the growth will be quite limited, but still, I believe that we'll be able to repeat the performance of Q1. Again, I would like to say that quarterly performance is important because of market's perspective, but it is the overall idea and the planning of the company, how the company is heading in 1 year, 2 years time, what are the plans. So we are on the path of expansion where we are launching new AIs, also launching new products, and our vision is that we shall be growing year on year at a good speed with improving the profitability of the company, because we are working a lot on the premium products and introducing of new technologies. We are increasing our capacities for the technical manufacturing as well as formulation manufacturing. And today also I'm sitting at my site, which is a new site at Sotanala, and the work is in progress. So you'll find me a little shabby because a lot of construction is going.
I was just going to ask you on that. You're talking about that new facility that you're at. When is it commissioning properly? What will the initial capacity utilization be? And when does the new Dahej plant reach that maximum capacity as well?
Dahej plant is almost in the final stages. So it has started production also, but post Diwali, I can say in the Q1, it should be in full capacity of production. And talking about the Sotanala, we have a target that when I said Q1 for Dahej means January, Q4. For Sotanala, we have to start the formulations for the Kharif season, which means we should be somewhere in the Q1, we should start production of formulation. First year will not be 100%, of course, but I can imagine that 50, 60, 70%, up to 60 to 70% utilization we should be able to do in year one itself. Regarding the technical, the target is again to complete the technical synthesis plant within this next fiscal year. So we would like to start some production in the next fiscal year from the technical plant, though the real benefit is going to come in 27.
Okay, Mr. Agarwal, thank you so much for joining us. You spoke to us about the export opportunity, the growth that you're seeing there, the domestic opportunity, as well as the new facilities that are ramping up. Well, we now slip into a short break. Up next, we will get an exclusive conversation from JK Tyre's Chennai plant. Stay tuned.
IQ.
Welcome back to Midcap Radar. Well, what we are essentially seeing, especially in the last 20 minutes of the session, is quite a bit of buying that is emerging, especially as far as some of the stocks in the broader end of the markets are concerned. Look at the exchange stocks. MCX, that particular name, has bounced back very sharply. In fact, trading near the day's highest point, up almost by 1.4% in the session. The other set of stocks that are doing quite well is actually a few names from the power pack. So wind power producer as well as turbine generator producer Suzlon is doing quite well. That particular stock has perked up in the session. And on the other hand, even thermal power giant, which is BHEL, that stock too today is seeing quite a bit of buying traction. Some amount of interest also seen in the metal names. Have a look at JSW Steel as well as Tata Steel. Both of those stocks have recovered a little bit from the day's lowest point. Well, as we mentioned prior to going to the wake, our colleague Rachna visited JK Tyre's Chennai facility to understand their business, how the raw material is processed into the final product. And obviously, she caught up with Anshuman Singhania, MD at JK Tyres, as the GST changes as well. Let's listen to that chunk.
GST move is a very welcoming move. And this will certainly give cash in hand to the consumer. And we see that there will be a boost, sudden boost coming in terms of the purchase. And we see that the consumer will definitely get benefited. So we are in for good times, and H2 looks to be good. There has been, apart from the GST, there has been a constant push from the government on the infrastructure move, and monsoons have been good, so there will be a lot of rural demand. So we are looking at a very positive outlook in the second half of this year.
Right, but would this mean a price cut is on the anvil, and would this price cut sort of cut into your margin pressure?
Right now we are not looking at any price cut. We are looking at a stable price right now, and raw material prices have come down, so that is helping the margin expansions, helping us. And plus, we are also very much increasing our product mix towards the premiumization, which is helping us on the bottom line.
Right, but input costs were also expected to soften between Q4 of FY25 and Q1 of FY26. How's the trend now?
Well, we have seen in Q4 to Q1, there has been a price reduction of almost nearly 2.5%. And we see that this year is going to be in the range-bound manner. So we don't see any major hiccups coming in terms of raw material prices.
Right. In the Q1, your domestic business also saw growth of about 11%. Does this give you a room to upgrade your FY26 outlook?
We are very optimistic about this year. We are looking at a double-digit growth.
Right. You'd earlier spoken to us on CNBC-TV18 immediately after the Trump tariffs that one way to beat the Trump tariff is to route it via Mexico. But now that there are reports that Mexico might also be coming up with tariff, now what's the strategy here?
See, right now the US MCA is there between US and Mexico. So those discussions, I believe, are already on its way. It is going to take some time. Till then, we are pushing a lot of tires into America. But 65% of our sales is happening in local Mexico, and rest of the sales are happening in Latin America and Brazil.
With commercial vehicle growth being muted the way it has been, what's your outlook in terms of demand for the next 2-3 years?
Well, right now, I think there is a lot of pent-up demand for commercial vehicles, particularly in the truck segment. But with this GST, infrastructure push, and good monsoon and rural demand, I think the outlook looks good in the commercial segment, particularly for the truck movement. So here, with this derived demand and plus replacement, we are looking at a good, healthy growth of CV segment coming in. And particularly in the bus segment, where public transportation is also given a lot of emphasis, with our strong market share in the bus segment, we feel that the CV per se is going to be doing good.
All right, that's the word coming in from JK Tyre. But with that, we'll take your leave on this edition of Midcap Radar with the news that the midcaps are outperforming the benchmarks. But yes, Nifty has also recovered from the lows. Stay tuned, your stocks when we return.
Hello, good afternoon and welcome to Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. A breather is what we could say is coming in for the markets today. So look at the Nifty, 25,349. Is recovered from the day's lowest point. In the last hour or so, we've seen that recovery coming in from the day's lowest point, but still a breather because we've seen those gains coming in the last few trading sessions. Last week was the second consecutive week of gains. This week also, we've seen the gains coming in for the most of the week. So some bit of a breather at least we're seeing today in the trading session. Now, in terms of what is not doing well today, Nifty Bank. That's not supporting overall in terms of an up move, right? Nifty Bank is also down 0.4%. So obviously the weightage overall that comes in from the Nifty Bank in the Nifty is also quite high. And that is why that bit of a decline for the Nifty as well. Broader end of the market, Nifty Midcap and Small Cap, managing to hold on to some bit of a gain is what the Nifty Midcap is doing as of now. So look at the significant recovery at least for the Nifty Midcap, right? It opened up, then it fell down, and then again around the day's highest point is what the Nifty Midcap is trading as of now. Small cap also is managing to hold on to gains of almost 0.08%, 0.1% approximately is what we're watching out for in terms of the small cap as well. PSU banks, that's managing to do well in today's trading session. So that is what we'll be keeping an eye out on. But this is a show where we solve all your stock-related queries, and to do just that, we have our independent market expert Shaina Mukaddam as well as Vaishali Parekh, Vice President Technical Research at Prabhudas Lilladher. Shaina as well as Vaishali, good afternoon. Thank you so much for joining us on the show as always. Vaishali, let's start by looking at some bit on the technical front for the Nifty and Nifty Bank. What are the important levels now that one should be keeping an eye out on? And if we manage to see a bit more of a recovery by the day's end in the next 1.5 hours, what will it mean for the Nifty as well then?
Very good afternoon. Yes, I think happy days are here again as far as the market is concerned. So Nifty, well, we saw a good run coming in during the week. So I think 25,300 levels is held on. So we do have our open target of 25,500. So pretty much close to that. If there is a bounce back coming in, I would expect Nifty going towards that. And Bank Nifty also gradually towards 56,000 levels.
Okay. Shaina, let's get your view also overall in terms of the markets, broader end of the markets managing to do a bit better today. What are we watching out for going forward now? Do you think that mid-side and broader end of the market is something that could do better? GST, the new rates are going to be coming into effect from 22nd of September. Now, what should we keep an eye out on?
Yeah, I would see some sectors doing much better going forward in the second half. You have auto, actually, which likely to do better. So some of the stocks over there you could look at for the second half to add to your portfolio. I would also say banks. While today there may be some bit of softness in the overall sector, I think banks also should do better in the second half. Infrastructure, I think that's another sector that you could look at. Defense. So I think there are pockets which you can keep adding to your portfolio. I believe overall second half should be better.
Okay, you expect overall second half should be better coming in, and some of the sectors also that are highlighted. On that note, let's get started with the queries for today. And the first query for today is coming in from Lijo Jose, who is from Kuwait. He is holding 10,000 shares of Ujjivan Small Finance Bank. Price is 32 rupees per share. Currently, Ujjivan Small Finance Bank is at 45 rupees approximately. He's holding it since the last 4 years. Now, what should he do with this, Shaina? Should he continue to hold this, or should he get out of the stock now?
What I believe is that price to book being 1.5 times, the upside for the shorter term may be a bit capped. At the same time, he can take some profit off the table since he's holding it for a long time. He can take some profit, but he can hold the rest for a little longer term period because they have their application for the universal banking, which is, we are expecting by this year end, RBI should approve it in principle. And when that comes, then the management plans to change the overall business of the bank. If, for example, now their loan book is about 33,000 crores. Over the next 5 years, with universal banking, they want to take it up to 1 lakh crores. So, they're looking at a very strong growth. And to fund that, they will raise funds. They're targeting about 2,000 crores over the next 1.5 years. So, to an extent, the downside for price from here seems limited. So, it looks more like very little risk. You can continue holding at least part of it, hold it for the medium to longer term.
Okay, hold part of it for a medium to long term, and yes, that put out that path that they have in mind till FY30 as well. That almost indicates almost a 25% growth in terms of CAGR that we could watch out for over there. So that is interesting. But Vaishali, on the technicals, what would your suggestion be? Should they continue to hold, book out some bit of a profit? What should they do?
Well, chartically, it looks much better. It's showing signs of revival. And if I heard it right, I think he has bought at higher levels. So 44, right now it's 45.90. So 44 acts as a very good support level. He may average out at these levels as well and run through the...
Vaishali is bought it at 32.
32. Oh, okay. So continue holding, and I think the stock is ready for an upward move. It can go towards 52 to 55 levels in times to come. Well, so if time is not the worry factor, I think you should hold it.
Okay, if time is not a worry factor, continue to hold it. That's a word from Vaishali. Keep an eye out on those levels over there as well. Next query for today is from Prasad, who's writing to us from Kerala. He's holding 215 shares of Infosys. This is at a price of 742 rupees per share. Now he wants to know if it's worth participating in the buyback and sell the proportionate offer. He also wants to know if there is any chance for the stock price to go up after the buyback. What are we watching out for now? China, what's your view coming in for Infosys? Now, when you look at Infosys overall, right, from his buy price, that's seen a good move coming in. But otherwise, in the last 1 year, it's not done anything, right, in terms of a return. So what should an investor do now? And is buyback a good option for at least a viewer to go for?
Yeah, it's like a good dividend actually. Because even if he tenders the whole quantity into the buyback, I don't think more than 3 to 4% at max will be absorbed. So it is a dividend. Actually, it's a good dividend. So yes, he should offer it into the buyback, and most of the quantity will be left back with him. Then I would believe it is, I would say you can continue to hold, review it later, of course, but continue to hold because valuations are not very expensive. If you see 1 year forward is about 20 times. And we saw in the first quarter, their order book is pretty good. You know, they did much better than what was expected. Deal wins were better this year, are expected to be better this year than what they were last year. At the same time, I think there are issues like, for example, US, what is going to happen with the visas and, you know, overall sentiment for the sector. So I would keep a watch later, but for now, you tender it in.
Okay, for now, tender it in, watch out later, but continue to hold. You know, if there's anything left back also, review it at a later time. Valuations are not too expensive. On the charts, Vaishali, is that the same story for you? Or maybe look at some of these other smaller IT cap names? Would you suggest that?
I think, well, one stock in isolation, I would definitely not suggest. But yes, Infosys, coming to Infosys, it is showing signs of improvement. Or in fact, whole IT pack is showing some signs of revival. So I would say continue to hold. And if you're asking me about other stocks, well, Persistent, Coforge, these are all good stocks which are getting into a trend. So I would say a basket of mid-cap and the large cap should be good.
Okay, keep an eye out on that. As of now, not much of a worry here. But let's move on to the next query then for today. This is for Railtel. We have Stephen Money, who's writing to us from Bangalore, holding 3,000 shares of Railtel, and this is at a price of 350 rupees per share. Stock is at 394, saying that he can hold it for 5 more years. Should he continue to hold or look to sell this one? China, Railtel, all these railway stocks, you know, just last week, this week, we've seen them seeing a run-up as well. Today, maybe Railtel is taking a breather, but there are a lot of order wins also that came in the recent time. What should they be doing with this? Continue to hold or sell Railtel?
I would say as of now, continue to hold. It's Navratna. It falls under the railways, but actually, if you see, railways accounts for only about 30% for their revenues. Remaining 70% is from other sectors like construction. Of course, maybe partly for railways or whatever. But there are other infrastructure contribution that come in for the revenues. I would say valuations are not cheap, you know. It's a small cap, 10,000 crores market cap. Valuations about 20 times 1 year forward, EV by EBITDA. At the same time, the order book is so strong, currently about 6,500 crores. They're targeting within the next couple of months, it will go up to 10,000 crores. Then if you look at valuations over 1 year forward, it's about 2 times turnover if you look at it in terms of market cap. So I would say you hold, and it's going to be a steady performer. Don't expect it to be a multi-bagger.
Okay, steady performer, not a multi-bagger. That's the word here right now. Vaishali, Railtel on the charts and technicals, what would your suggestion be? Hold or sell?
Yes, so since 5 years is the horizon, I'm looking at the monthly chart, and I think it's getting into a trend. We've seen good corrective move coming in. So I would say keep a stop loss of 320. And once we see good momentum and good price action happening, I think this stock can go towards 550, 600. So I think there is a lot of upside. Continue holding.
Okay, a lot of upside. Continue holding. That's the word from Vaishali on the technicals. Next query for today is coming from Krishna Kumar, who's writing to us from Chennai. He's holding 300 shares of ONGC. Price is 240 rupees per share. Wants to know if he should continue to hold or look to sell this one. Right now, the stock is at 235. So they're making a marginal loss on this one. China, ONGC, what would your view be?
I would say it's better to switch, he's not making much loss. And this is not going to be a stock or sector that's really going to give you too much money. Crude oil prices are actually low, and OPEC is now increasing production that we heard in August, September. So I would say that, the quarter numbers also in terms of revenue, I don't think it's going to be too much. Even first quarter was marginally lower. Profits also, though they were good in Q1, I wouldn't bet on it in the rest of the year. And what I believe is there are other stocks like you could switch to, I would say even Reliance would be a better bet. For example, ONGC is planning to invest double the amount of capex into renewable energy, around 60,000 crores compared to what it is in its own sector. So to an extent, better to get into a stock which already has made considerable investments and is likely to start showing results in the near term. You could also look at Tata Power if that is a sector you want to look at, but I would say switch from ONGC.
Okay, switch from ONGC, that's a word from China. Vaishali, what would your suggestion be? Because when I'm looking at ONGC, last 6 months also, it's just been in that range, right? We're not seeing it see a significant up move or not a significant downside as well. So right now, what should the viewer do? Would you also say get out of the stock?
I totally agree. It's been a laggard forever. So I think exit, and Reliance is a better stock to get into it. So yes, it's a switch from my side.
Switch from Vaishali's side as well. So ONGC switch on the fundamentals and the technical front. But on that note, we're going to actually sip into a very short break, viewers. And as we're sipping into the break, here's a reminder for our viewers that unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, our premium members experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits. Welcome back to Halftime Report on CNBC TV18, and Nifty as of now is where we started the show with. So not much of a move that is coming in there. Still down 0.2% approximately for the Nifty 50. But let's keep it going with your stock-related queries. We still have with us Shaina Mukaddam as well as Vaishali Parekh. Let's move on to the next query. This query is coming from SK Datta, who's writing to us from Kolkata. This is an investment query. Now, he's planning to switch from Asian Paints to Garden Reach Shipbuilders and wants to know if this is the right choice. Shaina, Asian Paints, switch from that and look at Garden Reach Shipbuilders. Would that be a choice that you would suggest coming in right now? Garden Reach Shipbuilders as such has seen a good move also coming in the recent times. What would your view be?
Switch from Asian Paints, yes, I would say that it is a good switch. Despite the stock having corrected by almost, I think, 20% in this last 1 year, still valuations 1 year forward are still expensive. It's about 50 times PE. Also, if you see on in the Q1, we saw volumes were decent, 4%, but average realizations were impacted. Now, in the rest of the year, while raw material costs may come down and you may see some stabilization, I think the competition going forward in the longer term is going to be much more intense with so many new players coming in. So I would say it's a good switch. Now, if you're asking me shipbuilding, which to switch, I would prefer Majgaon shipbuilders to Garden Reach because, it is a much bigger player. And secondly, in terms of valuations are more attractive for Majgaon compared to Garden Reach. Of course, neither of them are cheap, but Majgaon, if you see on a EV by EBITDA basis, it's about 20 times. Whereas if you see for Garden Reach, 1 year forward, EV by EBIT is about 28 times. So to that extent, even if you look at the order book for Garden Reach, even 1 year forward, like I think they're talking something like about 40,000 crores. And if you look at Majgaon, they're talking of more than 2 lakh crores. So I would say if you want to switch, but Majgaon dock, in my view, the only caveat here is that government holds 81% in Majgaon dock. So at some point in the longer term future, you could see some issuances from there. But I would still say that the current price would be definitely protected.
Okay. Current price would be definitely protected. Switch from Asian Paints, that's surely the word. But instead of Garden Reach, you would prefer Majgaon dock. That's the word there. Vaishali, what would your suggestion be? Should the viewers switch from Asian Paints and look at Garden Reach Builders, or would you also suggest any other name?
Definitely a shift. But I do like Garden Reach because seeing the past data, it has shown very good run up. And now that when I'm technically also seeing the projections from here, I see a lot of upside from here. Like currently it's at 2600. I think the stock is ready for a takeoff and it can go towards 3400 to 3800. So for that purpose, at least I would say Garden Reach is good.
Okay, Garden Reach is still good. So you're saying that even in the last 6 months, you've seen that 60% return and there's still some upside that is still left here, right?
There is lots, yes.
Okay.
It's 2600 expected target, projected target is 34 to 3600.
Okay, 34 to 3600 is the projected target. Keep an eye out on those levels over there for Garden Reach. But a switch from Asian Paints, that's the word from both our experts. Majgaon dock, Garden Reach, you can do your own research and look at that as well. But levels are also given by Vaishali. Let's move on to the next query for today. We have it coming from Parag, who's writing to us from Navi Mumbai. He's holding 100 shares of L&T Finance and this is at a price of 166 rupees per share. Wants to know if he should sell now or wait for the stock to move up. Now he's bought it at 166, making a profit. Shaina, L&T Finance.
I would say hold as of now, because while price to book is not cheap, currently it's about 2.5 times price to book. The management has come out with very strong commentary for the second half of the year. And this is supported, of course, by the GST cuts that are there and auto being a major segment for them. I think the second half growth is going to be much better than what we've seen in the past couple of quarters. So I would say it is a hold as of now.
Okay, and L&T Finance, your view, Vaishali?
It has been an outperformer, though it's in an overbought zone, but we still have higher projections. I think the stock is ready. It is not even correcting, even when the market has been volatile. So I would say continue holding with a trading stop loss of 230 and look for a target of 285 would be the first target. And it can perhaps even go towards 300, 320 levels. So in my opinion, it's definitely a hold.
Okay, definitely a hold there. Shaina, next query for today we have is coming in from Shanmuga Verma, who's writing to us from Kerala. Investment query, planning to invest in Ixigo for a period of 3 years. Would you suggest that?
Yeah, but not at current levels.
Okay.
I would suggest that my preferred price would be a little bit lower, around 240, 250 type of levels, because in terms of valuation, it is a bit expensive if you look at it over the next maybe 1 year. So, but they're doing well. I would say that, overall the growth has been very strong, and being a platform company for bookings, they're doing well across the board. If you take trains, flight, bus, and in fact, for trains, they have also had new tie-ups in the last couple of weeks, I would say. So it should do much better going forward. But the only thing is that, why I'm saying buy it at a lower price is because it is a widely held stock, new issue, and it's widely held by a lot of Ps, FIs. So to that extent, if we see corrections, it's better to get in at corrections and not when the stock has moved up so sharply.
Sure. Okay, that's the word coming in there on Ixigo. But that was the last query for today, ladies. So Shaina as well as Vaishali, thank you so much for joining us and helping us solve all the stock-related queries as always. And viewers, thank you so much for sending us your queries. Remember, you can email us your queries at the email ID at the top of the screens for you all. And with that, it's a goodbye from me as well as the team who put the show together. But don't go anywhere. Last hour of trade is still left. And for that, you have closing bell up next.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
We are seeing the Taiwanese index is trading lower by almost 0.3%.
Bank Nifty, 12 straight sessions, positive closes, no signs of a reversal yet.
To the conclusion based on facts that there is no allegation, that the allegation made is totally without any substance.
It's a flat opening. The Nifty opens down 5 points at 25,417.
Looking for opportunities to really de-risk their supply chain from China.
111 points gone on the Nifty as we speak.
Renewables is certainly something that's very attractive for us.
Be one or two more senior people coming in. There will be one or two more people coming in.
The Supreme Court to help with a possible solution to the Vodafone Idea issue.
Yes, it's an 80-point downtick that we're seeing currently.
Okay, the market just taking a bit of a break this Friday after galloping higher on all the prior 4 sessions. Actually, it's been 14 sessions, right? I mean, today is the 15th, and we're down a little bit. 90 points, 25,330. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, Nigel and Rima here with me. Guys, good afternoon.
Hi, afternoon. Just a minor correction. On Monday, there was a little bit of profit booking. So that snapped to that winning streak. So for today, we're up about 1% for the week, and we've snapped that 3-day winning streak. So Tuesday, Wednesday, Thursday were positive sessions. But I think while we're down now in the red, there has been a bit of a lift in the last 30 minutes.
Yeah, that's right. No, I mean, par for the course, right? After the kind of rally that you're seeing, taking some money off the table, you have a weekend as well ahead. Go ahead, enjoy the weekend. I guess some money off the table, yeah. I don't think it's a worry at all.
No, absolutely. And, 100 points is what? I mean, 0.35, 336 odd percent, right? I mean, on a larger scheme of things, the market is down 1,000 points. Nifty Bank is down 0.5%. The small and the mid cap index, maybe it'll come up on your screen. It's unchanged, the small cap index, and the mid cap index is also unchanged. Wow. Nothing actually literally unchanged from yesterday's close. Let me just quickly run you through what's coming up here on the program. And then we'll pick up from there. So week trade on Dalal Street, stocks are slipping with Nifty, of course, below 25,400. Financials, FMCG are leading. And there is, of course, the mid-cap space, which is doing slightly better, but is flat, as I said. And a boost to Vodafone Idea's hopes for some relief on its AGR dues. The Centre tells the Supreme Court that it is not opposed to Vodafone Idea's plea. Well, we have a discussion planned and lined up right next after this. And we'll tell you what this means, because there is some confusion whether this should be actually read as relief for Vodafone Idea, because it's important. Keynes is under pressure. The company announced the resignation of its CEO. And stay tuned for the excerpts of the management commentary on succession plan, etc. Adani Group stocks in focus. There's a clean sheet from SEBI which came through yesterday evening. Yash will tell us more about that. But how should you position yourself at the last hour? That's the question. Mitesh is here to answer that for us. Mitesh, what's your recommendation?
Good afternoon, Prashant. So, I was talking about the possibility of any intraday decline as a buying opportunity. I think we're right there. 25,300 is what I suggest is a good level to take some and explore some long positions. 25,300, 280 being the buying zone. And keep a stop below 25,230. I believe that there's a good chance that the market will head towards 25,500 and then 25,650. So these are the upside targets. And therefore, this pullback gives you a chance to, explore fresh long positions on the index. Coming on stocks, I have buy calls on IRCTC. Buy here with a stop at 725. Look for targets of 760. And Divi's Lab, pharma has been something which I've been very positive upon. So Divi's is the next stock. So it's going to go upside breakout today. Buy here with the stop below 6154 for targets of 6310.
Okay. All right. Just one more stock, Mitesh, if you could give us your view. Paytm. Stock suddenly saw a sharp fall. It's actually had a very, very good run from the recent lows, and everyone called it a peak at 800, 900, 1,000, 1,200. But it had a knee-jerk reaction, and it's recovered a little bit. On the charts, how's it looking?
I think, there's a problem that I have put options of bearish positions over here, so we'll refrain from commenting. But there's some kind of a breakdown which is happening in the chart, so the outlook in the short term is negative.
Any Adani Group stocks where there is a trade?
So the entire pack looks very good. In fact, we have had some buy calls on Adani Solutions, Adani Ports, etc. But after today's gap up, I think what still can be bought is Adani Ports. It's hit the highs of 1460, which was where the stock had, had made multiple highs in the month of July and tapered off a bit. But the structure is very positive. So if you get it closer to about 1420, which is about 10-12 points lower, I think that will give you a very good entry point. The first target will be 1460, but I suspect eventually the stock will get past these levels and head towards 1525, 1530.
Okay, best way to play is through Adani Ports technically. But let's get to the other big story. The Supreme Court has deferred the hearing in the Vodafone Idea AGR dues case to the 26th of September, 1 week from now. Ashmit is here with more details on what transpired in the court. Ashmit.
Well, major relief coming in for telecom player Vodafone Idea. The government batting squarely in defense of Vodafone Idea, asking for support for indulgence of the Supreme Court to bring about some form of solution to this Vodafone crisis. This is the first time that the government is openly rooting for Vodafone Idea, citing its own status as an equity shareholder in the company to as high as 49%. Now, this is not the first time that Vodafone Idea has filed a petition seeking relief as far as AGR issue is concerned. What is different, however, is the stance of the government. Previously, the best that Vodafone Idea got, like in the month of May, is the DOT, is the government being neutral, neither batting for or against any such relief, leaving the matter to the wisdom of the court. And as we've seen previously, the court had rejected previous such applications. Now, however, for the very first time, the government is squarely batting for relief, saying that they are equity shareholders. The facts on the ground have changed, that the situation demands some kind of solution, some kind of intervention, that the government is willing to work on some form of solution to address this issue of Vodafone Idea. The concern, of course, being that Vodafone Idea is a part of its petition saying that if this relief is not granted, it will threaten the existence. The company will go under. So clearly, relief being asked for by Centre in favor of Vodafone Idea. The Supreme Court for now willing to hear the DOT, willing to Vodafone Idea further. The hearing, we understand, will resume next week on Friday.
Okay, Ashmit, thank you very much for that. The stock has come off from the highs. It's still holding up with a gain of nearly about 7%, but a little bit of a cool off from the time when the news was announced. I mean, the fact that there is no outright dismissal by the Supreme Court should be read positively. But whether the company is saying that, the government is saying that we're not opposing a relief only on the 9,450 crore plea that was in front of them, or are they even open with it for the larger dues, which are in excess of 50,000 crores? There are lots of question marks to see how this plays. The government is an invested party. They have a 49% stake in the company, and relief we'll have to see in what form. There are multiple ways. One, maybe the moratorium can get extended. Two, even the timeline for payment, I think they have about 5-6 years from now on. By March 2030 or March 2031, they have to make the payments. Maybe they can say, you can extend the payment. Don't give a moratorium, but extend the duration for which the payments can be done. Maybe the government looks at converting more equity, more of the dues into equity. So relief, if the government wants to push for it, can come in different forms. So we'll have to wait to see. But for now, Vodafone Idea is hopeful. Shareholders are seeing a bit of a relief with the stock surging close to about 7%. But outside of that, on the mid-cap end, I think the big theme this week has been these consumer tech companies. Look at Urban Company. 103 was the issue price. Bumper listing on Wednesday, stock closed out with a 60% gain. And today it's added on another 8-9%. So Urban Company is a big high flyer. Swiggy is seeing buying now. Swiggy is up 2% this week. It's rallied close to about 8-odd%. And I think Eternal too is inching up and pushing up. Mitesh, can't give a trade on, Urban Company, very short, listed life. But on Swiggy, Eternal, any trade?
See, Eternal has had a very good run up, And I think now, looking at the fact that the price is also getting slightly overbought, I think I would want to see some correction. So the charts are very good because the stock is making new highs continuously. The medium-term charts are good, but in the short term, we are seeing very overbought levels. So I think Eternal, I would want to buy it if I get it closer to about 320 or so.
320 is a good buy level for Eternal. Gurmeet Chadha, managing partner and CIO at Complete Circle Consultants, is now joining in. Gurmeet, what's the right valuation for a company like Urban Company? Top line is at 1150 crore. They've just broken even right now. The potential is huge, but the company has to still capitalize on it. Valuations have crossed 25,000 crore. So what is the right valuation according to you? Fair one.
Hi, Rima. Very, very difficult to put valuation to these some of these new age businesses. Also, some of they broke even more largely on investment income more, and I think the operational burn continues. So obviously the stock has done well post listing, excellent premium. But as I said, we are more anchored where we see more visibility in terms of the environment we are in, growth along with some profitability metrics. So we like Eternal. I think Swiggy also has some catch up to do. We like Nykaa, we like Policy Bazaar, PP Fintech. We have added Paytm at much lower levels. I think at some point of time from lending, I think UPI monetization also will happen in the near future. And I think they've got their focus right now. It's just the lending and payment system versus too many things they were trying to do. And Geo Finance, I consider it as new age and as platform as anything else. Urban Company we haven't added yet, but happy to change my view if things become better as we go along.
Gurmeet, one feature we've seen good afternoon with all these companies, right, is these, and maybe it's true with IPOs as well, but just the cohort that you and Rima were talking about, which is look at Zomato. After listing, there was a big dip, right? After Swiggy, same thing. Did well for a while. There was a big dip. I actually went back and I'm looking at Policy Bazaar, listed in 2021, right? Yeah. Listed at about 1150, 6, 7, 8 months down the line was at 400.
Yeah.
Right, and then of course it had a move. So, these are all new age companies with early investors in and who've ridden the wave higher in the private side, now coming to the market on maybe slightly juiced up valuations. So, any lessons for Urban Company? People looking at Urban Company. I'm not suggesting anything. I'm just asking you.
I think, you have to make a portfolio for them, Prashant. Look at, for example, I'm going a little stretching. Look at NVIDIA and Intel now. Intel was what, $150 billion 10, 12 years back when NVIDIA was what, 5, 6 billion. Today, NVIDIA is buying a stake in Intel. Intel has, government has infused equity. Blinkit has disrupted a 30, 40-year-old business, DMart. And we saw Mr. Damani picking up a stake in Eternal, now amongst the top 10, 20 shareholders. Right, so I think so. I'm not saying it is a spray and pray approach. But
no, Gurmeet, sorry. I should have made my question sharper. My point is, do you buy after a substantial dip in some of these names after listing? You buy only then and not chase them higher in the first few days. That was the question, the sharper.
Yeah. So, Prashant, as I said, if there is improvement in operating metrics, then even buying during IPO, immediately listing is okay because you're taking a long view on this. You're not taking a tactic. I agree with you on the volatility bit. Same with Paytm also. I mean, went down to what, 300, 400 when RBI put a ban. So, if there is a sharp dip and there is some value play, you can be tactical when you buy a dip. But to be structural, you got to see quarter on quarter sequential improvement and burn getting lesser, operational profitability picking up. So with Urban Company, Eternal, we also entered late. We actually entered at 170, to be honest. We didn't buy during the IPO. I could not add during 50, 60. But that's when the platform fees kept going up. When Blinkit started, adding more dark stores, and people thought it is cash burn. I think it's a capex. So if HUL sets up a plant, it's capex. Somebody sets a dark store, can't be cash burn. So you have to see, take a view. And there's a bit of a leap of faith, I'll be honest. You can't really put traditional metrics to work. So have a 5, 6 stocks in different segments and hope that, a couple of them take off and, make up for the others which don't.
Okay, one question. Do you own? Yeah.
A viewer has just messaged, analyst by the way, says that the broader point is right, but Diwali is coming and Urban Company services Zoom.
Yeah,
Demand
Zoom.
for Urban Company services Zoom. It's a good point, I think.
Yeah,
you're right there. Sorry, go on.
Yeah. The difference between a Zomato and even an Urban Company is that when you have a salon service, right, you will call them once a month, maybe, right? For Diwali cleaning, it's once a year. But a Zomato, on the other hand, you can call groceries like every day, or dine-in can be once a week, once a fortnight. And even in terms of asset light, Urban Company is just Zomato is a platform. All it owns is people, right? Ferrying food. But Urban Company, on the other hand, is a little more asset heavy because it invests in training. So that's the difference between the two.
Training, by the way. For example, if you were...
and they have some minimum guarantee. Yeah, sorry.
There's a minimum guarantee. But, for example, the parlor chaps, right? You got to buy the product
You
from
have to
them.
buy the product from them. But that ensures
That is
quality.
also, exactly.
That ensures quality and the fact that, consumers go back, clients go back for stickiness. But Urban Company is a monopoly in the organized space, at least for now. And now they're tapping into InstaHelp. And when we asked the company about the opportunity, he said $10 billion is currently the serviceable market for InstaHelp only. But Gurmeet, a quick question. Do you own Urban Company?
No, as I said, we have Eternal, we have Swiggy, we have Policy Bazaar, we have Geo Finance, and we are now we have added Paytm recently, a couple of months back.
Okay, got that. What about Reddington? Stock up 5% today, 25% for the week. Lots of excitement with this Apple 17. We're seeing visuals of people falling over each other to get their hands on the new phone. But is it really a big deal for Reddington?
Could be. There's a bit of a probably effect when the overall space does well. We've been very lucky with Dixon. We have been lucky with Keynes, notwithstanding the resignation news today. So those are the two ones we have in our portfolio. Keynes is also quasi-semiconductor OSAT play as and when payout. So I personally think that if you're going for EMS, look at companies which are increasingly adding more ODM versus OEM and adding some IP to it, because that will give you a bit of a cushion, as things span in a volatile world where, you can see sudden changes in policies and tariff barriers coming in. So anything to do with IP, anything to do with ODM, where you are increasingly adding more margin to makes more sense. So we actually trimmed Dixon probably much earlier than we should have, but we have Dixon and Keynes in that space.
Very quickly, in the past you've spoken about the defense plays. I think Zentech was something that you like. I'm not sure whether you'll have it. And the railway theme as well. I think Hind rectifiers. Do you all continue to remain bullish on both those two? I mean, have you all changed things around from there?
Oh, Nigel, extremely constructive. I think defense tech, and I've said this earlier times, I think you'll probably see one or two defense companies being the top Nifty companies in next 3 to 5 years, and maybe one of them or two of them hitting 400, 500 billion market cap. And I think this space is merging into more technology now. And as I said, more IP related plays. So we have Zentech, which amongst, has the highest patents amongst all Indian companies. I think they have 24 patents. Simulators, for example, which is one of their bread butter, GST has become zero. India still has almost 80% physical training versus West, which has 70% simulators. And simulators have application beyond defense, aerospace, and related sectors. We added Hind rectifier in the railway, which makes transformers for railways. And now they've done an acquisition through a subsidiary, a French company, just for 1 million. Company does 24 million euro top line. They have acquired it under Chapter 11, but they get the IP in terms of robotics and electronics. So you suddenly get a global footprint on power, on electronics, and not just being transformers and propulsion suppliers to locomotives. Also, the current engines are no longer one engine dragging 18 bogies. It's step-up engine, whether you see Vande Bharat or you see Shatabdi, etc. So that's something we've added. And we're also looking at more space, more companies in the power equipment space. That's something we are extremely constructive.
Okay, so Zentech, Hind rectifiers also is something that you're now. And solar, of course, was your big bet when you got in triple digits, right?
Yeah, we were in 3 digits in solar almost, and I think got lucky there. Also, I think with Mr. Chandra visiting solar plant to me is very significant. Tata Sons chairman. I'm not speculating anything, but I personally think there are big JVs with large corporates will come because defense needs a lot of capex,
right.
IP, and capex.
Got it. Thank you, Gurmeet, for joining in. Enjoy your weekend. Let's talk about Vodafone Idea and whether one should really read into the government statement at the Supreme Court. We're not opposing the Vodafone Idea plea, but some solution is required. The government is also an equity holder, 49% stake. Shiju PV, Senior Managing Partner at India Law, is now with us on the show. Thank you for joining in. Share your first comments. Were you a part of the proceedings?
No, I'm not a part of the proceeding. My first comment would be a welcome step from the government side, because this has been a long overdue, and this is third or fourth litigation going on in this matter. So it is an opportunity for the government to see more than a litigation, to come up with a proper policy framework, which is the need of the hour.
So should we expect some relief is coming from the government?
Yeah, government currently already holding, as you know, it's already a 49% government holding, and any change in stand or change in policy stand of the government should be applicable to the entire spectrum, entire sector, not just to Vodafone Idea. But looks like there is a different view. One is DOT's demand, all issues coming out of the fresh demand made by the DRT for around 9,500 crore. And a part of that amount, the demand also goes back to the 2017 year period, which was already crystallized by the 2019 order of the Supreme Court. So seems like there is also another view from the government, since there should be some policy correction, there should be a revisiting. So I expect some kind of a change in stand by the government in the next week.
Gopal Jain, senior lawyer at the Supreme Court, is also joining in. Mr. Jain, would you read this as a change in stance from the government? Because the government has taken steps to resuscitate Vodafone Idea. You know, first, it was an entire policy which provided relief in the first place 4 years back. Then they converted some of their dues into equities, which is why they have 49% stake. So what has changed right now, in your mind, based on what's happened today, from the government's point of view and the stance? Mr. Jain?
So first, I think it's a positive step because we are in an era where resolution is very important. Issues should not be simmering. All sectors need stability. The telecom sector particularly has gone through a lot of upheaval in the past. Second, I think we should wait for a week when the government will come up with its proposal or plan of action to be able to be tabled before the court and for further discussion. And three, the very fact that the government is itself now infused equity by converting the loan into equity makes it a stakeholder. So to that extent, it's wearing two caps. And perhaps it's in this context that it is going to come up with some constructive formula or suggestion or practical way forward to address the issue. So I read it overall as the sentiment is positive. And if matters can be resolved, I think that will be a welcome.
But Mr. Jain, the government has been converted its dues into equity a while back. Despite that, you know, the recent Supreme Court hearings, we haven't seen, you know, have been dismissed by the Supreme Court. I may be wrong, but it just appears that it's not that the government has just converted its dues into equity. It's been a while. So, and yet from the Supreme Court, we haven't, I mean, whenever the government has, you know, made its plea, we haven't heard this kind of language.
It's not a timing issue. As I said to you, if you go with resolution in mind, like today when we have a mediation act, the idea is to resolve matters. So I think it's always good for a policymaker to come with a constructive suggestion before the court. And then once the suggestion is placed before the court, we will have greater clarity. And then one can discuss what that proposal is and how viable it is and feasible it is. So I think we should do it in two steps, but it's a welcome move.
Yeah. Well, Mr. Jain, good afternoon. Thanks for joining us. You know, my question is for the not very deeply sort of, you know, those who are not following this very deeply, what the government lawyer said in court today, how is that different from their stance earlier? Because, I mean, they said in court that, you know, the position has changed. I mean, the situation has changed. So just wanted your, that. How was, you know, what was this position then and what is the position, what is the new position now?
You're asking me?
Yes, Mr. Jain.
Yes. No, I think I would look at it the other way around. I would look at it that the government has told the court, look, we are going to come back with something for your consideration. So please defer the matter to a week from today. What that proposal is, as I said a few minutes ago, once it's stable, we'll have greater clarity on what it is. And the change, as I've indicated earlier, was the fact that it has itself converted loan into equity. Perhaps it also thinks that the sector needs three viable and strong players. And there could be a variety of such factors which the government as a policymaker could consider, while it's also donning the cap of a quasi-stakeholder at the moment. So I think the most important thing is the positive intent shown towards moving forward and resolving these issues rather than letting these be open-ended. I think that's the message that I take away from today's hearing and the suggestion made by the government.
So I'm not asking you what we should expect in terms of a proposal from the government, but typically how will this work? I think, Mr. Jain, if I can bring in Shiju as well, I think he wants to come in. Shiju, go on.
See, there is clearly a change in government stand. In fact, see, the government changed the earlier dues into equity quite some time back. But earlier petition came up, it was predominantly a DOT view was going on in the government side because we have the sovereign dues pending, we need to collect it. But it's been some time that discussion happened, a lot of petition, and now government also thinking two things, multiple discussions, multiple thought processes going on government's mind. One is the duopoly issue. There is already a lot of debate happened. We also had earlier debate regarding how a telecom infrastructure sector, already we have an issue in airline sector. Similarly, in telecom sector, how bad it will be a duopoly. That thought process is already a lobbying is happening on that side, in government side. Similarly, another side, government also holding a stake. Now it is also not just a DOT interest, it's also a government stakeholder. So there is a change in policy now, government, considering only take the money or a due sovereign due only. It's also now thinking from an overall perspective, how to save the sector as such, and how to streamline the revenue. So I think currently the way now the GST regime is changing, similarly, I think this policy side also, there is a change in thought process. A policy decision might be coming.
It's also, as you said, the timing of it, right? The 4-year moratorium for which Vodafone Idea has to start repaying the AGR dues in installments is up in March 2026. So maybe so far the government had a hands-off approach saying that the company Vodafone Idea will be able to raise the bank debt or external form of funding, some QIP equity fundraise. But since that is not transpired and the deadline is now approaching, March 2026 is when Vodafone Idea needs to start repaying the AGR dues after the 4-year moratorium comes to an end. Since that is approaching, they have very little time. So it's, we've just come to the threshold. It's do or die. Mr. Jain, would you like to make some final comments?
No, I think, as I said, let's wait for a week to have greater clarity. And once we know what the package on the table is, I think we can have a more informed discussion on that. Otherwise, it would be kind of speculating at the moment. But I think the intent is positive. That's the takeaway for today.
Intent is positive. And Gopal, Mr. Jain, what Shiju said, right? So far, the differentiation he made is that, according to him, so far the government was following the DOT view that we need to collect these dues. And now that seems to have kind of changed a little bit. Would you go that far?
And like I said, this would be second guessing something. So it's much better to know everything before commenting on it. But yes, always taking a wider sectoral perspective, a holistic view of things is always a welcome set. Practical, pragmatic approach always wins the day.
No, 100%. Only thing is, after so many, days in the court arguing one side, it'll be interesting to see how they kind of.
As you said, the first time they've gone ahead, they're going to approach with a resolution in mind.
You can treat it like a second innings in a cricket match.
Absolutely, and I think that's well put. Shiju, you want to last word quickly?
Yeah. So I have been telling much earlier discussion also, where government has to intervene with a policy decision, it has to act with the policy. A court proceeding should not be used for a policy as a replacement for policy. Finally, I hope government will come up with a final policy in this regard to save the sector.
I remember that last conversation where you made that point. Gentlemen, thank you very much for joining in, both Mr. Jain and Shiju. Get into a break on that note with the news that the Nifty is still down about 65 points. On the other side, Tushar Pradhan will join in.
Welcome back. Well, markets actually have seen some kind of recovery from the low point of the day. So we were down more than 100 points at the lows of the day. Decent recovery, not too bad. I think a couple of heavier stocks. Even the Nifty Bank actually has cut its losses. Axis Bank is a stock that's fighting back quite strong, and RBL Bank as well. That's another one that I think you should be keeping on your radar. Probability of it moving out of the F&O ban. I'll tell you more about that in just a bit. But we've got Tushar Pradhan, a director at Hexagon Partners, who joins us on the show. Hi, Tushar. How are you feeling about the markets? This 1,000-point rally has come out of nowhere. It's been a bit of a left-out feeling, actually, for many on the street because things were not really looking up. The economy is still very, very soft. But suddenly it seems bulk of the street is betting on a big recovery in the second half of the year. Going by the rate cuts, going by the stimulus measures that we've seen, and GST 2.0. How are you feeling about the markets?
I couldn't agree with you more, Nigel, because I think whatever we needed to really see from a policy perspective, what we wanted to see from an interest rate perspective, I think all of those things are already in place. I think what was missing probably all throughout into the year was an earnings pickup, which we did not see in the last quarter of the last financial year. We did not see in the first quarter of this financial year. And what we are hoping to see a little bit of an inkling of in the second quarter of this financial year. We should see the numbers very soon next month. But I think the big move in earnings growth should come in the third quarter, which should end in December, which is just after Diwali. And that is really when we'll see the bulk of whatever the expectation is, whether it's delivered or not. And of course, the busy season comes in the fourth quarter of the financial year. So I think what we are heading for is that the environment has been prepared. Now the delivery seems to be the one which is lacking. And I think that is something that the market will take a cue on as soon as we see some of the results coming in next month for the second quarter of this financial.
Tushar, hi, afternoon. This is Reema here. In the morning we were talking to Dheeraj Agarwal of Ambit. And he was saying that, we were just discussing how markets have been sideways. And he's like, yeah, this is a themeless market. It's all about individual stocks. And he says, this reminds me of the period, I think of 1994, 95 to 1998, a 4-5-year period where the index did nothing, but individual stocks. That's what made you the returns and the alpha. And he also went on to say that you will see a pop now. If we do get a India-US trade deal, etc., markets will do well. But generally, he expects only a mid-single digit kind of returns for the next few years for the Indian markets. Would you be in that camp?
It's an interesting question. And I think there is some validity to, kind of agreeing with that. And I'll tell you why. If you look at stock market ownership, and I think we're talking about the top 20 stocks across, the Indian spectrum, you will see that almost every portfolio, whether you take it as a mutual fund, whether it's an FII, whether it is a PMS, whether it's an alternative, any portfolio, you will find them chock-a-block with the top 10 companies, whether you like them, whether you don't, because they're all reasonably priced. Now, the problem is that unless there is a significant uptick in the demand for these companies over and above their current holding, and in other words, I'm saying they're overowned, it is very unlikely that these stock prices are going to move anything else except for strong earnings growth. And as we all know, the large companies are not going to grow at double digit. They're probably going to be low double digit or kind of up to high single digit. Now, that doesn't give you a confidence that the market as a whole is going to go up because these companies are likely to now not really have any PE re-rating left into them. Having said that, I think the composition of the market, of course, can change. There are companies at the lower end of every index, which is what we call as the tail of the index, which sometimes gives some impetus to the exchange itself. And that's where we are seeing actually some of the mid-cap indexes and the small-cap indexes continue to do well because they're not so weighted so much to 1, 2, or 10 or 15 stocks. They're across the spectrum. So I think when we look at a market, we need to kind of dissect that and to say which market are we talking about, which index are we talking about. So if you're talking about the Nifty 50, I would tend to agree with your sentence that maybe because of the large companies within the Nifty being so, I would say, over-owned across every portfolio, it will take something really special to move them significantly higher. And as a result, the entire market will be a result of that. So one would tend to agree. But I would not disagree also to the fact that there are significant individual stock opportunities that one should be looking at. And I think that is clearly where the alpha will come in. And I think there is something to be said for active management in a period like this, where most of the large caps are part of the index and they're partly owned across most portfolios in the market today.
Okay, all right. Tushar, I was looking at the holding, the FI holding, and on the whole, they have been very, very underweight. But if you look at sectors, they're holding in IT, that's come down to, I think, around 7.2%, which is, the lowest we've seen in multiple years. And the tech index, as it is, has underperformed. Now, suddenly, the kind of soundbites you're getting from the Globe, valuations, various other arguments are that things could start bottoming out and there is some interest that's coming back. The good part for them is they have clean balance sheets and, the dividend paying out, the cash, cash flow yields as a percentage as well looks pretty okay. Do you think you would start allocating gradually to the tech space?
I think when I look at tech, I clearly make a distinction between the large tech, which is the Wipros, TCSs, Infosys of the world, where they are in a different space altogether, and they are largely led by the kind of offshoring and the outsourcing volume that we get from the US especially. But when we look at mid-cap and small-cap IT, I think that is something where it is very interesting from my perspective, because the large caps are largely going to follow the overall trends of outsourcing in the market, and which is where the question mark is. First of all, in terms of growth, because they already are at such a stage that significant double-digit growth from here on seems very difficult to achieve. On top of that, there are pressures in terms of the economy. Now, we just heard that the Federal Reserve has cut the interest rate in the US, which is signaling some softness in the unemployment figure there, which again tells us that they are either bracing for some sort of maybe a flattening in the economic growth perspective. So if that happens, again, there is more pressure on the larger caps IT businesses in India. So I think there is many probably spanners in the work here to kind of make a very clear, distinct positive for the Indian IT space. And I think that is being reflected in the lightening of the FII portfolios. Now, if you say that if that period of lightening is over and should we look at it back again, I think that should again be circumspect with the kind of expectation of return from here on. So you might get a little bit of a spike, but it's nowhere near going to be something what people should expect from the mid caps, especially in the IT space.
Thank you, Tushar, for joining in. Enjoy your weekend. Let's get back to the markets and talk about individual high flyers, big movers. By the way, the Nifty is grinding lower now, closer to 25,300 now, more than 100 points down. But talking about the big movers today, Hormis is here with that exciting list.
Hey, coming down to the end of the week, so we thought of doing some weekly movers, but then the list of daily movers was a lot more exciting. So we stuck to the daily ones today. Starting off with some of the top gainers from the broader markets, Orchid Pharma is locked in a 10% circuit. It's the biggest single day gain that the stock has seen since August of 24. The volumes are also the highest since May. And you take a look at the volumes, we've been mentioning this over the last couple of days that the movers in the broader markets have moved on very, very strong volumes, and here's no different. 12.5 lakh shares traded, 20-day average is only 65,000, and despite this 10% move today, the stock is among the worst performers on the BSE small cap and is down 55% so far on a year-to-date basis. Hexacom Tele is the other one, 14% higher on this stock. This is also the biggest single day gain since April of last year for the stock, the third straight day of gains. The volumes as well on the higher side, 57 lakh shares have already traded. The 20-day average is only 3 lakh shares. And after this move, the stock is exactly at its 100-day moving average, which is placed at 164, so an important level in sight for Hexacom. And of course, after this 3-day up move, the stock has also crossed its IPO price of 142. On the downside, Bulgaria Industries, but The interesting bit is not the fact that the stock is down 4%. The interesting bit is the fact that the stock at one point was up 15% at the start of the trading session. So the stock has almost cooled off 20% from the day's high, and it has turned continuing to grind lower as the session draws to a close. And take a look at the volumes here as well. And despite on strong volumes, of course, with 4 out of the 5 days this week, the stock has been on the losing front, and the volumes at the highest since August of 2024, with more than 20 lakh shares have already traded hands, close to 25 lakh. The 20-day average is only 73,000 shares, and at the day's high, the stock was moving above all key moving averages, but now it has broken below its 50 and 100-day, and now it is right at its 200-day moving average, which is at 182. And the last one on the list is Anup Engineering. The stock is up 10% today. It's gained in 3 out of the 5 trading sessions this week. The volumes have been on the higher side in today's session. They're set to be the highest since May of 23, and 11 lakh shares have traded today. The 20-day average is only 17,000 shares. And of course, the stock at the above its 50 DMA, and the next one on the upside, the 100-day moving average, comes close to 2650, is down 30% so far this year, but not before the fact that it has moved over 150% last year and has more than tripled in 2023 as well. Back to you guys.
Okay, all right. Thanks a lot for that, Hormuz. So we'll slip into a short break. On the other side, we'll get you some trading calls. A technical expert will be back with us.
Welcome back. Watching Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. We've got about 15 minutes to go to wrap up the day and the week, and Mitesh is now back with us with a few closing trades. Mitesh, slipping a bit. Would you buy at this 25,300 mark?
So actually, around these levels where I want to take a long the index. This is what we haven't done the lesson. But the idea is to use decline to buy into stocks and indexes. So I have two BTST calls. Mankind Pharma is something which is near the day's high. So BTST here with the stop at 2644 for targets of 2680. And Steel Authority of Sale is also near the day's high. That's BTSC as well. Keep a stop at about 135 and a target around 138 can be looked at.
Okay. Thank you very much for that. Let's address before we get to the F&O desk, let's talk about Cohance Tech. The stock is a bit subdued in trade after the company announced the resignation of its CEO. We had a chat with the CFO, Jairam Sampath, and he will tell us what the road ahead is.
Discussion with me that he wants to move on to Bangalore, and that we would like to keep our headquarters here, and our major operations are in Mysore, so we would like to do that. So it has been friendly discussed and then well planned and done. There will be one or two more senior people coming in. There will be one or two more people coming in who has been with me for a long time, and then some people who have been with me for last 1 year, say around 8-9 months, who has been working along with me to take this position. So we have enough internal people who have been working as backup for everything. In another 2-3 days, it will come on.
Okay, Amrish Valika is also joining in for the last leg on the show. Amrish, first a quick word on Cohance Tech. The streets seem spooked, but it managed to recover, and it looks like there will be an internal candidate as a CEO. They have been in discussion with a few, and we could hear the name very soon. I mean, all concerns allayed?
As of now, it seems to be, but I think we'll have to wait for a while for the final appointment. I think that's what I think that's when the serious investors will again start looking at it.
Okay. And this Vodafone Idea, should we read too much into what transpired at the Supreme Court as a lifeline possibly being thrown? I mean, based on what we've heard, would you buy a Vodafone Idea even as a tactical punt?
No, I mean, see, based on what's come out now, I mean, clearly, I think there would be a lifeline because I don't think the government can afford to have just two major players. So the third player is important. So from that point of view, I think Vodafone would get that lifeline. But for an investor, it doesn't make sense because for an investor, a long-term investor needs to see as to when the profits will come. And I don't think we would see major profits coming from Vodafone, at least in the next decade, if not more. So it makes sense from a trader's perspective, a risky trader's perspective. Maybe one can, I mean, in case this thing is settled, then possibly we could see levels of about 12, 14 or whatever it is. I really don't see the stock going much beyond that. So for an investor, it's a clear no. It's only for a trader who can take risk.
Okay, that's the call coming in on Vodafone Idea. What about any of the Adani Group stocks? Big relief coming in, the SEBI dismissing all the allegations of fraud, related party transactions, etc. in the stock, I mean, in the entire group. Stocks have done well today. Look at Adani Enterprises, 5.5% up now by close. Would you be a buyer?
So basically, again, out here across the group, the stocks have moved up. It is clearly a sentimental move because of the SEBI notification. But then again, I mean, as an investor, one needs to look at the fundamentals from a longer term perspective. And from that point of view, I would be a buyer only in Adani Ports for the time being.
Even technically, Mitesh was saying Adani Ports perhaps is best placed if you want to take a trade. Amrish, do stay on. Nigel has moved over now to the futures and option desk, and he'll give us the latest trends.
Well, today the markets have taken a bit of a breather, and the Nifty Bank in particular, after gaining for 12 straight sessions, has taken a bit of a break. But if you look at the future space, well, there is unwinding of long positions clearly that you're seeing on the Nifty Bank. So the index is lower and the open interest as well has come down substantially. On the Nifty options pack, well, two strikes should come up for you on the screen. There is some writing that we're seeing at higher levels. At around the 25,400 call, just take a look at that. Big open interest built up out there. There is aggressive writing that we're seeing. The premium, I think, at the start of today had moved to around 120, 130. That's come down to around 55 rupees. So there is writing that we're seeing at that levels. On the downside, some of those put writers, they are packing their bags. They're moving out. The 25,450 put Big open interest shedding is what we're seeing at that particular strike as well. What does this mean in terms of levels? I think the market's the near-term reference mark comes in at around 25,150. That's the level that we highlighted at the start of this week at a bit of a resistance zone. We crossed that mark, so that becomes the first level of reference on the downside. On the upside, going by the options data, 25,550. Well, that appears the level that the bears, they want to come in there, they want to fight for that particular level. Moving to stocks then that we are tracking, Vodafone Idea, that's the one that in fact did see a lot of short built up out there. That's coming for a bit of a short covering bounce as well. So, that one should come up for you on the screen. Your Pyramid Pharma, there is some fresh buying that we're seeing on that particular counter. So that as well comes up for you on the screen. Good amount of buying on that name. And, stocks that could potentially move in and out of the band. Let's highlight a few of them. Saman Capital, well, that one is seeing massive open interest build up today. The last time I checked, going by the file, it appears that this is a stock that's going to move into the F&O band. So I'm going to keep an eye out on Saman Capital. By the end of today, when you get that file, that could possibly be a stock that moves into the F&O band. And RBL Bank, I'd mentioned yesterday, it was on the edge now with regard to coming out of the F&O band. It appears today, by the end of today, that's going to be a stock that could potentially come out of the F&O band. The shorts in the system are getting a little bit nervous on this name. So RBL Bank is a stock that I'll be looking at.
Thank you. For that, we will slip into a very short break. We'll come back with the closing.
Welcome back. Here, tuned in to Closing Bell. Well, Sanjiv Goenka, the chairman of RPSG Group, spoke to Shireen Ban earlier today about the group's big capex push, the growing renewable energy ambitions, as well as other aspects in terms of the group. Let's listen in to what he had to say.
For the next 5 years, what we are committing to is a total capex of about 1 lakh crores, largely in the energy area. It'll go also in chemicals, but chemicals is not that capex intensive, as you know. So renewables is going to be a large part of our investment. And let me make an announcement today on CNBC-TV18. It's not only solar and wind hybrid projects that we are implementing. We propose to get into module and cell manufacturing. Our first gigawatt of module capacity goes on stream in the next 45 days. So that's something we've been quietly implementing. And in the next 3 years, there'll be 3 gigawatts of cell and 3 gigawatts of module capacity that will go on stream. We're keen to get a share of that pie. We already operate in UP, in Greater Noida, and that's one of the most successful privatization cases of power in the private sector. And it is UP's most successful utility. So we have now begun to understand how to operate in UP. And Yogi Ji's government provides a very secure law and order, and so helps a utility for sure. We're keen, and we are going to bid.
Well, interesting snippets from that particular conversation. By the way, just pull up the erstwhile ITD cementation. I think it's now known as Sempro. The intraday chart should come up for you. That suddenly has fallen off the cliff. So I think let's get the intraday chart of that one. Sem India projects, I think that's what it's known as right now. That one's moved down. It's down 6.5%. And the other one I'm looking at is Powermech. Massive volumes out there for that sort of a counter. You know, from the highs of the day, it's seen some kind of profit taking. We'll have to see whether or not there's a large trade that has taken place, because the volumes indicate very, very large volumes just in the last 1 hour or so. But we still have Amrish Baligaus with us. Amrish, tell us that one pick that you normally give us. What's on your radar today?
Hi, Nigel. It's ABB, which is a technology leader in electrification and automation. I mean, they have 4 business segments: electrification, motion, process automation, and robotics. Last quarter, the order flow was a bit weak, and but still, the overall order book is quite decent at about 10,000 crores. Again, last quarter, they had that forest fluctuation and quality control order implementation, which had a negative effect on margins. So the stock had corrected. So it seems a buying opportunity, because the order flows are expected to improve over the next 2 quarters, along with margin expansion. And another big trigger going ahead would be the demerger of the automation and the robotic business into a separate listed entity. And I think this should happen in the calendar year 2026. So I think that should be a big trigger. Even otherwise, expected consolidated EPS in calendar year 27, I'm expecting it to be 115. And with that, my target price is about 6,325.
Okay, all right. Amrish, appreciate you joining in on the show and giving us your view on a lot of stocks that we discussed. Thanks a lot for joining. We'll keep an eye out on this one, ABB India. Well, it's been a good week for the bulls. You know, the Nifty will still go home with gains. But in today's trading session, we did have some profit taking both on the Nifty and the Nifty Bank. After 12 straight sessions of ending in the green, the Nifty Bank today went home with a cut of close to around 250 points. What took a hit from the banking names? ICICI Bank, that was down 1.5%, and HDFC Bank. So the large constituents of the index, well, they came in for profit taking. What stood out from the banking pack itself? You had IndusInd Bank, that went home with gains of around 1.2%. You had SBI Life as well, that did pretty well. But the stocks that really caught your attention today is Adani Enterprises, Adani Energy, Adani Green. Post that SEBI clean chit, well, these stocks did bounce up and trade. So good move is what we saw in all of those names. Vodafone Idea, that was the stock actually of the day. Lives to fight another day. And, you know, that's why, in fact, the street is quite excited that hopefully there could be some kind of relief that's in the offing. But that one ended high with a gain of around 8%. Remember, it's not a one for the faint-hearted, but the commentary did appear in favor of them. You had a Morgan Stanley note with regard to initiating coverage on Adani Power. that stock went home at the high point of the day with a gain of close to around 13%. Other stocks that did well, NetWeb was up close to around 8%. You had Adani Total Gas that was up 7.5%. The Adani Group stocks actually did quite well. Hind Rectifiers, they've done that acquisition in Europe. I think it was a company under distress. So that stock, in fact, does go home with good gains even in today's trading session. So all in all, the bright spot of today was that the Midcap index was in the green. The headline indices did come in for some profit taking, and a lot of stocks were bobbing around. Anantaraj was the stock that went up with gains of around 9%. Try Gentech, a stock we don't talk about very, very often. That one as well, circuit up close to around 20%. Well, we'll wrap up on this edition of Closing Bell. You stay with us. Editor's Roundtable comes up next.
The last three clocks gains for the week. In fact, it's the third week in a row. And this has happened for the first time in 5 months. The Sensex and the Nifty have gained nearly 4 percentage points. If you accumulate the gains over the last 3 weeks, this week, the frontline indices are up close to about 1 percentage point. Now, over the next 30 minutes on Editors Roundtable, we'll decode last week's action. We'll put the spotlight on Urban Company, what a stellar debut it's had. And we'll tell you why JP Morgan is betting big on India's CRDMO space. Hello and welcome to Editors Roundtable. I am Rima. With me is Ekta Prashant will be joining in. We've left that chair empty for him for now. And Hiren Ved, Director and CIO at Alchemy Capital, is here with us in the newsroom. Hi.
Hi, Rima. Hi, Hiren. Welcome to the show. Well, definitely some amount of a pullback is what we've seen this week. We've seen a little bit of the clouds being lifted when it comes to, maybe thawing of relations between US and India. We've seen a very good listing from Urban Company as well, and we've seen the Fed cut rates as well. So given all of that, what's your sense, Hiren? Do you think that maybe the end of the year we could probably see a rally for the Nifty as opposed to the consensus view of consolidation?
Well, I think the markets have been consolidating for almost a year now, right? We've negotiated a slowdown in the economy last year, then we negotiated a couple of wars, we've negotiated the whole, trade and tariff uncertainty. And I think we seem to be coming out of that. I think all the conciliatory remarks that we've seen over the last week or so makes people confident that the last irritant for the markets to kind of take off is also well in play now. And I think we shouldn't forget the fact that the big GST cut came as a significant surprise, upward surprise for the markets. And everybody's looking forward to a very constructive second half of the year, I must say.
So the opinion seems to be, Hiren, that, markets are due. We're poised for some sort of a recovery because last 13 months we haven't done anything. So we will get that bump up for all the reasons that you've said. But the question is, what happens thereafter? Can it be a durable recovery, or are you still
First, let's enjoy the recovery.
But do you think new highs are coming by Diwali? Or year end?
I think definitely by year end.
By year end.
By year end, for sure. Yeah, I think by then, hopefully, we should have hammered out some kind of a deal with the US as well. And everybody would be very keenly watching the auto sales numbers and, the updates that would probably come before the end of Q3. So I think there's a fair chance that we should be hitting new highs going into Christmas.
Oh, okay. New highs going into Christmas. There's going to be an event which is going to take place on Monday. The two-tier GST structure is going to come into effect this Monday itself. What's your sense in terms of what the festive season is going to look like for big ticket purchases such as autos, as well as the smaller ticket purchases in terms of consumption?
So I think given the fact that the GST was announced in August and then people kind of held back big ticket purchases like autos. I think we should see there is a considerable amount of hope and excitement that, the cut has been quite significant at the lower end of the higher ticket.
Hello.
Hi.
That's what we call making an entrance.
Thought I'll surprise you guys.
Yeah. Well, you did. But he just gave us the headline that he expects markets to hit new highs at least by Christmas.
Yeah, and we're discussing GST now.
Now he's talking about GST.
New highs by Christmas.
By Christmas.
But that new high is what, 3-4% away, right?
It's not much.
I'm just keeping some cushion.
But not a 10-12% kind of a bump up. It will be...
I mean, it's difficult to say, but I think it's, one can't rule it out, right? Because, one could argue that last year valuations were high. Last year earnings growth was just single digit. But at least I think the second half of the year we should see earnings move into double digits, right? And then as we move into December, people will start discounting FY27. And then it looks like maybe a 10-15% move over the next few quarters should not be a very difficult ask.
I heard 10-12%. This is not now because markets have moved up very quickly last 3-4 days, right? I mean, I think 3-4 days back, I heard by the end of the year, 10-12%, which basically gets us to 27,000 kind of levels.
Yeah.
And I don't know, I mean, possible. One person I was talking to, not on air, but off air, said that, well, I went to the City conference, Jeffries conference, which just finished, and a couple of others. He said, the classic signs amongst at least FIIs, foreign investors, of, meeting attendance is low, general apathy.
Yeah.
So his point was, this looks like a pretty classic contrarian kind of setup for the market to do well.
Correct.
From here.
Correct. Because as I was telling them that, a lot of people, other than the retail investor who kept investing in mutual funds, I think a lot of people were sitting on the sidelines, given what was happening on the trade front. It almost felt like India was singled out. And I think whenever India has underperformed the other global markets by such a big margin, usually there is a reasonable catch-up that happens, right? So I think probability-wise, there's a pretty decent probability that we should see a very good move over the next few months, at least.
Okay, well, let's get talking about one particular incident in the market, which was actually the bumper debut of Urban Company after it listed on the bourses at a 60% premium. Reema, you've been following this particular story from the start. You interviewed the promoters as well. So give us a sense in terms of the statistics and what the market is making of it.
Well, just first quick numbers. 103 was the issue price. On Friday, the stock closed at 185. Market cap has crossed 25,000 crore rupees for Urban Company. Last year, FY25, the company's top line was about 1,150 crore. But of course, it's been growing at 30%, and the management seems fairly confident that that rate should continue, and it has broken even. Now, what is the opportunity ahead? Well, they said the total addressable service market for them was $57 billion last year. They see it going up to $97 billion by 2030. That's nearly $100 billion of a size. They're planning to target 200 cities by FY30 versus 47 cities. But that is one growth area. In the current market that they're in, expand it to 200 cities, go deeper, go wider, etc. The second one is InstaHelp, which is, the quick made in 15-30 minutes you can get if your buy doesn't show up. That is a $10 billion opportunity. And the third one is Native, where they're manufacturing products, hardware products. And right now they only have two. One is smart locks and the other one is water purifiers, because they said in their experience, because they've been servicing the space for so long, the complaint was that people keep calling us for changing filters, right? Every 6 months you need to change a filter. But with this one, the Native brand, you don't need to change a filter for 2 years. But the sense you get from the management is that it's a very calibrated approach to expansion. They're not jumping in. They know it's a tough market to execute because you have so many service professionals. So we asked them that, is Native planning to expand into other categories, etc.? He says, no, not as of now. We will eventually. But, we want to make sure the losses come down. Very categorical that we will not let the losses of Native eat into the profits that we are making from the home service market, which they're acing, and they have pretty much a monopoly. So it seems a very calibrated, very, grounded kind of a management, and they acknowledge the opportunity, and they're going to take it step by step. And it's a duopoly right now. So, everyone seems to, just look at the kind of reception it's got.
Yeah, I think in either consumer products or a B2C kind of business or services, I think investors were looking for something that was growing. So, beyond the FMCG companies, which were finding it extremely difficult to grow beyond single digits or, even low single digit volume growth, I think some of these opportunities come as a breath of fresh air. And I think there is also a level of confidence the way Eternal and many of these stocks have scaled, right? And I think somewhere the investing community now feels that, yes, how do we play the consumer markets or the service or the B2C markets where things are growing much faster than the other available opportunities that were there. So I think...
But you didn't participate as anchor investors?
Well, we already have our plates full with some of the
tech companies that you own. Urban is not something that you own right now.
We have been owning Eternal for quite some time now. We also have some exposure to Paytm. We have some exposure to car trade. So we have a fair bit of exposure across what you call as platform companies.
So it's yesterday we were having this discussion on editor's playbook, and somebody asked, I think Sriram asked, how do you categorize? What are these companies? They're FMCG, they're this. So there's all kinds. I said, well, they're convenience, consumer, internet, right? So it's all about convenience, right? I mean, you want food at home, you want, as you said, buy at home. And of course, there's internet, there's a platform aspect, as I think Hiren said, and the consumer, which I think is very clear. But you said it's a duopoly, which is the other one.
No, I said it's a monopoly in this.
It's a monopoly.
It's a monopoly in this.
By the way, did you know there's a company?
Even I heard duopoly, but I was wondering which other company.
Then I'm getting. I think
it's Friday Blues.
Friday.
But I think there's a company called, I'm told, Yes Madam.
Yes.
Yes.
Do you know?
I've seen it on Instagram. Come up
oh,
a couple of
It's
times.
apparently it's all women.
Yeah.
And yeah, I mean, obviously it's much smaller, but it's there.
Yeah.
I was told.
Yeah, it's there, and it's advertising a lot.
So we spoke to Axel Partners, and they said that at the time that they invested in Urban Company, they had spoken to 20 other companies, such as Urban Company, and they only chose Urban Company. So it's actually one out of many that eventually survive or, reach the scale that you're talking about. So let's see what happens in the future.
Yeah, it's a tough business because you're dealing with so many,
service professionals, as they call it.
Yeah. It's only few people who know how to manage this can really scale.
And the biggest risk is that they'll give you the number and say, call me separately and I'll come and do the service.
Yeah,
so
I mean,
that's
all
the
of
biggest
those
risk.
happen. But I guess over a period of time, if you are able to provide reliability of service, then people will stop taking these shortcuts.
The other route and...
The disintermediation, that's the word for it.
But in terms of when to buy, say, something like an urban company, it's not a commentary on urban company, but you take a look at Swiggy, right? Listed, did well for a while, had a sharp correction, right? Many people panicked for a while. Zomato was a classic example.
Correct.
Huge correction. I looked at PayP FinTech, 2021 listing, from 1100 fell to 400. And then, of course, it's had a one-way kind of move. So is there something to be said about when to buy these kind of companies, not chase the initial few days when everyone is chasing it, and then wait for that euphoria to be out?
Yeah, I think when these first few listed, which was in 21, etc., right? I mean, I think, first of all, there was a lot of euphoria about digital and the internet because we were just coming out of COVID, right? And the valuations were very high. Obviously, all these companies were losing money and there was no real visibility when these companies would turn profitable. I think over a period of time, as each of these companies has focused on unit economics, on getting to EBITDA positive, I think the markets has more confidence that yes, some of this can work, right? And I think once that confidence came in, I think there was greater participation, across the board. And that's why I think Urban got such a fantastic debut on
So it's possible that some of the corrections we saw initially on all these other names, we don't see. Who knows?
Who knows?
I mean, because people have now seen that these eventually make money.
Correct.
So, why not just hang?
But again, I think we have to be, I think one of the things about the internet businesses is also that it's very important to judge who's going to be the number one or the number two. Because typically in these kind of businesses, it's the winner takes all, right? The number two or the number three really has, they don't get the share of market cap that the number one or the number two player gets. So I think the ability to assess that in the subcategories is extremely important. And that's why you see the differentiation in the valuation between, let's say, an Eternal and a Swiggy. Right? It's very significant.
$35 billion for Eternal and $11 billion now for Swiggy. So yeah, I mean, and of course the P multiples are very different.
Correct.
As well. Let's talk about the next one, right? JP Morgan is betting big on India's CRDMO space with Cohance and Divi's as their top bets. We, by the way, had the management of Cohance today with us, Ekta. We spoke with them.
Yes, absolutely. So I'll just give you a brief in terms of what JP Morgan is saying. CRDMO seems to be this big buzzword that we are working with in the pharmaceutical space. They've estimated that the Indian CRDMO market could grow around 13% CAGR to $15.4 billion by 2029. Outsourcing is a key driver, with global pharma increasing their reliance on CRDMOs. Now, India is emerging as a preferred outsourcing partner due to a couple of reasons over China, which is basically stronger regulatory compliance, IP protection, lower labor costs, and Obviously, the drivers are China +1, EU +1, and the US-China tensions, which are positioning India as a high growth contender. Now, JP Morgan has initiated with an overweight on Divi's and Cohance. They have a target price of 7,800 on Divi's and 1,300 on Cohance. And Divi's, according to them, stands out for the organically built scale, strong process chemistry. And for Cohance, they're betting on the ADC market, which is basically the anti-drug conjugate market, particular cancer therapy. We did have Cohance on the channel as well earlier in the morning, Hiren, and they're committed to that 2030 guidance of $1 billion. They're saying that RFPs have increased significantly in the past couple of weeks itself. They've received multiple RFPs. So there seems to be this big market, which is not also, and that those RFPs are for the non-ADC market, whereas ADC is also a separate engine of growth for them.
Yes.
So give us a sense, because you look at CDMOs, which ones do you like? Why do you like them? What's the growth opportunity there?
Well, the two that you mentioned are both that we own. Divi's is a bigger position for us, but we also have an investment in Cohance as well. It's a large market, and I think Divi's by far has executed absolutely phenomenally, right? So while there's been a lot of excitement about CDMO now, but CDMO is not a new opportunity. I think Divi's and before that Syngene, which was also one of our portfolio companies at a point in time, we saw that opportunity quite early, and I think it makes a lot of sense. I also believe that given the to and fro on generics, right, in terms of tariffs and so on and so forth, I think investors have preferred to invest in CDMO, which doesn't have those risks of tariffs, etc. And also it's a long-term structural growth story. Margins are good, return on capital is very good, and entry barriers are significant, right? So I think this could turn out to be, I would say, the next IT services kind of opportunity from India.
Hiren, expand the universe a little bit, not asking you for this or that, but what else are you interested in? Have you bought recently, last couple of months?
Well, actually, we haven't changed much of our portfolios, if you ask me, and I think for the longest time we've been bullish on 3-4 big areas. Our largest exposure is to consumer discretionary, and then some of these platforms included in that. So anything that is premiumizing, we think that there is a big opportunity there. We continue to have fairly large exposure on industrials and capital goods across power, defense, and all of these areas. We still feel we are quite bullish on that. We also have some exposure to premium real estate, which you could count as consumer discretionary. Given the amount of wealth that is being created in this country, I think every promoter who's selling shares is then going and buying flats in Camellia or wherever. But we think that longer term, we think real estate is underrepresented in India's capital markets. So we see that. Another area that we are bullish is the sort of capital market plays, asset managers, wealth managers, exchanges. We have a pretty decent exposure there. And then we have exposure to healthcare across hospitals and some of these CDMO plays. And then in tech, we have some very specialized players, more in the ER&D space, not the larger cap companies.
A company like NetWeb, have you looked at it, Hiren?
We own it, yeah.
Oh, you own it?
Yeah,
Wow.
we bought it immediately after listing. So we're still owning it.
So it's how many bagger?
It's been a 6-bagger now.
So far.
Oh, wow.
Yeah.
What else in specialized tech?
So again, we own KPIT. We own Latent View. We own NetWeb.
For our viewers, because there's not that much coverage, I think IIFL covers NetWeb. Just very simply, if you can briefly tell us the...
Yeah, so I think for us, what we found interesting was that high-performance computing, cloud computing, AI, I think all of this is going to drive demand for localized built hardware and software systems. And I think NetWeb was the only company, when it got listed, we were quite amused that out of the top 250 supercomputers around the world, 50 were built in India. And many of them were built by NetWeb, right? And we realized that, anything which has to be high-tech, whether it is semiconductors, whether it is AI, every country wants to build domestic capabilities. And we thought this was a great segue.
So they don't build the chips because there's some connection with NVIDIA
No,
as well.
build the boxes, they build the servers, and they build the software that is built onto the servers, right?
And I think they have a supply line with NVIDIA for chips. So that's the other one, right?
Yes.
Which is also, because those chips are hard to get. And I think they have an agreement.
I think anybody who builds high performance computers will need those chips, right? And when the IPO happened, many of these big IT service companies used to buy, the cloud computing hardware from them, right? Which gave a lot of credibility, because if Infosys is buying from them, then you know that.
And where is it now placed in terms of valuations and growth rates?
Well, it's been growing at 25-30% a year. And this was before the whole AI opportunity opened up. And now with the AI mission opening up, and I think more of compute and data center capacity will come up in India, my sense is that it will continue to grow at 25-30% a year for the next few years.
And where does it trade in terms of what are you paying for it?
I think it's now upwards of 50 times. Anything that is growing is not cheap.
What about latent view analytics? We don't often talk about it, but that's a quasi-consulting play, right?
So I think Latent is quite interesting. It's actually a data analytics company, right? And everybody talks about AI, but once, and what we generally talk about is AGI, which is the large language models. But I think once you start using AI in enterprises, then you need to have specific applications which may be relevant. So let's say a bank would use AI differently, a consumer business will use AI differently. But before you can start using AI, you need to get your data and your data sets in place. So I think what a company like Latent View does is they help an enterprise to make sense out of that data, so that then you can have a specific LLM which you can train on that data set and then start using AI in several of the functions within an organization. So that's actually like a step before you start using AI in your organization. So so we thought that there are no direct AI plays in India. There is very little, but we thought that Latent View could be a very interesting way of playing the AI trend globally. And if you look at it, they have all the Fortune 500 companies as their customers, right?
Okay. There's a company called, I discovered it about a month ago, unlisted of course, called Cursor. It's 18 months old, $10 billion valuation. And what they do is, they're like a layer between you as a coder and ChatGPT.
Oh.
So you got a code, and ChatGPT will help you code, but how do you use it in your organization for your specific needs of coding? So it sits on top of, as a layer between you and ChatGPT. It uses ChatGPT, that's the engine. But they just provide a way for you to be able to use it in a more efficient way for your specific situation.
It's so interesting that this entire conversation for the last 30 minutes, majority has been in the new economy and nothing in the old economy, autos, infrastructure, cement, everything.
Pharma's universal.
Yeah, pharma, CDMO, that's the new segment that we're talking about.
I think you will see the revenge of the old economy coming back now.
Anyway, Hiren, it's been a pleasure. Thanks very
so
much for joining
But I must say, I spoke a lot of individual names, so as a matter of disclosure, we have interest, and we have our clients have investments through our PMS and AIF scheme in all these companies.
Absolutely.
So,
all right.
Thank you so much.
I think we have the disclosure up on the screen now. So the producers just pulled that up. So absolutely, all good.
Yeah.
Thanks very much.
Thank you
for joining us.
Thanks.
Well, I think it's a wrap on this edition of the Editors Roundtable. From all of us here, it's goodbye. Thanks very much for watching. More comes up on the other side.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty gained for the third straight week despite a lackluster Friday. All sectoral indices in the green, barring FMCG. Rupee remains above the 88 mark against the dollar. Centre seen relaxing its position on granting relief to cash-strapped Vodafone Idea tells the Supreme Court that it does not oppose the telecom company's plea seeking relief on AGR dues. Des says some solution may be required, claims facts have changed on the ground. The government owns 49% stake in Vodafone Idea.
It's not only solar and wind hybrid projects that we are implementing. We propose to get into module and cell manufacturing.
RPSG Group Chairman Sanjiv Goenka commits to a capital expenditure of 1 lakh crore rupees in the next 5 years, tells CNBC-TV18 that their first gigawatt of cell module capacity will be going on stream in 45 days, says they're looking at releasing their first AI-generated film in 12 months. US government targets Iran's Chabahar Port, which is being developed by India, revokes the waiver on sanctions granted in 2018. This is a setback for India as the port is crucial to access Central Asia and Afghanistan. Chabahar Port is also close to the Gwadar Port in Pakistan, developed by China. Donald Trump and Xi Jinping are scheduled to speak today as Washington and Beijing try to finalize a deal to keep Tik Tok operating in the United States. The talks could be a precursor to a potential in-person meeting later this year. This would be the second call between the two leaders since Trump returned to the White House in January for a second presidency. US President Trump threatens to cancel the licenses of TV stations that criticize him. This comes after pressure from the administration led to ABC suspending late-night host Jimmy Kimmel for making some remarks about the murder of conservative influencer Charlie Kirk. Israeli military mobilizes more troops as it continues the ground assault on the densely populated Gaza city. The death toll in Gaza has crossed 65,000. United States blocks a UN ceasefire resolution for the 6th time. The truce call was approved by 14 out of 15 member states, barring the US. And Apple's new iPhone 17 goes on sale. Thousands throng Apple stores across the world. A scuffle breaks out at the Mumbai Apple store. The starting price of the phone in India is 83,000 rupees. All right, let's start with the day's market action. Sensex and Nifty gained over 1% this week despite a lackluster Friday. Both indices lost less than 0.5% today. In the last 3 weeks, Sensex and Nifty have gained 4%. All sectoral indices, barring FMCG, gained this week. In the money market, the rupee gained some strength against the dollar but remains above the 88 mark. 10-year bond yields softened in trade today. And several listed entities of the Adani Group surged in intraday trading session today. This after market regulator SEBI gave a clean chit to the group on some allegations by US-based short seller Hindenburg Research. The group added nearly 70,000 crore rupees in market capitalization, taking its overall valuation to around 14 lakh crore. The SEBI order details that it found no violation of laws, fraudulent practices, market manipulation or insider trading. In a post on X, chairman of the group, Gautam Adani, said, and I quote, SEBI has reaffirmed what the group has always maintained, that the Hindenburg claims were baseless, end of quote. And the big story we are tracking this evening, shares of Vodafone Idea surged after the government relaxed its position on granting relief to the cash-strapped telecom player. The government has told the Supreme Court that it does not oppose the telecom company's plea seeking relief on AGR dues. Remember, the government owns 49% stake in Vodafone Idea. Ashmit Kumar is here with more details on this hearing. Ashmit, what are you picking up?
Well, major relief coming in for telecom player Vodafone Idea. The government batting squarely in defense of Vodafone Idea, asking for support for indulgence of the Supreme Court to bring about some form of solution to this Vodafone crisis. This is the first time that the government is openly rooting for Vodafone Idea, citing its own status as an equity shareholder in the company to as high as 49%. Now, this is not the first time that Vodafone Idea has filed a petition seeking relief as far as AGR issue is concerned. What is different, however, is the stance of the government. Previously, the best that Vodafone Idea got, like in the month of May, is the DOT, is the government being neutral, neither batting for or against any such relief, leaving the matter to the wisdom of the court. And as we've seen previously, the court had rejected previous such applications. Now, however, for the very first time, the government is squarely batting for relief, saying that they are equity shareholders. The facts on the ground have changed, that the situation demands some kind of solution, some kind of intervention, that the government is willing to work on some form of solution to address this issue of Vodafone Idea. The concern, of course, being that Vodafone Idea, as a part of its petition, saying that if this relief is not granted, it will threaten the existence. The company will go under. So clearly, relief being asked for by Centre in favour of Vodafone Idea. The Supreme Court, for now, willing to hear the DOT, willing to Vodafone Idea further. The hearing, we understand, will resume next week on Friday.
Right, thank you, Ashmit, for that update. And sticking with court hearings, the Supreme Court judge has recused himself from hearing a PIL against Vedanta, Hindustan Zinc and Vedanta Resources over alleged financial irregularities and regulatory violations. The petition cites a report by US-based financial research group Viceroy Research. The report alleges that the companies are draining listed entity Vedanta via disproportionately large dividends and artificial brand fees. The case is now expected to be listed before a fresh bench in the Supreme Court for further hearing. The big news maker this evening, RPSG Group Chairman Sanjiv Goenka, has said that the conglomerate plans to venture into cell and module manufacturing, and the first gigawatt of capacity will be going on stream in 45 days. In an exclusive conversation with the CNBC-TV18, Goenka said the company will also look at the export opportunities of these cells and modules as they offer a good business model. He also exuded confidence about achieving a market cap of 2 lakh crore rupees and committed a capex expenditure of nearly 1 lakh crore rupees in the next 5 years. Speaking on the future revenue streams for the group's entertainment subsidiary Saregama, Goenka said that the conglomerate will ride the artificial intelligence wave by venturing into AI-generated video content. He said that Saregama will hopefully launch its first AI-generated film in 12 months.
For the next 5 years, what we are committing to is a total capex of about 1 lakh crores, largely in the energy area. It'll go also in chemicals, but chemicals is not that capex intensive, as you know. So renewables is going to be a large part of our investment. And let me make an announcement today on CNBC-TV18. It's not only solar and wind hybrid projects that we are implementing. We propose to get into module and cell manufacturing. Our first gigawatt of module capacity goes on stream in the next 45 days. So that's something we've been quietly implementing. And in the next 3 years, there'll be 3 gigawatts of cell and 3 gigawatts of module capacity that will go on stream. We're keen to get a share of that pie. We already operate in UP, in Greater Noida, and that's one of the most successful privatization cases of power in the private sector. And it is UP's most successful utility. So we have now begun to understand how to operate in UP. And Yogi Ji's government provides a very secure law and order, and so helps a utility for sure. Mm-hmm. We're keen, and we are going to bid. We are looking at getting into AI-generated films.
Okay.
So the whole film
will be AI.
It will be AI.
Okay.
And So you produce it at a fraction of the cost. So the whole entire film, so the scripting is normal. Everything is normal.
That's still people.
That's still people, but the whole production and the whole casting is AI.
So there won't be any actual actors?
No.
When will we see the first AI film being released?
Hopefully in 12 months.
In 12 months?
Hopefully.
And you can catch the entire conversation with RPSG Chairman Sanjiv Goenka at 4:30 and 10:30 p.m. right here on CNBC-TV18. The other big story, in a bid to ramp up pressure on Iran, the US government is targeting the Chabahar port in the country, which is being developed by India. The Trump administration has revoked the waiver on sanctions granted in 2018. This is a big setback for India as the port is crucial to access Central Asia and Afghanistan. It's also a hub that links India with Russia and Europe. Parikshit Luthra is here with more on this. Parikshit, please take us through what this means for India and India's maritime security and trade.
Well, the Chabahar port is important because it has been India's major strategic and geopolitical counter to China's bet by China. India had proposed to develop the Chabahar port for the first time in 2003. India's vision was to build Chabahar as a major regional and international hub for humanitarian purposes and movement of goods. India and Iran signed a MOU in 2015 to develop the Shahid Beheshti port at Chabahar, Iran. This is a crucial India-Iran connectivity hub which counters China's presence in the Arabian Sea. In 2024, India and Iran signed a long-term contract to develop Chabahar port. Chabahar has been India's gateway for trade with Afghanistan and Central Asian countries. It has all the plus points of a major cargo hub. This is a deep water port providing easy access for large cargo ships. It is also connected by road with Afghanistan. India has used this port for sending wheat, medicines to Afghanistan. The plan is to use it for trade in textiles, engineering goods, pharma products, also food to Afghanistan and countries in Central Asia in future. Chabahar serves as a key hub in the international north-south transport corridor linking India with Russia and Europe as well. India had pledged investments of $500 million in Chabahar in 2016. In 2024, India said it will invest around $120 million in the Shahid Beheshti port in Chabahar. A credit window of $250 million has been provided for infrastructure upgrades, and India has already supplied port equipment worth about $24 million to develop the Chabahar port.
All right. Thank you, Parikshit, for that update and the important developments as far as the U.S. is concerned. Shifting focus now, U.S. President Donald Trump has wrapped up his visit to the United Kingdom. The UK rolled out the red carpet with lavish ceremonies at Windsor Castle. At a joint press conference with Prime Minister Keir Starmer, Trump criticized Russian President Putin for letting him down over Ukraine. He also condemned European nations for buying Russian oil and suggested Russia might settle if oil prices fall. When asked about India, President Trump defended the punitive tariffs, but also added that he has a good relationship with Prime Minister Modi and praised his statement after a phone call between both leaders earlier this week.
When I found out that the European nations were buying oil from Russia, and as you know, I'm very close to India. I'm very close to the Prime Minister of India. I spoke to him the other day, wished him a happy birthday. We have a very good relationship. He put out a beautiful statement too. But I said, I sanctioned them. China is paying a very large tariff right now to the United States, but I'm willing to do other things, but not when the people that I'm fighting for are buying oil from Russia. If the oil price comes down, very simply, Russia will settle.
President of the World Economic Forum, Borg Brent, believes that the trade challenge between India and the US will be solved within weeks. In a fireside chat at the PAFI Annual Forum, he told Shireen Bhan that both Washington and New Delhi are keen on a resolution soon. He also flagged weak foreign direct investments into emerging and developing economies.
You're coming to New Delhi via Washington, D.C. Do you come bearing good news, Borge Brende, for the India-US relationship?
I think yes. I think that challenge will be solved in the coming weeks. My impression also when I was in Washington, D.C., was that they're serious about finding solutions, and with the people and the ministers I met here, I think it's the same approach. And of course the tariffs are the tariffs, but I think the most challenging tariff, the highest of all tariffs today, is uncertainty.
President Donald Trump and China's President Xi Jinping are scheduled to speak today as Washington and Beijing try to finalize a deal to keep Tik Tok operating in the United States. The talks could be a precursor to a potential in-person meeting later this year. This will be the second call between the two leaders since Trump returned to the White House in January for a second presidency. President Trump has threatened to cancel the licenses of TV stations that criticize him. This comes after pressure from the administration led to ABC suspending late-night host Jimmy Kimmel. The administration alleged that Kimmel implied that the murder of American political activist Charlie Kirk was committed by a Trump supporter. Protesters have begun demonstrations across Los Angeles questioning the network's decision to indefinitely suspend Jimmy Kimmel's show. When asked about it, President Trump lashed out at the media and defended broadcast regulator Brendan Carr, who's being seen as the man behind the crackdown on late-night TV hosts.
Well, I read someplace that the networks were 97% against me. I get 97% negative, and yet I won it easily. I won all 7 swing states, popular, I won everything. And if they're 97% against, they give me only bad publicity or press. I mean, they're getting a license. I would think maybe their license should be taken away.
Israel has intensified its ground operations in Gaza City. The Israeli army is forcing tens of thousands of Palestinians onto coastal roads to drive them out of the Strip's main urban center. Gaza health officials have said that Israel's army has killed at least 16 Palestinians across the enclave since dawn. The United States has once again vetoed a United Nations Security Council resolution calling for an immediate and lasting ceasefire in Gaza. The resolution was approved by all 14 other council members. It also urged Israel to lift all restrictions on aid into the besieged enclave. The U.S. maintained that the resolution fails to condemn Hamas or recognize Israel's right to defend itself. And coming up next, Apple's new iPhone 17 goes on sale worldwide. A scuffle breaks out at the Mumbai Apple store. The starting price of the phone in India is 83,000 rupees. Welcome back. Last month, the RBI asked the public if the inflation targeting framework is working or if it needs to be tweaked. CNBC-TV18 polled 15 top economists to gauge their reaction to these questions, for which RBI is seeking feedback. Lata Venkatesh is here with the details. Lata, what did the poll reveal?
Well, let me start at the beginning. Since 2016, the Reserve Bank's Monetary Policy Committee has a mandate to keep inflation at 4% plus or minus 2%. The framework needs to be reviewed every 5 years as per the law to check if the 4% target is appropriate. Hence, Reserve Bank put out a discussion paper late August asking 4 questions. The first question posed by Reserve Bank in its discussion paper is, should Reserve Bank target headline CPI or core inflation? That is, inflation excluding food and fuel, since food prices in particular are driven by bad weather and not really controllable by interest rates. What did our poll say? 90% of those polled said Reserve Bank should stick to the headline inflation, since a target that excludes food would make no sense to the common man. Only one economist polled said Reserve Bank should target CPI inflation excluding vegetables. Now, the second question Reserve Bank asked was, should RBI retain the target at 4%? All the economists polled said yes, target should stay at 4. One economist said that in the West, inflation is getting higher than their long-term trend of 2%. And that may well happen in India, but even he didn't want the Reserve Bank to raise the target from 4% because that will indicate weak commitment to fighting inflation. Now, the third question that was posed by RBI, should RBI change the band of 4% plus or minus 2%, that is 2 to 6%. Here there was disagreement. 20% of those polled said the range should be narrowed to 3 to 6%. One of the dissenters even said that a target of 4.5% plus or minus 1.5 would be ideal, but it would confuse so many people with all this 0.5. So maybe the range should just change to 3 to 6%. Finally, the question, should Reserve Bank abandon the point target of 4% and only keep the range? All respondents said no way. There should be a point and a range around it. Well, those were the Reserve Bank's questions. CNBC-TV18 additionally asked economists if the inflation targeting system has worked. All of them said a resounding yes. Going by this poll, looks like the current inflation targeting framework will continue as is even after March 2026.
All right. Thank you, Lata, for that comprehensive update. Shifting focus now, Apple's new iPhone 17 series is now on sale. Thousands crowded in long queues outside Apple stores across the world. The iPhone frenzy gripped India as well, with buyers queuing overnight in New Delhi, Mumbai, Bengaluru and Pune. A scuffle broke out at the Mumbai Apple store as thousands waited to enter. Security personnel were seen trying to handle the crowd. All 4 variants of the iPhone are available in India. Prices in India start at 83,000 rupees.
The models that they were most interested in and are going out to purchase today are the Pro variant and the Pro Max. So that's good news for Apple. That's the top tier. And they were very interested in this cosmic orange color.
Well, I was at the launch event in Cupertino and there was huge excitement. And I think overall, in the era of sameness that we have seen with the iPhone, it's great that we've seen a completely redesigned lineup.
I just love having that experience with Apple every year.
I'm a bit of a content creator, so I'm needing that camera and also the battery. I thought about going for the Air, but I don't know whether or not the battery is going to be able to hold up.
I'm at the Apple store at the BKC, and you can see since yesterday evening the people are standing in the queue and massive crowd gather here, and almost more than 3,000 people has gathered here on weekend. So how many hours you are standing in the queue?
22 hours.
22 hours?
Yes.
And you are impressed with the new iPhone 17?
Yeah, Pro Max.
You are waiting for this iPhone since how long?
3:30 in the morning.
आपने तो एक नहीं 5 आईफोन खरीदे।
पूरी फैमिली चेंज करेगी अभी 16 Pro Max है 17 Pro।
And with that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18. Thank you for watching.
Hello and welcome to On the Record with me, Shireen Bhan. Every year, my guest joins me to talk about the road ahead as far as the diversified conglomerate is concerned. Joining me once again on the program today is Sanjiv Goenka to lay out the roadmap for what he has in store for a whole host of his companies. Mr. Goenka, it's always a pleasure. Many thanks for joining us here on CNBC-TV18. It's great to have you back. It was last July when we spoke where you laid out a very clear roadmap for each of your businesses on CNBC-TV18. Before I get to the individual businesses, I want to understand from you the sense of confidence and optimism that you have with respect to the larger economy and each of your businesses today. We had the finance minister yesterday speak about the fact that the government has done all it can to try and get industry to do more, to invest more. Has the government been able to unleash the animal spirit, so to speak?
Well, thank you, Shirin, for having me once again. It's always a pleasure. Since we met last time, I think the confidence has grown a few notches in both our ability to implement what we had laid out, and that is largely because of what the government has done in terms of policy, in terms of environment, in terms of approach. I think this whole Modi vision of build for the world in India, and believe in yourself, believe in India, as an Indian, believe in what you're capable of. That confidence, that self-assurance, that backing that the government gives has been great. Not only for us at RPSG, but I think for the entire corporate India. And that's why you will see lots of corporates committing to large-scale capital expenditure, and of a kind that has never been committed. So since we met, last year I remember telling you that our target is a 2 lakh crore market cap. That we are now fairly confident of doing. Our internal targets have actually been scaled up since then, despite the stock markets not being at their best. And we had talked about investments. That number has gone up considerably. And as we move forward, the implementation part of each company, each project, each improvement is actually a lot more secure because A, we've made a very good start, and B, now we are that much more confident. So from a plan, it is now in action.
Well, let's put some numbers down then. As you pointed out, that internally you have decided to revise upwards a lot of the targets that you had spoken of. So from an investment point of view, from a capex point of view, what should we now expect given the sense of confidence that you just shared with us?
So over the next 5 years, what we are committing to is a total capex of about 1 lakh crores, largely in the energy area. It'll go also in chemicals, but chemicals is not that capex intensive, as you know. So renewables is going to be a large part of our investment. When we met last year, we talked of 3 gigawatts. Now 3.2 gigawatts is under implementation, advanced stages of implementation. Another 4 gigawatts is getting close to closure. And our target is to get to about 10 gigawatts over the next 6 years.
10 gigawatts by 6 years. So would it be fair to say that at this point in time, the renewable push is what is most exciting for you within the group? Of course, not to say that you're ignoring the rest of your businesses, but both in terms of investments as well as in terms of the kinds of bets that you intend to make, it's the renewable side of the business that will get the lion's share of the attention and resources.
Well, renewables is certainly something that's very attractive for us. And let me make an announcement today on CNBC-TV18. It's not only solar and wind hybrid projects that we are implementing. We propose to get into module and cell manufacturing. Our first gigawatt of module capacity goes on stream in the next 45 days. So that's something we've been quietly implementing. And in the next 3 years, there'll be 3 gigawatts of cell and 3 gigawatts of module capacity that will go on stream.
Well, thank you, A, for breaking the news here on CNBC-TV18. So you heard it first right from Sanjiv Goenka on CNBC-TV18. But, what will the benefits be on account of these bets that you're making? You just gave us an outline of what you expect over the next few years, both in terms of cell as well as the module. How do you see this benefiting your business and also the numbers for you going forward?
Well, one is that given the thrust we're doing on renewables, a large part of it will come into our own facilities. Mm-hmm. But the market for these products is growing. I mean, the more companies invest and the more self-reliant India becomes, the more cells and modules manufactured in India will get sold. So therefore, we do believe that there's a very good business model for that.
So from an export point of view, is that going to be something that you're looking at as well?
Yes, absolutely. Absolutely.
I want to come back to the push on renewables and understand what it could potentially mean as far as your own bottom line is concerned in terms of cost savings, because you do intend to disproportionately move towards being able to use your own renewable energy.
So our target is to get about 45 to 50% of our total sold power sourced from renewables. And we will try and see that it largely comes from our own capacities. It's always not possible because sometimes, you have, not sometimes, you have to have tenders. And so it really depends upon how competitive we are. We're confident of being competitive, but at the end of the day, we have to be competitive. But the very fact that you can get from generating sources which are under your control gives you that much more security of supply. So I think there is a delta in the pricing between thermal and renewable. And regulatory commissions don't always give you your entitled fair return. And to that extent, this mitigates the need for tariff increases or the extent of tariff increases.
You still haven't left me with a number, the ballpark. What could it potentially mean in terms of savings as well as addition to the bottom line?
I think what it will do is huge cash flows which will be additional. So in terms of the regulatory assets that the companies have accumulated, I think that could get liquidated very fast.
Well, speaking about the energy business, since we are talking about that, more states looking at privatizing. UP, of course, is the big one. The expectation is perhaps by the end of October, we should get done as far as the RFP is concerned. How aggressive do you intend to go after that market?
We are keen to get a share of that pie. We already operate in UP, in Greater Noida, and that's one of the most successful privatization cases of power in the private sector. And it is UP's most successful utility. So we have now begun to understand how to operate in UP. And Yogi Ji's government provides a very secure law and order, and so helps a utility for sure. Mm-hmm. We're keen, and we are going to bid.
You're keen, you're going to bid, but is there a preference on where you would find yourself best placed strategically? Because, of the 5 zones that the government is looking to bid out?
Yes, there is, but I'm not about to spell it out here. Okay. Not yet.
Not yet. Hopefully the next time
yes.
we meet. and there should be a decision. But that's as far as UP is concerned. What's the indication that you get from other states at this point in time in terms of their own privatization efforts?
I do get the impression that if the UP one happens fast, which it is likely to, there will be a couple of other states which will move in. In Maharashtra, you're already seeing applications for parallel licenses by Torrent, Tata, Adani. So I think this whole thing is moving, and it's moving reasonably fast. So you could see a couple of other states jumping into the fray before the end of the year, before the end of next year.
So let me, before I move to the next business, get the big picture headline for the energy generation as well as distribution business for you in the near term as well as the medium to long term.
Well, over 3 to 4 years, profitability to, I wouldn't like to specifically say, but I think our internal targets are at least a 2.5 times growth in profits. At least.
I like the fact that you stressed at least.
So I think there is a reasonable level of confidence on that, barring anything unforeseen, because utilities are never completely within your own control. But yes, there's sufficient action that has been taken to give us confidence that we will get there.
Well, yes, the stroke of the pen risk exists as far as all regulated businesses are concerned, but that's a different story. Let's now move to the engine of growth that you were most excited about when we spoke in last July, and that was PCBL. You know, the outlook for that business, you continue to be as confident as you were when we last spoke?
Yes, absolutely. The chemicals business and the carbon black business indeed has gone through a little bit of a low for the last 2 quarters. It'll take 1 more quarter for it to completely bounce back. But yes, over a 3-year horizon, 4-year horizon, we're exactly where we had planned to be. So we've signed up for a new plant in Andhra. Our first phase of expansion in Tamil Nadu. The Tamil Nadu plant has since got operational, fully utilized. And now we are doubling capacity there. We've got land for a new facility in Andhra. We're setting up yet another one in Mundra. We're looking at a plant in Russell Khaimah. We're looking at value additions. A nanosilicon plant, which is like a pilot commercial, gets on stream in the next 2 months. So yes, significant action has happened there. And that gives us confidence that we are well on track to our targets.
The proportion of the specialty chemicals business, you know, from where it is currently today and where you believe it could be on the back of the steps and the measures that you are taking?
Our target is to increase our specialty business by about 2.7 times from where we are.
By when?
By 28-29.
28-29. You know, not just PCBL, but across the group, you've been fairly acquisitive across each of your businesses. At least as far as PCBL is concerned, do you believe that for now it is going to be much more focused on consolidation, or do you believe that you will potentially look at more acquisitions?
We are always open to acquisitions, and we always look at opportunities that come our way. They should fit in from either a market perspective or a domain perspective or a cash flow perspective. So if one of these 3 criteria, or all of them are met, then we are certainly very interested.
But as of now, you believe you have enough to digest?
That's right.
On the back of the acquisition already done?
Absolutely.
Let's talk about First Source, because that was another engine of growth that you were excited about. Double-digit growth is what you have been able to deliver. But how do you un-BPO First Source?
Well, un-BPO is something that we are very keen about. We were a BPO company. We are not a BPO company, and therefore our slogan is un-BPO. We are looking at AI, agentic AI, and we are looking at being solutions providers rather than call centers. And that's beginning to work. We used to get 3 big wins in a year. Last year, we got 3 big wins every quarter. This year, we hope to get 4 big wins every quarter. And we are now at a steady run rate of about 100 million wins every quarter. So let me just put it in perspective. When you talk of, say, since the time we last met and now, we've got about $540 million of additional business at 18% margins. That roughly translates into close to about $100 million of additional contributions. You're already expensed out because you've invested in the people and the SG&A and that whole thing. So now the entire contribution will come to the bottom line. So that in itself is one chunk. Then right shoring is the second one. Attrition is the third. Getting greater wallet share from our existing customers is the fourth. And then this whole AI and agentic AI piece, which we are working very actively on. Our AI labs in London and Melbourne have been great successes, and that's just the beginning.
You know, this transition in the quest to un-BPO yourself and move into an AI era, is this largely going to have to be driven by inorganic opportunities and inorganic growth? Is that going to be something that you actively pursue?
We are looking at, we've always looked at opportunities, and we have acquired over the last 18 months 4 companies.
Yes.
And we will continue to look for opportunities that excite us. But now it's going to be either led by a domain that we need, a geography that helps us. For example, we're looking to grow in South Africa, or it gives us access to a larger number of customers.
The headwind potentially for this sector, and this is not just for FirstSource specifically, but for the industry, what's happening in the US, you know, with regards to the kind of restrictions that President Trump is looking at imposing and so on and so forth. How vulnerable do you believe you find yourself to those potential changes, and how do you fortify yourself from those proposed changes?
You know, honestly, a large part of our workforce was in the US, and we were in the process of moving part of that workforce from the US elsewhere. But now, with this, we won't do that as much as we had planned for the immediate future. So it doesn't impact us from our past. But yes, we are looking at some stage, at some time, we will have to right shore because costs are a factor.
Well, costs are a factor, and that would have an impact as far as your margins are concerned. So if you push back your plans to, in your words, right shore, what could the implications be on margins in the near term?
We are right now shifting some of our people to Mexico and some of our back-end work to Mexico, which is proving to be a very good opportunity. And it's working well. We just started that a couple of quarters ago, and that's paying us good dividends. Overall, I think we are on track to get to about 2.5 to 2.6 times growth in profitability over the next 2 to 3 years. I think we are very, very sort of, with the orders we have, we are almost there. I think we have to do a little more on the cost side, which we are doing. And I think it's sort of beginning to fall into place.
You know, what we're seeing, though, in that space is deals like Capgemini WNS, and WNS saying that, look, it's hard in this market, in this environment, to keep at it solo. You don't believe that to be the case?
You know, for us, I think at one stage we were not exactly up there. So it's easier for us to move down. It's easier for us to move up. And for somebody who's right up there to move down. And if you see the last 3 or 4 quarters, we've been pretty much number 1 or number 2 in terms of growth rate. And that's a trend that we expect will continue, at least for the next couple of years.
You know, the global aspiration of the group as a conglomerate, as a diversified conglomerate, would it be fair to say that the aggression on increasing your global footprint across each of your businesses is now picking up pace, picking up momentum?
Yes. Today we have a presence in 35 countries. And the way I look at it, whether we have our facilities in India or elsewhere, I mean, as an Indian, I would like to have as many facilities in India as we can. But we are serving the global market. And that is something that we will continue to do with greater aggression, with greater efficiency, and hopefully greater margins.
And hopefully greater margins. But on the renewable side of the business, to come back to where we started, eventually, would you look at a listing? Because, the growth aspiration there is significant. And what could the potential timeline be?
Well, as of now, we are not listing it for the next 12 months. But thereafter, yes, it depends upon
how... So that's not a very long window. So you're saying that potentially after in a year's time, you could look at it?
In a year's time, we could start looking at it.
And outside of course, tapping the markets for the renewable side of the business, the capex plans that you outlined, the funding for that, what's the plan?
The cash flows over the next 4 years are reasonably strong and robust. And we believe in a debt-equity ratio of 1:1. The worst at any point in time should go as 1:1.5 and not beyond that. So I think we will be very much within that parameter. We'll be very conscious of that. So there are no immediate no immediate capital raising plans. But frankly, if you don't raise capital, your growth gets limited. So over a period of time, over the next 12, 18 months, there would be capital raising.
There will be capital raising.
There will be capital raising.
And outside of the IPO, what are the other means that you're considering in terms of capital raising?
It's a little early to specifically spell out, but there will be capital raising as we go forward, but not immediately.
And what would you be looking at in terms of fundraising to fuel the kind of growth aspirations you have?
I think these aspirations are well served by the internal accruals that we will have. But I think our ambitions are defined for what I just outlined to you, but they're not limited to just that. So I think, hopefully, by the time we meet next, there will be some more growth in terms of thoughts and plans and action, which will need more capital. So right now, it's not specific. It's more at an ideating stage. But yes, 12 months from now, we should be looking at raising capital.
Okay, let's talk about the unlisted part of the business, or may I call it the passion part of the business. On the sports side, I mean, are you looking at any further opportunities that you're getting into?
Well, we're very happy with our expansion into South Africa and England. And I don't know whether any other leagues will look at privatizing. There is some talks.
Were they to come up for privatization, any other leagues in any other parts of the world, would you be interested?
The Caribbean, we are not. We examined and we didn't take that opportunity. The American League also, we didn't take that opportunity. We thought that the terms were a bit one-sided in favor of the American owners. But if the Big Bash were to come up, yes.
So the Big Bash would certainly get a serious look.
For sure.
Okay. The GST cuts come into effect on the 22nd of September, which is Monday. The expectation is that this is going to provide a boost to consumption. From your vantage point, what do you think it could potentially mean?
It should spur consumption significantly. And I think this is very bold. What the finance minister has done is incredible. It's beyond what we expected, for sure. And therefore, corporate India can go and ask for more. But frankly, there is nothing more that you can ask for. It's now for us to go and perform.
Up to you to perform. Saregama, let's talk about that, because that kind of quietly moves along and is a significant revenue kicker for you.
It's a revenue kicker. It's given us about 23% annual CAGR in terms of profits, and that will continue. But I think there are two things that excite me a lot there. So one is this whole AI piece, and you know what we're doing is we are. Okay, we haven't spoken about it so far.
So it's another news break here on CNBC-TV18.
So most of our catalog, we are using AI to do fresh videos.
Okay.
So you have
all the classics.
All the classics.
Yeah.
So you will have now AI-generated videos which are completely modern. And so that is something that we're very excited about. And that you can produce at a cost of less than $1 lakh. So if you were to take your 20,000 biggest songs, say, and did all of them in terms of videos, it's 200 crores in terms of total investment. At the outside, it could be less. And put them on YouTube. And that could be a huge revenue generator. That's one. Two is we are looking at getting into AI-generated films.
Okay.
So the whole film
will be AI.
It will be AI.
Okay.
And so you produce it at a fraction of the cost. So the whole entire film, so the scripting is normal. Everything is normal.
That's still people.
That's still people, but the whole production and the whole casting is AI.
So there won't be any actual actors?
No.
Okay.
And we are actually looking at creating our own version of
AI heroes and heroines.
And heroines, absolutely.
And when does this get off the block?
So it's now all under production.
When will we see the first AI film
hopefully
being
in
released?
12 months.
In 12 months?
Hopefully.
And are you looking at a theatrical release? Are you looking at OTT?
We're still working that out. It could be theatrical, it could be OTT, it would be a mix. But Narasimha has done very well. That's animated, that's not AI, but that's animation. That's done extremely well. So you will see us doing a lot of that. And so that's very exciting. This whole concept of re-energizing your repertoire and producing new content, new films, which are scripted by the best. But you're not dependent on dates from the best in the class.
Or having to sign big paychecks, which is the majority of the cost of a film.
Exactly. So you can produce the entire film at a cost of less than 5 crores. And if you can get 10 crores revenue out of it, it's 100% return on investment. You know, and this is a model that we are so excited about.
Well, I don't know how much of Bollywood is going to be excited about this idea of yours, Mr. Goenka, and how it plays itself out. But what is the library that we're talking about that Saregama has the potential to monetize in this AI fashion?
1,87,000 songs.
1,87,000 songs. Do you have a preference as far as your own playlist is concerned?
I have a playlist, but that doesn't govern which is the how we are going to prioritize
What's the
this.
top song on your playlist?
Kora Kaagaz Tha Ye Man Mera.
So it kind of is almost symbolic of the way that you're planning this business. It's like a canvas that you're painting over, right?
Completely. It's actually this is headed by my daughter.
Yes.
And she's the one who's doing this, and as much as the renewables is by Shashwat. So I only come here to make
projections.
The projections, but
They're doing the work.
Yeah, they're doing the work.
But speaking of Shashwat, it's interesting. I was talking to you about the comment that Pat Jindal made, where he said that he's much more calibrated in comparison to his father. Would you say that's the same as far as you and Shashwat are concerned?
You know, Shashwat's my voice of sanity. So he'll very gingerly caution me that maybe you should look at this and maybe you should look at this.
It's interesting that the next gen is far more calibrated than the previous.
And he's far more researched. And he's far better read than I am. So I think he's been a huge asset as far as RPSG is concerned. And one of the reasons that we can think like this is because we have talent like Shashwat's.
So finally, let me end by asking you, you've talked about all the headroom for growth and the tailwinds that you want to leverage. But what could be the potential headwinds that you will need to brace yourself for?
You know, we don't know how AI is going to impact us. So far, we are seeing the positive impacts on our business. In FirstSource, in Saregama, in our existing businesses where routine activities are being outsourced to AI. But we don't know how AI is going to really impact us going forward or what shape and form AI will take. So that is something that's frankly unknown. And that could play out in different ways. How do we keep abreast of newer technologies and newer molecules in the chemical space? So whereas we have invested in an R&D center in Palage, in one in Belgium, but I think we need to do a lot more and quicker and get in better resources in terms of scientists. And yes, nanosilicon is one, but we can't be satisfied with one. And so that's how fast we can stay abreast or ahead of technology, and that's going to be the biggest challenge.
I'll end by asking you, while you talk to us about a whole host of your businesses which continue to drive growth for you, what about retail and FMCG, two yums, as well as wellness? Is that kind of pushed out,
No.
pushed back on the list of priorities?
Well, retail is managed for value. So retail is not something that we are looking at big ticket growth. FMCG is something that we are growing very well in. And in the next 3 years, we expect to get to a break even. At 1,800 crores revenue, we break even. And we expect to get there in the next 3 years. Tuyam is doing well. The snacking space is going very well. Our booth category has done exceedingly well. It was one of the things that we launched. It started with booth chips. Now all our products are available in the booth category, and we can see other FMCG snacking majors coming out with booth equivalents, and that is the surest way to say that this product is succeeding. Our wellness is going well. Our Ayurveda-inspired medicines, it's fledgling yet, but very exciting products, very, very exciting products. It is available online, but we haven't really given a marketing push yet. But we are very excited about those products. The products are brilliant. And several people, like several thousand people, have been using it over a few years, and with great results. And now we are ready for a very big launch. Shashwat drives that business. I'm not exactly up to speed as to exactly when he is going to go full hog with the marketing, but I'd reckon sometime in the next 6 months. But the products are brilliant. The sleep drops, for example, they're flour-based, and they're very effective. There is Chyawanprash in a toffee form. There's Shitopaladi in a capsule form. The conventional kadhas that we've all grown up having are now in the form of infusions.
Right.
So there's a lot of innovation with tradition that's gone into the development of these products. We have to now market it.
Do you need the sleep supplement, or are you being able to sleep absolutely fine given the fact that things seem to be in place at this point in time?
You know, my wife complains that I go off to sleep the moment I hit the bed.
Which is not a bad thing at all.
Yeah. Well, for me it's great, but she somehow seems unhappy.
Mr. Goenka, always a pleasure. We look forward to hearing more from you as you roll out the plans that you've laid out for us here on CNBC-TV18. We look forward to our next interview together as well.
Such
always
a privilege.
pleasure. Thank you so much
Thank
for joining
you.
us. Well, that is it on this edition of On the Record with Sanjiv Goenka. From all of us here on the team for now, many thanks for watching. Do stay tuned to CNBC-TV18. We're back in a moment with the news.
Hello and welcome to Global Eye. I'm Parikshit Luthra. India's strategic trade gateway to Afghanistan and Central Asia, the Chabahar Port in Iran, is now being targeted by the United States. The Trump administration has removed the waiver on sanctions that it granted in 2018 to ramp up pressure on Iran. So why is the Chabahar Port so crucial and important for India? And why did New Delhi sign a long-term contract with Iran to develop it? The simple answer is China. That's because the Beijing-operated Gwadar port in Pakistan is just 140 kilometers away from the Chabahar port and is only about 550 nautical miles from the Kandla port in Gujarat. These two factors make the port India's best bet, both strategically and geopolitically, as it is crucial for India-Iran connectivity. Now, it is important for countering China's presence in the Arabian Sea as well. India's proposed plan to develop the Chabahar port came up for the first time in 2003. New Delhi's vision was to build Chabahar as a major regional and international hub for humanitarian purposes and movement of goods. This strategic port has all the plus points of a major cargo hub. This is a deep water port providing easy access for large cargo ships. It is also connected by road with Afghanistan. India has used this port for sending wheat, medicines to Afghanistan. Chabahar also serves as a key hub in the international North-South transport corridor linking India with Russia and Europe. India had pledged investments of $500 million in Chabahar in 2020 2016. In 2024, India said it will invest around $120 million in the Shahid Beshti port in Chabahar. A credit window of $250 million has been provided for infrastructure upgrades, and India has supplied port equipment worth about $24 million to develop the Chabahar port. Reacting to the US's move, Ranveer Jaiswal, spokesperson of the Ministry of External Affairs, said that India is examining how the possible impact of Washington's move, which will now kick in 10 days from now.
See, you would have seen the press statement which was issued by the US side yesterday on revocation of sanctions waiver that applies to Chabahar Port. We are presently examining the implications that this revocation has for India.
To take this discussion forward, I'm now joined by former Foreign Secretary Kanwal Sibal and former Indian Ambassador to the United States, Meera Shankar. Thank you for joining us on the show today. Ambassador Sibal, if I can ask you first, why do you think the US has acted in this manner? In 2018, it was this very administration which had given that sanctions waiver for the Chabahar port because they felt this was important for regional connectivity. It was important for India.
Well, as you know, the genesis of the project in 2003, which you mentioned, occurred at a time when I was Foreign Secretary and I was involved in it. The idea was to develop an alternative route for us to Afghanistan, because Pakistan was the only access that Afghanistan had to the sea. And given the fact that Pakistan was not allowing us overland transit to Afghanistan, the intention was then, as I said, to give an alternative route to Afghanistan to access the sea and for ourselves to be able to connect ourselves to Afghanistan. At that time, it was not the Taliban that was in power. The progress on this has been slow and fitful, and then to come to what has happened now. I think this is one more strategic blow that the United States has chosen to inflict on India, apart from some other steps that they have taken. And it seems quite unnecessary because it's not only that it gives Afghanistan an alternative to the sea and gives us access to Afghanistan. Beyond that, also it connects us to Central Asia. As you know, very recently, a trilateral meeting between India, Iran, and Uzbekistan took place just a few days ago, because Uzbekistan is very keen on developing this project. China is also involved in this area, not directly in the port, but building refinery, railway lines, and this and that. They have shown interest in that, and probably they are involved on the ground. I have not followed it that closely, but I know that they are on the ground. Now, the International North-South Corridor is a different project, but the intention is at some stage to link the two through a railway line across Iran. But that will happen in due course. We'll see.
Right.
Now, there's no need for the United States to punish us this way. I think it is partly also as a result of the irritation that Trump himself felt, because at the SCO meeting, Putin, Modi, and Xi were together, and Iran is a member of the SCO. So it's part of that kind of syndrome that Trump and the Trump administration is suffering from when it comes to India's show of strategic autonomy. It's an unfortunate step.
All right.
And
Master Sibal,
it will not help.
I want to come back to you.
Our relations, yes.
It's not going to help. But let me get in Ambassador Meera Shankar as well. Ambassador Meera Shankar, what does this waiver exemption, now that it has been taken away and revoked, what does this imply? The document from the State Department, the press statement says that those involved, government entities, individuals involved with the Chabahar project may get sanctioned if they are so involved. Could bodies, could companies, individuals already associated also be sanctioned, or anyone who now tries to get involved with it or make any investments will be impacted?
My sense would be it would be prospective. It won't be retroactive because the waiver was in force at that time. But unlike the very harsh tariffs which the US has put across the board on Indian exports to the United States for import of Russian oil, these will be more targeted sanctions at companies and individuals involved in the project. But given the fact that, this was a conscious decision of the US in 2018, and it was not just, India, which had interests in the project because it gave us connectivity to Afghanistan and it connected us to Central Asia by land, which we didn't have. That connectivity we didn't have because Pakistan continued to deny us transit across their territory to Central Asia. So it wasn't so much, China focused, but it was more focused in terms of India's connectivity with Central Asia. And of course, the North-South corridor would enable India to access Russian oil in a more direct way and bring it out through Iran. So you can see at some level that this is part of the US's strategy and policy to exert maximum pressure on Iran, because the Trump administration has completely aligned their policy in this region with that of Israel. They have, apart from encouraging Israel to bomb Iran's nuclear facilities, they themselves have launched attacks on some of the deep facilities. And now they have tightened the sanctions regime to actually, do away with the waivers which were given in 2018. But in this case, as I said, the sanctions will be more targeted at those companies and individuals or government entities actually involved with the port project. And the sanctions involve freezing of assets in the US. It involves, no dealings that the US will have with them, and also blocks visas and travel for individuals who may be engaged in the project. So the sanctions are more targeted. They are not wide-ranging.
Very far-reaching as well.
Yes.
Right.
So
you're right. You're right, Ambassador. Let me get in Ambassador Sibal also once again. Ambassador Sibal, does this now mean that India-Iran cooperation on the Chabahar project will now come to a halt, or can we continue if we do it via a local currency arrangement, sidestepping the dollar?
I think it's not as simple as that, because this project has been signed at the government level, government-to-government level. And a lot of entities on the Indian side have been involved in the past when we've had problems before we got this waiver. In the orders that we were placing on various international companies for cranes and other port facility arrangements were not being fulfilled because those entities, companies were very hesitant to get involved because of the fear of sanctions. Now we'll have the same situation where, in terms of expansion of capacity of the port, any additional facilities we want to build to make the berth that we have more efficient will all be subject to prospective sanctions by the United States. I think Meera may be right in her interpretation that this may not apply retrospectively, but only prospectively. But I'm not sure of this because once the waiver is revoked, then it's revoked for anybody who's involved in this project, past or present or future. So it'll place the government of India in a very difficult position because it will have then to decide whether it wants to defy these sanctions and continue developing this project or bend to U.S. will. It'll be a test of our willpower and our strategic autonomy.
Ambassador Meera Shankar also, sir. That's an important point. Ambassador Meera Shankar, Chabahar Port was an important counterweight in the Arabian Sea to the Gwadar Port, which is controlled by China, the China Belt and Road Initiative. We had already broken off energy ties with Iran because of US sanctions over the years. Will this now be a body blow to India-Iran relations?
Well, it depends on how India chooses to react, in the sense that is it going to try to find ways to continue the project? Is it going to try to find a way forward on the project during negotiations with the US? Will it be on the table? So it depends. There are many imponderables. But clearly the US has signaled that it doesn't take India's interests into account as regards Iran, as they were willing to do in the past.
Right. That's an important point. Ambassador Sibal, to get you in at this point, what do you think India should do? Is the only way out diplomacy, back-channel diplomacy? Can we somehow link it to the trade negotiations, or will this have to be completely outside that?
Let me make an additional point before I answer your question, which is that we are financing this project, which means the Ministry of Finance, Government of India is involved. So if at the government level we continue to finance this project, then we are attracting sanctions. And I don't know, will the Americans apply sanctions on the Ministry of Finance or individual officers there, or what have you? It's a very, how should I say, it's a typical bullying by the United States of America. They didn't have to do this at all, but this is part of the other decisions they are taking to put pressure on us. Now, the other aspect of this which is interesting, which is that in a sense, what you said earlier on about Gwadar and everything else, this by sanctioning Chabahar and not doing anything about Gwadar, despite all US concerns about China, in fact, they are making life easier for the development of the Gwadar port and preventing a port which could actually also take business away from Gwadar, making that more difficult to operate. So indirectly, they're helping Pakistan as well as China, and this is the absurdity of it. Now, whether we stand up to them or we don't stand up to them, I see, but I think we'll have to. We'll have to, and we'll have to take the risk of sanctions. I don't think backroom diplomacy will work because they'll attach easily, because they'll attach a lot of conditions. And this will be one more point of pressure on us, on our relations with Russia, because at the end of the day, this also connects us to Russia. So I think
Central Asia and Russia, and that was the plan to increase trade through this region.
It's testing time.
Again, Ambassador Meera Shankar quickly, sir, for the last comment. Ambassador Meera Shankar, we had seen very positive statements between India and the United States as early as last night. In the presence of Prime Minister Starmer, Donald Trump said that I have a very good relationship with India. I like Prime Minister Modi. I have a very good relationship with him. So how do you see this? Are they putting pressure on us to cut off oil purchases from Russia? Why go after this project, which is very important for India's connectivity, also helps the United States to balance China in the region?
Well, I think balancing China doesn't seem to now be a priority for the United States. The draft defense policy, it hasn't been finalized, which is on Pete Hegseth's table as defense secretary, apparently prioritizes defense and security of the homeland and the Western Hemisphere, leaving Asia out altogether. Now, we don't know if that will be the final shape of the defense policy, but if that is the case, then the US is clearly deprioritizing balancing China in Asia. So it won't look at India through the strategic prism of being a balancer to China and Asia, but will look at it transactionally and from the point of view of asserting its power and getting a market. You know, a lot of the pressure on the energy sector is the greed by US companies to corner the Indian market. And, you know, that is something we should do if it is economical for us. If it is not economical to purchase US oil, then we have to look at other sources. But the US policy has been to use its geopolitical clout to force political decisions where actually economic rationale should prevail.
All right. Ambassador Meera Shankar, Ambassador Sybil, thank you very much for joining us on a very important topic. India will have to watch our developments there very closely. With that, it's a wrap on Global Eye. Stay tuned to CNBC-TV18 for more updates.
India's gig economy is booming. After Zomato and Swiggy, Urban Company hit Dalal Street this week, making a stellar debut. There are currently more than 1 crore gig workers in India, and this is expected to more than double in the next 5 years. Now, a lion's share of gig workers are in the delivery sector as well as ride-hailing. Other areas include services like logistics. They are also seeing steady growth. Now, gig work offers several benefits like job creation, autonomy, flexibility, entrepreneurship, among others. Urban unemployment in India is close to 20% according to the government's data, underlining the need for more job creation. While gig work does fill a gap, there are disadvantages as well, including the lack of social security, income stability, poor working conditions and limited growth opportunity. The question is, how can we strike a balance and ensure that gig work is at least a part fix to India's jobs problem? We have a full house here to discuss the gig economy. With me, Prashant, Surbhi, Nigel, Nimesh and Sriram. Guys, thanks very much for joining us. Nimesh, let's get straight to you. You know, what we saw yesterday with the Urban Company listing, it's the new kid on the block, 53% premium to the issue price. I want to understand from you, what does the market make of these stories? We've seen Eternal, we've seen Swiggy, we've now got Urban Company in the listed space, Zepto, possibly another contender that could be making its debut on Dalal Street at some point. But what does the market make of these stories? How are they valuing these companies?
Well, you know, Shirin, first on the Urban Company which got listed this week, 100 times on earnings, right? So that's the kind of P multiple market is willing to give. So again, from a market perspective, Shirin, I talked to so many fund managers. There are in fact now some tech funds as well who are only focusing on this kind of platform to buy these platform businesses. The street is very divided because not many understand this business very well, how to value them, what's the kind of potential which is there. So the street will always be divided. But I just want to give a both side view, right? A tailwind for the sector as well as the headwind for the sector. First, from some of the big tailwinds point of view, India is a large consumer market, right? So that's the biggest mode or the biggest tailwind for these kind of businesses. So that's one. The other big thing is from an India perspective, the density. If you look at US versus India, India's density is almost 16 to 18 times bigger than what the US density is. So that plays on the scale of economy. So that works in India's favor. So that's one big tailwind. From a headwind point of view, increasing competition, no entry barrier. Some of the biggest guys have not yet got into this business. So as and when others see that some of the listed companies are making money and they're turning profitable, I'm sure there will be more competition coming in. And also there is always going to be a risk of what the government does with this gig workers. If they put some cap, or if there is some levy on X amount of money you have to pay, some benefits you have to pay, then the cost will go up for all these guys. So that's a kind of a tailwind, a headwind as well for these companies. So that's the sector perspective. Now, about the valuation, right? We spoke about what kind of valuation this guy listed at, Urban Company. Look at Zomato. It had a very volatile history in the last few years. Actually, it hit a low of almost 40 rupees in 2022, and from there the stock is up 8 times, and now commanding a market cap of 3 lakh crore and having a valuation of more than 120 times on 1 year forward. So nothing is less than 100 times is what I believe in this space. Even for that matter, Swiggy has actually recovered from the recent lows of almost 297, now back to 450 odd levels, 1 lakh crore of market cap, and almost 4 times price to book. So not very cheap on any metrics. As we spoke about Urban Company as well, and Zepto as well, right? Zepto did a fund round recently, some fundraising, and even that's valued at close to $7 billion or $8 billion. So clearly this space is something which a lot of people are excited, but from a market perspective, there is a bit of divergent view on how to value these companies, and should one look to buy even at this level.
Once you burnt your fingers, you're shy. But I have a question on this. So is it, in your conversations, should they value these platforms as FMCG, as restaurants, as QSR, or as logistics?
It's an entirely new class. I think that's what it's an entirely new class.
Exactly, new class of, and which is why a lot of the traditional investors are not willing to get into this.
So that's the way.
Platforms
That's a cop-out.
why are you boxing them into FMCG,
exactly.
or logistics? As Nimesh pointed out, Ramdev Agarwal believes that Eternal could be India's answer to NVIDIA. So we're talking about human, low-cost human capital being the big AI lever, perhaps, you know, in the Indian context, and that comparison, though it seems very, very surprising, is a comparison that Ramdev Agarwal is making, that Eternal could be India's answer to NVIDIA. But Nigel, I want you to come in on this, because you, you know, did a conversation on exactly how these platform companies have fared, and you know, what is the kind of headroom for growth from here, and what's the market's perspective, to just pick up from where Nimesh left off.
Well, just 2 points I want to make. One is on the IPO phenomena. You know, as Nimesh said, that the company is listed, is trading at around 100 times odd. Just want to jog your memory back, because exactly 1 year ago, we had two big listings. One is Bajaj Housing and the other one is Hyundai. Just to give you a quick data point, you know, 3 days from listing, Bajaj Housing went to around 190 rupees, 188 rupees on 18th of September. Today, the stock price is 115 rupees. At that point of time, the stock on a price to book metric went to around 7 to around 8 times price to book. And everyone was gung-ho, promoter pedigree, you know, Finance, massive penetration, everything looking good. You rather buy Bajaj Housing than Bajaj Finance as well. I remember these arguments. The stock price is down 40% from that peak. Point number one. The other one is Hyundai. Hyundai listed, I think, in October 2024 till April 2025, the stock went down to 1,550 rupees.
Below the IPO price.
And today, the stock is at a 52-week high.
Yeah.
You know, just take a look at the sea change. You know, I wouldn't want to compare it, the hare and the tortoise, but that's the way it's played out, right? The one that got off the, you know, out of the blocks in style post its listing was Bajaj Housing, which corrected big time. And the other one is Hyundai, which was, no one was interested. Everyone spoke about the dividend they took back, the royalty was higher, the valuations are very, very expensive. And the thing, you know, things have totally changed. So that's just the listing phenomena, so to call it. You know, sometimes when these companies list, there's a lot of excitement. Moving to, you know, the chat that I had with Sandeep Agarwal, he made a few points with regard to these companies, the platform-based companies, and, you know, that argument as well that we don't have companies, you know, in the league of Microsoft, Alphabet, NVIDIA. He said that today, if you look at TCS, Infosys, as well as Reliance, as a percentage of India's GDP, these companies are either 1, 2, and 5% of India's GDP. Whereas all these large companies in the United States, they are at around 10 to around 14% of the GDP, of United States GDP. But when they listed, they were less than 1% of the GDP or 0.5% of GDP. So as the economy moves up itself, India's GDP moves up, he's expecting Reliance Industries, and he's very, very bullish on Reliance Intelligence in particular, and the other couple of big tech names as well could be double-digit as a percentage of India's GDP as well. So, you know, we'll have to keep an eye on that.
But there is a difference. So we can't speak about Reliance and an urban company in the same breath.
Yes, absolutely.
Not just about the scale. I'm saying even in the quality of the business, in what the business does. One is a pure play tech. The other is a lot of people. A tech putting together. It's a social media of,
Sriram,
you know.
Sriram, I mean, among one of the headwinds for this sector, the first time in this AGM, Mukesh Bhai did speak about getting into e-com, or at least talking about e-com as a big opportunity. So, see, again, this will happen. The moment these listed companies start making profits, you will see competition and larger guys getting into it.
So on that
just want to add what Nigel said about IPOs. You know, Shirin, even in the private discussions with all these bankers who come out with the IPOs, some of the good friends have told me all these IPOs you evaluate only when they become 1/3 the issue price. You get the euphoria out, and then you evaluate on merits, and then you will make money. So this is, you know, the listing first.
Absolutely, and I think that caveat,
few days are honeymoon period.
I think that caveat is important to put on the table. That's an important caveat that Nigel has put on the table, and I think we do need to look through or look past the initial listing euphoria. But you know, Prashant, going back to the global point that Nigel was making, and when I was talking to Abhiraj yesterday, you know, he said we keep getting asked this question: who is the global equivalent of urban company? And there isn't one at this point in time. But if you were to look at how the global story is really played out on the back of the gig economy and gig workers, where do we find ourselves today with the DoorDashes, the Mithwans of the world?
You know, I'll run you through that data, Shireen. But before that, let me just bring the discussion on. We started with urban companies. So yesterday, when we decided we're going to talk about the gig economy, I asked my wife, who's an avid urban company user, what she likes about it, and she said, and she said, well, I've had extensive discussions with, you go to a parlor, but now you have parlor on demand, right? You can whatever, you can call people home, etc. She said, discussions show that a lot of the, and especially her point was for women, it is a much bigger kind of enabler in that sense, because many of them, for example, when kids come back from school, they will switch off, the app, because you have the ability to do that from say 1 to 5, and then they will reactivate it later. The flexibility, especially for women, that it provides, I think is a significant enabler that I thought.
And there's a significant portion of women on the platform, as you mentioned, and that's in fact a big big
also a lot
part.
of
And that's
a lot of Gen Zs also, including old people in denial like me.
No, so that's
Saturday
also
night party karo, Sunday subah you see below, because the domestic help cannot fix the house after the Saturday night party. So
no, and,
you need
So have you gone through the app, by the way? I went through the app yesterday. There is a service called, for example, if you buy IKEA furniture, IKEA doesn't tell you that you can hire, but they refer you. I think formally or informally they say that there is a service in Urban Company. You can call them and they'll put the furniture together. So there's all kinds of
also, and I'll tell you this. Most of us, I'm sure, are as an avid user of a lot of these platforms, probably all of them, and observing their cost structures, their service, structures very, very carefully. There's a marked difference when you talk to the gig workers on these platforms. There's a marked difference between, say, how the hail riding economy is moving, who are part of that workforce. You talk about the kind of training that they've gone through, the flexibility that they're being offered, and far more greater financial control of their life. You hear the sense of satisfaction, and it's very nicely distributed in terms of your areas where you're working, etc. And I think this is going to be a very, very important differentiating feature in terms of the longevity.
But the model,
these models are
the
different.
risk,
You
and I
can't
think
compare.
Nimesh alluded to that.
Shireen, I had just one question for you.
One of the key risks, of course, is also the supply-demand equilibrium. At this point in time, the supply-demand equilibrium favors the platform players, and so they have leverage, and the customers willing to pay for convenience. But were the supply-demand equilibrium to change, it will certainly be a risk factor that will test the models. In fact, I asked Abhiraj this question, and we'll get that soundbite going for you in just a second. But Prashant, going back again to that global story that we were talking about.
That point, Shireen, that point that Surabhi also made, that training the workforce. I wonder if that came up in your conversation as well, which is.
It did. It did. They spend
organizing
over 100 crores, on just training the workforce.
Yeah. No, I'm saying, say for example,
Every year.
There are people, say for example, using the parlor example, somebody's working at a parlor and because there's no flexibility, got to be there for 12 hours a day, whereas that person suddenly joins Urban Company because it perhaps is higher earnings and flexibility as well, but that person is trained. I'm saying that is organizing what is existing, and the person is trained, and then of course you take them through your own processes. But in terms of training fresh people into these professions, is that also happening? Did you get a sense of that?
Well, no, I think that certainly is the case, and that is happening, but it is still a very small universe that they're dealing with. They're under 1% of the market, and this is a very fragmented market. It's a very disorganized market. So the headroom for growth is significant. It's about 50,000 professionals at this point in time on the platform. But here's Abhiraj. Let's listen into what he had to say on this question of will the model be tested if the supply-demand equilibrium changes.
In FY25, we had the average professional make about 26,500 rupees net per month. And most professionals made well above 35,000. So I think we today offer a platform which has good middle-class earnings opportunity, social security through a free life, accidental and health insurance cover, access to credit at attractive rates, access to formal training. We have to continue to do better here. The onus is on us.
Will the market force you to do better is the question. Is it already starting to look like you will need to do better on that parameter?
Absolutely. I think for us, it's a win-win equation that we're trying to solve. Because the service professional is not a cost center, is a revenue center for us, unlike, say, a delivery platform. The quality of service they deliver is directly proportional to the happiness of the customer and their retention. So happy professionals lead to happy customers. So unless it's in our incentive to actually make sure that professionals do well, earn well, and are well retained. Otherwise, the business model doesn't stand the test of water.
I think those are interesting points there, Shireen, in that conversation. Just to come to your sort of, a question about the global stuff, and I just looked at where we stand. Swiggy market cap is about $11 billion. The eternal market cap is about $35 billion now. So let's look at the global giants. So Uber Eats, and the graphics will come up, global scale of operations. It's part of Uber Eats, is part of Uber. And they're into food and grocery delivery. Market cap, of course, $200 billion, not breaking up how much is derived from ride-hailing and how much is derived from, the food delivery business. There's DoorDash, again, mainly US, food delivery, primarily $100 billion in terms of market capitalization. Meituan, who's completely China, food delivery and some amount of what they call Insta shopping. Now, I don't know if it's 10 minutes or 30 minutes, but $85 billion in market capitalization. But Meituan is, huge. The scale is very, very large.
How do you know how to pronounce it?
You can, up to you. Meituan is how I call it Grab Holdings, right? Southeast Asia mainly, but they are in food delivery, there's ride-hailing, and there is financial services as well. Market cap is about $25 billion. And there is Delivery Hero, which is Asia, Middle East, Europe, but mainly Germany. And they do food delivery and some quick commerce. And it's about $10 billion in terms of market capitalization. So, you've got, if our companies want to look at the global companies, it's Meituan, it's DoorDash, and of course, it's Uber Eats as well.
Sriram, go ahead. You've been dying to make the point that Surabhi kind of stole from you, but go right ahead.
No, so only Blinkit, Big Basket and Urban Company are the two people who have a fair pay policy kind of a framework in the organization. This is from the Fair Work Report 2024. We are talking about billions of dollars of enterprises standing on the shoulders of millions of workers. And we don't have AI, we have people who are,
Our people are the AI.
Yeah, exactly, right? They are all the eyes that we need. Yeah. So, and that is a fundamental problem because this, so what we have seen in Nepal, what we've seen in Sri Lanka, what we've seen in Bangladesh, we are not very far. That income inequality, we've spoken about it. 27,000, 25,000, 20 is not a livable wage in any of the Indian big cities, right? So if you see Big Basket and Swiggy are the only ones who've scored well on fair pay. On unionization, obviously none of them are there. Nobody wants them, and we'll come to that later. It's a different show altogether. But having said that, there will be pressure on these companies in the next 5 years, especially before 2029. I don't see why there won't be an upward pressure on wages from rural to urban everywhere. There is a need to fix that gap. And that will then test these models.
You know, but Sriram, I come back again to the point that, you know, this is not something that can be, of course, unless it is legislated that you have a certain minimum wage and so on and so forth, that's a different story altogether. But otherwise, the market will decide.
Absolutely.
Look at quick
demand
commerce.
supply.
I mean, essentially, at this point in time, it's a three-horse race. You know, there are several other players, including the big boys, who are in that market. If companies want to grow, companies will have to do more, companies will have to do better to satisfy the demand. So I think, you know, the market with the supply-demand equilibrium will be decided in the market by the market.
There's just one caveat to that. Let me add, let's not forget that this is an increasingly organized set of large number of people, workers, right? And from what I've seen, at least, you know, in let's say a state like Maharashtra, when the workers protest, there is not a political spin, but, you know, the political circles are taking note of the protest.
That is exactly what I'm saying.
So, I don't know if it will remain pure demand and supply or somewhere this comes in as well.
Supply demand wala point, I'm saying, see, a supply demand point made in a room like this sounds very good. It is a reasonable point. If you're telling me, you know, I can't give you a hike because there are 5 other people who will do your job, it's fine. But when you're telling somebody who's making 25,000 rupees a month with a family of 4, that is literally the definition of exploitation. I don't think we should, I mean, that insensitivity on that point is the problem.
Nobody's forcing them, no.
No.
They don't have an option. There is serious
So that is why...
But Nimesh, they've also realized, they're also smart people, they're realizing what they're getting paid and, like he said, the billions of dollars that the international franchise, the MNC is making.
Because the guys who are working are also seeing how much money you're making, right?
But the disagrees about the K-shaped and inequality, etc. But the point is, as Shireen said, these companies don't operate in a vacuum, right? They operate in a marketplace. In
No, I'm not saying it's not going to happen.
One minute. Let me just finish. Say, to your point, say for example, if wages rise, why will wages rise? Wages will rise if demand picks up generally in the economy.
Or the government says there needs to be a minimum wage for gig workers.
That is separate. That is legislation. But I'm saying otherwise, organically, why will wages rise? That will rise because demand picks up, companies do better, purchasing power rises. So it's not one going up in isolation.
No, it's also because, so for example, why Uber this thing goes up? Because there are not enough drivers. So you pay more. And the question...
But then you'll have some other player coming in and take that market.
The point is that if there is demand...
Maharashtra is toying with the idea of setting up its own app.
So
these things will create those bubbles along the way.
On this is all I'm saying. These are great platforms. It's not a complaint about the idea.
This is not foreign against wages.
No. I'm saying, so the point is that I'm saying that there are 3 arguments that are usually made. More earnings. You only said 98% of the people are making less than
5 lakh rupees.
5 lakh rupees.
Yeah.
77% of people are making less than, I think, 10,000 rupees or some number. I'll just check that. And the bulk of the problem is in the delivery segment. 40% of this entire gig economy are delivery boys. It does not include a company like UC. So the problem is more in that case for Zomato, etc. The risk is higher. But at the same time, if you see, the labor laws are concurrent subjects. So if there is an issue in one state, it might replicate in another. There might be a mirror effect.
There could be a political angle emerging.
You have to convince 30 governments, not one.
The stroke of pen risk is a risk that every sector has to watch out for. We've seen it play out for the online gaming sector very recently.
Absolutely.
The stroke of pen risk is a real risk that every sector has to deal with, and you know, we cannot preempt what the government may or may not choose to do. All that we're saying at this point in time, you know, do wages need to rise? They will rise if there is higher demand for riders, cab-hailing executives, you know, service professionals who will join platforms like Urban Company, etc. If the supply is
actually in a way
lower than the demand, the wages will go up. But I think it's also important to go back to an example, since we're talking about valuations and market cap, you know, I had a conversation with Sanjiv Bikhchandani of InfoEdge. He was one of the early backers of Zomato way back in 2010. And InfoEdge today, 90,000 crores market cap, eternal over 3 lakh crore rupees in market cap. So, you know,
But that's also because of diversification that you spoke about, Shireen, right?
Exactly.
Diversification is also very important.
So
they have to find something that funds this.
Correct. So I think how much will these companies pivot? They've already pivoted significantly, and they're pivoting at a very fast pace. So, you know, they may not be the companies that we're talking about today, 5 years on. So I think that's also something that we need to be mindful of. But we could continue this conversation. Unfortunately, we've run out of time. But this is an important story, not just from a markets point of view, but really from an economy standpoint, from a job standpoint, from an employment perspective. The gig story is picking up momentum, it's picking up pace, and it is certainly a space to watch very closely, and we will be doing that right here on CNBC TV18. As always, Prashant, Surbhi, Nimesh, Nigel, Sriram, thanks very much for joining us. We'll see you again next week. Till then, from all of us here on the Editor's Playbook, thanks very much for watching.
Hello and welcome. You're watching the Global Reset on CNBC-TV18 Prime with me, Prashant Nair. Today we are focusing on the institution that regulates India's pension landscape, the Pension Fund Regulatory and Development Authority, or PFRDA. As retirement planning, equity markets and financial security become ever more intertwined, PFRDA's role has never been more important. Joining me in just a bit from now is the chairperson at PFRDA, Mr. Sivasubramanian Raman. So thank you very much for joining us. Great to have you with us.
Thanks, Prashant.
And so before I come across to you with my questions, for our viewers, let me just quickly set up the pension landscape as it stands right now, which you oversee in your at PFRDA. So the PFRDA is the statutory body overseeing India's pensions, from the NPS that urban professionals know to the Atal Pension Yojana targeting unorganized workers. It sets the rules, regulates fund managers, and works to ensure that every Indian can look forward to old age income security. Well, our guest today, just a brief bit, the PFRDA chairman, Mr. Raman, who I'll sort of go across to in just a bit, is a seasoned financial sector leader. Before taking over at PFRDA, he headed SEBI, driving credit to India's MSMEs. As chairperson of PFRDA, he brings both administrative expertise and capital market understanding to the task of building India's pension future. The National Pension System, the NPS, is already a financial heavyweight with assets of nearly 14 lakh crores and over 7 crore subscribers. Well, equities, by the way, within this now account for a sizable chunk. The numbers are coming up on your screen. The PFRDA projects the corpus could triple in the next 5 years, basically reshaping India's long-term capital base. Now, in the last year, PFRDA has been rewriting the playbook, so to speak. From October, that is this October, NPS subscribers can hold multiple schemes under one account with high-risk variants, even allowing 100% equity exposure. Other reforms extend the age of entry and tweak costs, making the system more flexible and accessible. Well, continuing with recent changes, there is more reform afoot. Again, from October, private sector, these are proposals, private sector subscribers will only need to annuitize 20% of their coppers, not 40%. Partial withdrawals are easier with 6 permitted instead of 3. Each scheme under the multiple scheme framework must run 15 years before switching, and the exit age could extend to 85 now. These are big changes. The road ahead is full of challenges, but also opportunities. How much equity is too much? Can annuity markets deliver reliable retirement income? How do you extend coverage to the vast unorganized sector while keeping fees low and trust high? These are questions that the PFRDA as a regulator must navigate. Well, that's the short preamble from me. Mr. Raman, once again, welcome to the program.
Thanks, Prashant, and I must compliment you on your research. So you've really put out those points very well. Just a small correction, and that's technically on the record, that the schemes that we have put forth for the non-government sector through the pension funds is something that's going to roll out on the 1st. The slew of changes that we have brought about in what we call as the exit regulations, that is up for public consultation, as regulators must do.
Absolutely.
There's a process of...
those are proposals. The latter are proposals. Yes.
And therefore, we'll have to see, measure it against, what's the kind of, feedback that we get. And there would also be certain tweaks that may be needed to allow for example, if we're saying that we'll allow different forms of payouts through the pension funds. Now, those are products that are maybe comparable or as substitutes or in complement with an annuity. And our idea really is, through the entire set of reforms, to be able to provide more on the table to the customer, such that the customer is in a better position to take a informed choice. And I think that's really what reform is all about. It's not that, you're walking in a particular way and now you turn 90 degrees. It's not that everybody has to turn 90 degrees. We just want to open up the road, allow for many more products. And remember, let's look at NPS. It is basically started for the government sector, then it opened up to the private sector. We are now saying that on the government sector, things have moved very well. In fact, 75% of the AUM comes from the government sector. But it's the private sector in which I'm saying it is the informal sector that really we have probably not addressed. And that is the core, motivation behind this reform. That how do we get pension funds to suitably make a product such that it can go to, for example, the platform workers, which are upwards of 35 lakh to 50 lakh already. Now, they don't...
And I'll come to all of these. So the proposals, right, and the graphics are up on, and we'll keep the graphics on, annuity cut to 20% for private. These are proposals.
Correct.
Right? Partial withdrawals doubled, 15-year vesting before switching. And of course, there's the exit age, which is extended to 85 years.
So the 15-year is already on. It's part of the schemes that the pension funds will propose.
Right. What are you most excited about from what you've done so far and what you're proposing? What do you think makes the maximum?
Good question. So I would say the best thing we have done and what makes me feel truly satisfied is we have handed over the entire gamut of design and execution to the pension funds. Because I think that's where the driver is. I mean, the pension funds have to go out and to meet the customers in whichever, length and breadth of the country that they may be in and create those cohorts, look at, okay, these are the sub-segments that are underserved, these ones need this kind of service. And that is where their skills have to come through. I don't think it's a regulator's job to get into the nitty-gritty of designing each fund or each scheme. In the past, we have basically taken the schemes meant for the government sector and offered it to everybody. But the government sector has its own rules and regulations about it. Now, what we are saying is that for the non-government sector, there is too much of differentiation in our society, as we all know, and therefore each segment of society has its own requirement. Why is it that today's Gen Z is being told, think of 60? 60 is not a number in there. It's for you and for me, maybe not even for you. So I'm just saying that we are looking at saying, okay, there's a vesting period and the word investing has the word vesting in it. So that is what I'm saying. Look at 15 years as a minimum vesting period. If you want to continue, please continue. But at the end of 15 years, you have the right to be able to take that money. You want to reinvest it in some other scheme, in some other sector, in another financial product, do what you like. But look at the returns that you've got over 15 years. That is the power of compounding, which everybody must see. It is very important for a pension product to be seen as long-term and therefore the effects of the long-term must be visible.
I don't want to compare one product to the other, but this comparison inevitably comes up. So allow me, say, NPS versus the EPF.
Right.
What is the compounded kind of returns from these two products? I'm assuming NPS should be far higher, right?
So NPS has a record of about 9.2% year on year for the last about 12 years. EPF is not very far behind. Now, we don't really know what that is because now EPF, let's separate EPF into the provident fund and the pension part. They're two totally different parts. You and I are more knowledgeable about the provident fund part, which today is a tax-free interest return of 8.2%. But that is something which is totally contingent upon what government thinks is a rate of return they can afford to give. The pension part is completely different. So in fact, the pension part was never meant for the well-heeled. It was meant for the persons who, and today that threshold is 15,000 rupees. So persons earning less than 15,000 have to have a pension under EPS. Now, I'm saying when it comes to pension, we need to have a situation where people are informed that these are the pension products that are available.
Let me the point I'm getting at is, right, world over, pensions, assets grow. There are two ways. One, you make it compulsory, right? In the case of NPS, that is not true. Two, make it incentivize it, or maybe one more. Three is make it tax-free, right? Now, in the case of NPS, are you at a bit of a disadvantage? I mean, you are, of course, you've got to do, and you're doing what you can, but within the board is set in this way, right? So it's not compulsory. The tax advantage is, I think, there was a 50,000 thing in the under the new tax regime that's gone. And of course, you're competing against an earlier existing product in EPFO, which is tax-free on withdrawal, whereas in PS it is not. So my point is it stacked
a little against the NPS as a product.
So, as a philosophy, I think the government has taken a view that investment in financial products should not get decided upon by a tax arbitrage. So, I should not be doing a shopping between products because tax is superior or inferior. That's not the way financial planning takes place. So, NPS is at the core of financial planning. It's really for us to better educate our citizenship that you need an NPS product because this is going to sit with you for 60 years. There is an accumulation phase and then there is a decumulation phase. That decumulation phase today is only an annuity. We're looking at broadening that, saying that there have to be alternatives to an annuity. Let the customer decide, okay, an annuity is 6.25, a pension payout from the pension fund may be 7.2. I'm saying the market has to take over. The market has got a variety of products. So, we are in talks with an academic who has already, is working with a few other countries. They've actually come out with a product which is GSEC based, which allows for people to hold small slices of the GSEC in their respective jurisdictions, which provides them a pension-like return. So, we need to be allowing our pension funds to go out and create those products such that if I have a corpus of 50 lakh rupees at the end of 20 years, now I can choose out of that 50 lakhs, I will take some part of that and convert it into an income flow. But right now, NPS, I don't think is at a disadvantage because 60% of your accumulated corpus is tax-free. It's that remaining 40% which people are for some reason fearing the annuity because they feel it's not a fair return. Now again, this is the market. So, we have to allow the market to come out with competitive products.
But you are at the end of the day, there is also a 7.5 lakh total limit, right? Which is, and then with EPF that gets used up. So then room for NPS in that sense. So, there are some issues which I guess the government also perhaps is aware of.
So, 80CCD was a great incentive. And I think world over incentives do exist for guiding people into pension
These
products.
kind of products.
So, I think, there's certainly a scope to look at that, study it, and maybe we can, have a look at what
you think. I remember Mr. Jaitley back in the day, I think it was 2021 when he was finance minister, he said with EPF, and these are his words, not mine, he said with EPF doesn't have subscribers, it has hostages or something. I think something like that he had said.
I didn't know this.
And he basically talked about, whether this should be transferable, EPF and NPS, right? You think that's something which is we should
again? I think it's actually a very
move from
bold
one to the
idea.
other seamlessly.
So, I'm just saying in terms of financial products, money will always flow to where you get the best benefits. So, I think it's only fair that financial products get created, they compete with each other and let the customers choose. But I'm saying let customers choose between like and like.
Correct.
It's not that I'm choosing NPS over something which is unlike NPS. So, we need to look at consolidation of retirement products, but let's be clear that we should have similarly aligned products and therefore there should be a definition called, okay, these are retirement products and therefore it follows a particular norm. But I certainly believe that to reduce the confusion in people's minds, we probably would benefit. So, there is in fact a regulatory forum which has been created under the DFS and such issues would probably get discussed. We've had one meeting in that. And I'm sure many of these issues, as you well expressed, will probably come up.
the NPS is not employer linked, it's employee linked, right? So especially, and I'm talking about this in the context of gig workers, for example, which is such a large and growing workforce, where you have these platform companies who are hesitant in coming on as and being called employer.
Right.
You think it's a captive kind of audience for something like a NPS?
NPS is for everybody. NPS, as you yourself said, is voluntary, and that's why any and everybody can pick it up as a financial planning and a safety product. The platform workers are in a peculiar situation vis-a-vis the existing products. So, you know, we look at it saying, oh, you're not an employee, so you don't come under this. They don't need to come under it. They have NPS as a product already available. It's probably, let me say, our combined failing as the PFRDA and its stakeholders that we haven't been able to reach out to that segment as yet. And that's one of the prime segments which is going to get addressed through this new pension schemes that we are asking the pension funds to roll out. They've already in talks with some of the larger platforms such that the entire database of those workers, let me say the platform workers, because that's the technical term that's used, we can bring them in and get them seamlessly to start their NPS contributions. So, you know, there is a need.
So there is a concerted effort by pension funds to do this, to kind of sort of
we are very clear
engage with this cohort of population.
And more than one pension fund will certainly come up with this scheme because there's such a large target segment to be brought within the scope of NPS.
We don't have a specific scheme.
So again, we're saying that it is for the pension funds to design the schemes. Let them design the schemes based on various persona. So the platform worker is one such persona. And create it such that it's easy for them to, you know, realize their financial requirements. What we're also saying is that kindly go across. In fact, one of the pension funds is looking at a scheme for women. That's again a segment which is underserved largely. So it is for them to be able to figure out how they want to implement those schemes with the right design and then go after it. And therefore, we've said that typically NPS prides itself on being the lowest cost financial product, and it is by a mile. So, you know, we've done the comparisons. So, even after putting a little more money on the table within the pension schemes, for them to be able to provide a much better distribution commission, we're still the lowest cost financial product. So, I say we will probably test it with what we're doing right now. But our goal is very clear. We have to cover the country. So today we have about 1 crore people under NPS outside of government. There's about another crore within government. There's about 6.5 crores within Atal Pension Yojana. This volume is not something that we can sit back and look at. We have to drive that very hard. And that is really where the growth is going to come from the private sector. And we should be looking at numbers between Atal Pension, which is for the underprivileged and the, you know, particular in sector, which I'm saying is not only an informal sector, but it's a sector that needs help from the government. We also have a very large informal sector with varieties of subsegments within that. And that is really where we're saying the growth can come. So we should be looking at the end of 5 years, something to the tune of 30 crore people coming under NPS and APY. And overall, I mean, these are numbers that we've run, saying that the AUM could probably be touching about 45 lakh crores.
So 7.3 subscribers right now, you're saying could be 30 crore odd subscribers in 5 years?
It's roughly about 8.6.
Okay.
So, you know, APY plus
45 lakh crores?
That is right. That is what we're putting as an ambitious target before ourselves, saying that that can happen. And there's another much larger...
And give me the equity number as well. How do you think? I mean, this is of course a projection. Now that you've allowed all of this, 100% equity, etc. I mean...
that's rather speculative because I'm not sure...
It's under 3 odd lakh crores right now.
That's right. So it's roughly about 18% of the AUM. If we look at the way pension funds are creating their schemes, some of them will come up with aggressive schemes, which could even be 100% equity for those particular classes of people who can take that risk. But my sense is that from an AUM perspective, equity would probably never go more than 1/3. It's unlikely because we need a balanced portfolio. And that's really the concept of growth over a long period of time with a diversified asset portfolio. That's where the, sort of returns start kicking in. So in a bad year of equity, you have, G-Secs and corporate bonds which come in and keep up the return. So the sense I get
these kind of products are available globally as well? For those who want, they can go 100% equity globally?
Of course.
They are available?
Yeah, absolutely. Okay. So if you look at what other regulators have done, they've given a range. That range actually goes up to 100.
Okay.
So this is what we are also doing.
But the lure of return versus risk, etc., you think, it's...
Absolutely. So it's very important to ensure that there is no mis-selling. But you'll be surprised how many people over 60 have a corpus and they're willing to take some slice out of that corpus and say, I'm putting 100% of this into equity. Now, I think it's fine. It's just that the pension funds have to be very clear that if a person much in lesser income or wealth and then start saying that, okay, I'm offering you a product which is 100% equity. So it's very, very important to be able to put those guardrails. And I think we've already done that as part of our scheme approval process. So we will make sure that the pension funds are not going overboard and trying to promise something which is probably not maybe achievable, but more importantly, not suitable.
Commodities, etc. as well, you think there's a chance?
There is a demand for commodities and that is really a demand for gold and silver. I think that's important because it's a very good diversification. So from, I would say, more of a safety point of view rather than a return point of view.
Although returns have not been bad lately. But where is that process at? That is in consultation or
that is happening right now, and we have a system of an investment guideline which goes through a committee. And that committee is working on it. We have the benefit of another committee which has looked into the pool corpus. And therefore, we've got some excellent recommendations from there. So I think we're putting it together and we will come out with a more enlarged list of instruments that can be invested in too. This will probably...
So there will be commodities, which is gold and silver, specifically? Likely. What else? You said other instruments?
No. So, you could... Again, it's a matter of looking at what is there, which is demanded by the pension funds, and then we'll have a look at
But what are those demands right now? Gold and silver is one,
There's
as you
nothing
said.
which I can really recollect immediately.
Okay.
Because already there's a variety of instruments that has been
available.
allowed.
Yeah.
So, the other demand was the unlisted companies, especially in the startup space, the AIFs. Now that is allowed, but there is a particular operational requirement. So that's one of the demands from the pension companies, that they be given a slightly different way to operate it. So it need not be just an instrument, but the way the instrument has to be operated.
So that's has to be a kind of it has to be a new structure, but not within.
Correct. So we'll have to look at whether that investment in an AIF needs to be part of equity if it's an equity AIF.
Sure.
It needs to be part of debt if it's a debt AIF. It doesn't probably make operational sense from what they have given us to understand that it should be a standalone
asset class in that sense. It has to be counted as, either debt if it's private credit or something, and
that's right.
These unlisted investments, etc., on the equity side.
That's right.
So all this is how far out, you think? In terms of, it'll be a gradual process as you take these decisions, or it'll be like a one set thing which...
The investment guidelines will probably happen, I would say 30 to 45 days, something like that, because it's a process and then it goes to the board and therefore it will take its... But the idea is to put it out quickly because, we would like the pension funds to be able to design schemes in a better way. And we would also like to have other segments of business to get the benefit of the kind of capital that is raised through pension funds.
So next 45 days, whatever, we'll have these out and then they'll have to be approved by there'll be consultation
It'll go through the board. It'll go through the board and the board has to approve it.
They'll have to operationalize it with an effective date, etc.
Correct.
Mr. Raman, I have more questions, but we are out of time, so I would urge you to come back on this program again. Really appreciate you joining us here, and I hope you sort of succeed in your endeavors to really expand the scope, scale of the availability of pension, which is so necessary for all Indians.
Thank you so much for having me on the show.
Thank you very much, sir. Thank you. Well, insightful conversation with the chief chairman, leader at PFRDA, the pension regulator. That's it on this program. Thank you very much for staying with me.
Welcome to Startup Street. I'm Ritu Singh, and with me are Arundhati Ramanan and Shruti Mishra from the Mumbai studio. Here are the key headlines from the startup world. EdTech firm Educational Initiatives has acquired Open Door Education, which is a learning platform known for its thinking-focused approach, for an undisclosed amount. The strategic move will bring Open Door Education Technologies tool and school network into the EI fold, as the latter aims to enhance learning outcomes for K-12 students across India and overseas.
Infra Market has raised nearly 732 crore rupees in Series G funding round led by Silver Line Homes with participation from Tiger Global, NK Square Axle India, Nexus Ventures and Evolvance India. The company is preparing to file its DRHP with SEBI.
Google has selected 20 AI startups in India for its accelerator program, focusing on healthcare, finance, climate, and education. These companies are developing agentic multimodal and foundational AI models. Google will provide support through Google Cloud Infrastructure, Gemini models, technical mentorship, and go-to strategies.
Donald Trump and Xi Jinping are scheduled to speak today as Washington and Beijing try to finalize a deal to keep TikTok operating in the United States. The talks could be a precursor to a potential in-person meeting later this year.
And Apple's new iPhone 17 goes on sale. Thousands throng Apple stores across the world. A scuffle breaks out at the Mumbai Apple store. The starting price of the iPhone 17 in India is 83,000 rupees. All right, so those are the headlines that we're tracking for you today. But in what's brewing, climate tech startup Equilibrium has secured $3 million in a seed funding round from Kalari Capital, Peak 15 Partners and Avana Capital. Equilibrium integrates carbon science, digital monitoring and community-driven execution to deliver high-quality, verifiable carbon removals that build climate resilience in India's food systems. This fundraise is going to support the expansion of 8 pipeline projects across 9 Indian states that will cover 1,20,000 hectares of land and engage over 1,50,000 smallholder farmers. Collectively, these are expected to generate more than 20 million tons of high-quality carbon removal. But for more on the funding and the company's plans ahead, joining me now is Siddhant Jayaram, the founder of Equilibrium. Siddhant, welcome to Startup Street. Thanks very much for being with us here. Briefly start by telling us about the company. You partner with farmers, as we understand, to fight climate change, creating new income streams through verified carbon removal projects. What are the biggest challenges in getting farmer participation at scale as well, and how do you plan to sustain this?
Yeah, no, thanks firstly for having me here. And yeah, regarding the company, we generate high quality carbon removal credits, right? What does that mean essentially, right? We work with farmers who essentially have barren land or land where they're producing today, and we make them transition into climate resilient agriculture. And when they transition to climate resilient agriculture, they're also either reducing or removing greenhouse gas emissions or carbon from the atmosphere. And for the greenhouse gas emissions that they're reducing or removing, they end up earning what we call as carbon credits or carbon removal units, right? And these units are then purchased by companies, organizations, and, in some cases, even governments that have net zero targets, right? There are lots of big tech companies, big oil companies, and even the Singapore government that today has net zero targets, and they're the ones procuring these credits from organizations like ours. So broadly, in terms of how we work with farmers, we work with, a lot of existing infrastructure. So there are NGOs, FPOs, and other farmer-facing organizations that already have trusted relationships with smallholder farmers. We work with these intermediaries and organizations to tell them or to provide them best practices to convert these land areas into, climate agriculture or carbon removal sinks, whether it is transitioning to agriculture that is organic, whether it is to move towards agroforestry practices, or implement products like biochar that improves the carbon content in the soil. So we have a plethora of solutions that we offer to smallholder farmers, and they not only improve or enrich their soils, but they also earn an additional revenue stream in the form of carbon revenue.
All right. Your portfolio spans agroforestry, regenerative agriculture, mangroves, biochar. Which of these pathways is showing the most traction, and which do you expect will drive the largest impact in the next 5 years?
Yeah, I mean, in terms of, the amount of carbon sequestered or carbon removed, agroforestry definitely seems the most promising. But in terms of the number of farmers that is being that we are impacting, regenerative agriculture will continue to be the largest driver of, growth / amount of impact that we're having. With that being said, each one of these solutions bring their own strengths, right? Mangroves helps, local communities in the region, not only as an income stream, but also with climate change. There are lots of cyclones, for example, in the Sundarbans that really affect these tribal communities. So it's important to understand that, when we're building these critical infrastructure, we're not only sort of adding a revenue stream, but we're protecting them from the perils of climate change itself. So each of them bring their own unique perspectives. But in terms of scale and impact, this is the order that will follow.
Okay. Got that. Siddhant, now that you've got this $3 million check, tell us what the priorities are in terms of deployment.
Yeah, so priorities are to continue to scale these projects, right? So we started them with some initial amounts of capital that we ended up financing from our balance sheet. So parts of the scaling up is also now a critical area where we will end up investing some of this capital. Outside of that, we'll continue to build our technology stack where we measure and monitor all of these carbon removal solutions. Outside of that, we're continuing to build a world-class science team, operations team, and technology team. So parts of this capital will be used to continue to build a team that can deliver on our ambitious climate goals.
Siddhant, since you're a young company, if you could give us a sense of how fast the company is growing, if you could put some financials, some numbers to it, what kind of revenues and scale have you already achieved, and what is the sort of outlook you have over the coming few years as you continue to grow?
I mean, we're honestly a very young company, started a couple of quarters ago, but in the next 12 months, we'd expect to sort of be north of a couple of $1 million in revenue. Probably, I know it's a lower base, but we'll end up growing probably 15 or 18 times from the last fiscal year in the next 2 quarters, which will be the end of FY 25-26. With that being said, in terms of growth over the next 2 years, we do expect a lot of companies, a lot of organizations to continue to ramp up their carbon credit purchases and carbon finance and enable the carbon finance industry. So, we only see positive growth in this segment. 2030 is when most of these organizations have interim goals. So, in the next 3-4 years, we expect this to sort of translate into potential revenue into our organization.
Got that, Siddhant. Thank you so much for sharing your thoughts with us, and we wish you the best with this venture. It's been a pleasure speaking with you. Thank you.
Likewise.
And moving on, Evolute IX has raised $53 million in a minority growth capital round led by global private investment firm Baird Capital. The fresh funding will give the Bengaluru-founded startup the firepower to supercharge its international expansion, deepen investments in its India R&D center, and cement its leadership in agentic AI-powered automation. Founded in 2019 by a group of tech visionaries, Evolute IX has built a platform that redefines how enterprises automate complex business processes across industries like banking, insurance, healthcare, and telecom. With recognition from Gartner, Everest, and IDC already under its belt, the company is now looking to scale globally, hire top talent in India, and make strategic acquisitions as it ushers in the next phase of AI-led transformation. Joining me now to discuss this further is Sumit Gupte, the co-founder and CEO of Evolute IX. Sumit, thank you so much for joining us on the show today. And before we get into the fundraise, if you could sort of take us through the kind of growth Evolute IX has already seen, and in what way does Evolute IX agentic AI platform go beyond traditional automation solutions in the enterprise space?
Yeah, so let me first start with the right name. We are Evolute IQ and not Evolute IX. So just want to go on record. But we've had a phenomenal journey from the beginning. We started back in 2019, and our whole ethos and philosophy was that we wanted to focus on the problem rather than parts of the problem. So if you look at any organization, any global organization that has been consistently delivering successful outcomes, whether it's a bank or it's a courier service or it's an airline company, the one thing common between all of these organizations is they have good, consistent processes that allow to create the right outcomes. And so myself, Deepak, Sanjay, Naveen, and Arun, when we got together, our thought was that, hey, why don't we build a technology that sort of underpins all of this and solves the problem for the entire process rather than pieces of it. And most importantly, build a technology that can think for itself, that can be autonomous, that can learn, basically, essentially do whatever a human can do, but better and consistent, right? And I think that's sort of what we started with as a concept. We've built on the technology and we continue to scale. And it's been a phenomenal 6 years that we have put together, and love the team. We sit here today with significant growth as well as scaling globally.
All right. Just to point, Evolute IQ, I said IX by mistake, but you have raised $53 million in funding. So how will these funds sort of help Evolute IQ fast track its big global expansion plan? Could you take us through how you plan to use these funds that you've raised?
Yeah, I think we are an innovation company, right? So the heart of it is the technology. That's our central nervous system. And we have been ahead of what most of our peers have been doing. So while people have been focusing on one part of it, we have always looked at the entire end-to-end. And we will continue to do that, right? So we are moving towards what we call the vision of singularity over the next few years. And so a big chunk of the investment will be towards the continuous innovation. The second big chunk of the investment is going to be scaling our operations globally. So, we are headquartered out of Stockholm. We continue to scale in the US, which is one of our largest markets. And then India is obviously a very, very strong pillar of growth for us, especially with the GCCs. And then, a big chunk of our R&D talent sits out of Bangalore. And that's sort of, a big hub for us to invest in terms of talent and also in terms of operations.
I was going to come to the India plans in just a bit, but if you could take us through your current, client list and which industries, because you cater from banking, insurance, healthcare, there are so many industries you cater to, are likely to see the biggest transformation from this technology?
You're talking to a bunch of engineers and innovators, right? So we build technology that can solve the problem. And I think over a period of time, what we have seen is our biggest customers have been Fortune 500 customers, and most of them have been in the healthcare and the banking and financial services sector. We have seen a sudden surge in the insurance sector as well. So those are sort of the three key industries that are scaling now. And, we all know, right, the GCCs are sort of becoming the core of a lot of innovation, especially around the AI space, which is what we are, a core native AI platform. And what we see is, India taking sort of the pole position in terms of some of these core innovations with our customers who have opened up the GCCs. So it's not just an innovation center for us, but it is also a build and a scale center in terms of, operations and business.
Sure. And if you could take us through the kind of revenues that you're currently clocking. Where do you hope to end this year and what's profitability looking like?
So, it's public news, right? We have always been a bit positive and we continue to scale. So I think that's been a very core part of how we have built the company and sort of the philosophy of the founders. The more important thing is, we have been doubling on our license subscriptions ever since we started. Our CAGR on the license subscriptions has been north of 100%. We don't see any reason for that to slow down. In fact, post this with the investments in sales and marketing, we do expect that to actually grow even more. And so, that's sort of the track we are looking at, the trajectory we are looking at. And, with Baird Capital, investing and with them bringing in their balance sheet and the scale and size and sort of the access that they have, especially in the healthcare and the financial services space, I'm fairly confident that, we will blow the numbers out over the next few years.
Sure, you'll blow the numbers out over the next few years. But if you could quickly let me know, currently most of the growth is coming from US and UK, right? If you could take us through where India stands and what Evolute IQ's India plan is, how do you see the revenue mix changing in the next few years, if you do?
I think if you look at the global spread of our revenue, US obviously is our largest market, followed by UK and Europe. But the acceleration that India is showing in terms of using the technology and the adoption, because even if our clients are headquartered in the US or the UK, they have significantly large, development centers or GCCs or their own subsidiaries out of India. And we have seen that piece of the of the business starting to scale very, very significantly. I mean, if I have to talk numbers, I expect India to be like growing 300-400% out of the entire portfolio over the next 2 to 3 years.
So big growth there that you envision for the India market. All right, Samit, thank you so much for taking time out and being here on Startup Street. And we wish you all the best going forward.
Thank you so much. Thanks for having me.
Well, on that note, it's time for us to head into a short break. But coming up, BlackRock-backed Minute Media makes a big play in India, acquiring AI startup VideoVerse, a company known for using cutting-edge technology to automatically extract and package sports highlights. What does this deal mean for the global sports content game? We find out on the other side. Stay tuned. Welcome back to Startup Street. Global technology and sports content company Minute Media, the name behind Sports Illustrated and the Players Tribune, has acquired India-born AI sports video platform VideoVerse. Now, VideoVerse's flagship product, Magnify, powers instant highlights and short-form video for FIFA Plus, ISL, Willow TV, and more. With this deal, Minute Media says it's creating a full-stack solution from creation to distribution to monetization, while also expanding its AI footprint in India. Joining me now are Asaf Peled, founder and CEO Minute Media, and Vinayak Srivastav, the co-founder and CEO of VideoVerse. Gentlemen, welcome to Startup Street. Asaf, let me start with you. If you could first give us a sense of the deal size and confirm if this is a 100% acquisition. Also, Minute Media already has a strong global presence in sports and content. So why was VideoVerse the right fit to acquire at this point?
Hello, Shruti. Thank you for having me. It is indeed a 100% acquisition, so we own the entire company, VideoVerse. I cannot expose or share the exact number, but you may assume that it's a substantial deal, hundreds of millions of dollars of enterprise value.
Okay.
And obviously, Minute Media is quite global, but that's a key entry into the strategic market of India for us.
Sure. And why VideoVerse?
Sure. So as you've indicated, we are a global sports tech and content company. And for us going forward, one of the key areas of focus is working with global leagues, teams on the areas of AI and video, and looking at a few leading global companies in that space. We figured that VideoVerse is really the best target with the best tech platform and the best cultural fit for us, for Minute Media, to grow together over the next few years.
All right, let me go across to Vinayak here. Vinayak, you've built Magnify into a platform used by FIFA Plus, ISL, and Willow TV and the likes. What convinced you that Minute Media was the right partner for the next stage of growth? And what is the big impact you want to create now together?
Thank you so much for having us on the show. I think my personal belief has always been that AI-driven video technology has the power to transform sports content. To fully unlock the scale of that vision, we needed a partner with global reach, distribution, and a complementary culture of innovation. Minute Media was exactly the natural choice that we ended up finding eventually. Together, we're creating something very unique, a true end-to-end ecosystem where technology and media converge together. The big impact we want to make now is to redefine how sports content is created, distributed, and monetized worldwide, delivering more value for sports content owners and more magic for sports fans everywhere.
All right. Asaf, like I mentioned earlier in my introduction, you now want to offer a full stack solution, creation, distribution and monetization. So tell us, Asaf, how will this change the value proposition for leagues and federations that you work with?
VideoVerse acquisition, we've already been working with top leagues around the world, predominantly in the US, like NBA and NFL and MLB, where we have distinct and unique distribution agreements where we can essentially distribute and monetize those league highlights. But one area where we are significantly lacking is on the AI-driven video content creation, and that's really what VideoVerse brings to the table. So now when we target a global or a local league, we have the full scope of creation, distribution, monetization, and we feel that no other company in that space globally can come up with that end-to-end offering.
All right. Picking up from what Asaf just mentioned, Vinayak, Magnify is known for its AI-led capabilities, real-time highlights, multilingual subtitling, automated workflows. What new innovations are you now doubling down on post this acquisition?
I think we've only scratched the surface of what AI can do for sports content. We are working on exploring AI capabilities in multilingual expansion 2.0 to go beyond subtitling and localized storytelling for global audiences. We are getting into interactive fan feeds where AI builds dynamic highlight feed fans, and fans can interact with their content. Example, they can choose their own perspective, their favorite player, follow the view of the ball, everything that a fan would want to do as they would be in the stadium. And then goes the monetization intelligence, where AI identifies high-value clips in real time, sponsorship, hotspots, viral moments, and suggests monetization routes instantly. I think our mission for Magnify evolve into a global sports storytelling platform that is personalized and immersive has just begun. And I think we're unlocking experiences and revenue models for partners.
Sure. Asaf, let me now talk about the India market. With Minute Media spanning 14 global markets, where does India fit into your AI and technology roadmap now that VideoVerse is part of the family?
So India has been a key strategic driver of that transaction. By the way, Shruti, I personally have lived and worked in India in the past, so there is a personal element there as well.
Okay.
No secret that India is just the largest market in the world in terms of population, sports fanship, and also in terms of technology excellence. We focus on video and AI technology. So looking at our global tech and development presence in AI, India is now becoming a huge component. Obviously, it's a large addressable market. Looking into sports, it's the home of cricket, and so on and so forth. So there are many drivers behind it.
All right. Vinayak, you've literally scaled VideoVerse with backing from marquee investors and taken deep tech from India to the world. What's the growth plan ahead, both in terms of geographical expansion and revenue targets?
I think we've been very lucky to partner with some of the best investors and also team members, right? My entire team from people like Meghna Krishnan, Ritu, Prateek, Nitesh, Rohan, Om, Vivek. There's a bunch of people that I can keep naming that have contributed to the success and where we are in the journey. We have had really great investors and partners and advisors backing us through the journey, whether the likes of Moneta Ventures, Bluestone, Audacity, 9 Unicorns, Evolvance India, and many more. We've been blessed to have the right set of people around us, the advisors like Maker Group, the SKS Group, and a bunch of people that have just supported us through the journey. I think with our merger into Minute Media, we're entering the next phase of growth. Geographically, our focus is to double down on the US, EMEA markets, where we're already working with top leagues and publishers, while also expanding deeper into Asia Pacific. And I think where demand for scalable video solutions is growing fast is just a global one on all sides. On the revenue side, the ambition is very clear. We want to accelerate growth by combining VideoVerse's AI-led technology with Minute Media's global distribution and commercial scale. I think together we are definitely building towards a business that grows top line revenue, but also grows it sustainably over a period of time.
All right, one final question I want to ask. Asaf, sports media is a fiercely competitive space with tech giants also investing heavily in AI-led video now. How do you plan to stay ahead of the curve? If you could answer it like 20 seconds.
Definitely. So I would say tech-driven platform focus on AI entrepreneurial energy and passion like the one that Vinayak and we bring to the table, and global footprint. That's the recipe going forward.
All right. On that note, it's time for me to wrap up this conversation. Many thanks, Asaf and Vinayak, for joining us on Startup Street, and wish you the very best with this collaboration.
Thank you so much.
It is Friday and it's time to look at all the deals from the startup world. This week saw 22 startups secure around $300 million as per Venture Intelligence. Some of the notable deals include construction's materials marketplace Infra.Market, securing over $54 million from names like Tiger Global, Accel India, Evolvence and Nexus Venture Partners. And business automation startup Evolute IQ bagged $53 million, while B2B credit infra market platform Finbox landed an investment worth $40 million. Wealth management player Incred Money raised $30 million from Mankind Family Office, MMG Family Office and others. And digital lending platform Finable received $29 million. So far this year, over 650 startups raised around $6 billion.
Well, with that, it's a wrap on this edition of Startup Street. More news and updates coming up on the other side.
Class of 2025, the graduating class of 2025, all of you in your blazers.
Just a bit older.
But you know, back at IIT or IIM, I mean, did you think that you'd be here one day?
No. I think you know, when you start, you're really not thinking about these things. You're thinking about survival.
In the near term, is the bulk of the investment going to go into native, etc., or into the core business?
I think it will be a mixture of investments in core, investments in the newer lines we are trying, investments in native.
India is the bulk of our business and continues to be the bulk of our focus.
The employee portion was subscribed 37 times almost, so perhaps around that number. I mean, that tells a story about the belief that your people have in what you're doing.
You know, we don't have enough employees to have it oversubscribed 37 times. So we were also curious. So I asked one of my team members to dig in and find out what's really happening. And turns out a lot of service partners had bid.
One of India's most awaited startup listings has hit the bourses today. Urban Company has listed at a 57% premium on the National Stock Exchange at 162 rupees against the issue price of 103. The company has seen its market cap cross 25,000 crore rupees on listing. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Founded in 2014 to bring structure and trust to India's unorganized home services sector, Urban Company has today grown into Asia's largest tech-led platform for home and beauty services. It operates across 51 cities, including international markets like Singapore, the UAE and Saudi Arabia, and it's expanded into new verticals under smart home solutions for native and home improvement with Revamp. The company closed FY25 with net transaction value of over 3,270 crores, revenues of 1,144 crores, and a transacting user base of 7 million, 48,000 professionals under the Urban Company umbrella today to try and create sustainable livelihoods while also attempting to deliver consistent service quality. Joining me now are the co-founders of Urban Company, Abhiraj Singh Bhal, Varun Khaitan and Raghav Chandra. Gentlemen, it's wonderful to have you join us here. Congratulations to start with. And, from a 100 square foot office space in Bikaji Kama Place in New Delhi to the Lal Street today. Abhiraj, let me start by talking to you. Has it sunk in? It was a little bit of an emotional moment. I could see, at least on account of Varun getting teary-eyed. But what was it like for the three of you?
I think it's still sinking in, Shireen. I think it's it has been an emotional day. It is it's a feeling like no other. It's a feeling of happiness, but also one of responsibility, humility for all the love we've been getting. We had service partners, employees, ex-employees, family, everybody join us today.
So there's about 100 odd people here in Mumbai for the listing?
There's more than 100. And I think it was heartening to see everybody so happy. So yeah, I think you never imagine this when you start a company. But we're glad that we're here today.
Urban Company is 11, but the two of you have known each other for 2 decades now, 20 years, and that's a deeper, longer association and partnership. Varun, you got emotional today, but what was the feeling or the memory, the core memory that you had while you were speaking today?
A lot of thoughts running in my mind at the same time. Right from times we spent together in college, when we after college decided that we need to get together and do something in the service of India over the next many decades, to the many months the three of us spent the streets of Delhi trying to really identify what business we should build that will create large impact in the lives of millions of Indians. And be a company that they will look forward to, a company that will make a difference to their daily lives. And then, like a fast forward of the last 11 years, while I was trying my best trying to hold emotions back.
Well, Raghav, you've known them for 11 years as well, and you've of course been part of the Urban Company story from its inception. As you stand here today, what would you say has been the biggest factor for success at scale so far?
I think as a team, we have been known to showcase very strong ownership. In fact, while we were on the stage talking through, it just reminded me how all facets of Urban Company kind of come together, be it our internal teams showcasing ownership when it comes to just doing their best, going beyond what's needed, or our partners who kind of go to customers' homes, just own up the brand, own up the experience. I think that's probably what our decade of building has been at its core.
Well, talking about the decade of building, but now importantly talking about the decade ahead. The kind of reception that you've got from the Lal Street clearly is an exemplification of the fact that people are believers in this story and believers in the fact that there is potential headroom for growth. I know you said that you've got a very strong balance sheet, but you also said that you want shareholders to be patient. Public market patience and private market patience are entirely different things, Abhiraj. So, what are the levers that you're going to exercise now to get to profitability as you've promised?
I think for us, Shireen, long-term growth and long-term profitability is very important. We see our business in parts. There is the very profitable core in India, which is growing well. It has been profitable for the last year or so. It had a 3% adjusted EBITDA margin as a percentage of NTV last year. That went up to about 4% in the first quarter. And I think that core will have to continue to compound well, grow well, and continue to compound profitably. The new segments where we are, which is InstaHelp, Native, I think these are the areas where we will invest. And at the right time, hopefully either in the first or the second earnings call itself, we will come out very, very clearly to investors with how long will that investment phase last, what is the capital we would like to deploy.
But give us a sense of what we are talking about in terms of investments. And let me contextualize this, because what we've seen with other listed entities, now Eternal, Swiggy, and so on and so forth, they're all having to diversify into new distinct businesses. Eternal with Blinkit, and now District, and Swiggy similarly with Instamart and a few other offerings. Is that now a go-to for platforms like yours to really build out these new distinct verticals, these new distinct offerings to keep growth going?
I think for a platform like ours, at our core, we think of ourselves as a home platform. Anything inside your home is definitely relevant for us. The user trusts us to enter their homes, and we don't take that trust lightly. We understand that that trust comes with a lot of responsibility. I think today we are playing in many services, but not the end state of everything we can do. So in the end state, any service in the four walls of your home will very much be part of our ambition and our playing ground. And similarly, we are imagining a connected ecosystem inside your home of devices which have a strong affinity with our service ecosystem and our platform. So more than a services company, we think of ourselves as a home platform, and that's what we're building. It's hard to see it today, but I think over the next 10 years, this will play out. And we want to be the operating system for your home, the backbone for your home.
The operating system for your home,